Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. Thursday morning, we are coming to you live as always from the CNBC-TV18 News studios. In 2 good days, can we see a repeat today, build on the gains? That's the big question. I'm Prashant. With me, my colleagues Nigel and Surabhi. Guys, good morning.
Hi, good morning, folks. Well, yesterday we managed to break out of our long-standing trading range. And this morning we've not woken up to, any untoward incident or any, out-of-the-park kind of news. So maybe, who knows, bulls keep marching on.
Well, it feels a little weird, right? I mean, no big news point overnight. But let's see. And today we have expiry as well. So let's see how it plays out.
Absolutely. And last night was kind of, from Wall Street, not very much by way of cues. It's kind of flattish, actually. But markets
and no missiles on social media either.
On social media. No, actually, there are a few.
Actually, there are a few.
There are a few.
But, that's the times that we are in. Now, just to take it from the top, the U.S. market and the S&P at least was largely unchanged. S&P 500, that is, largely unchanged from the previous close. Actually, it was actually absolutely unchanged. But it remains, the headline is not that. The headline is it's just less than 1% away from an all-time high. It's been that way, The one sort of, as we get into the end of the month, there seems to be some selling which is happening. I mean, 2 days in a row now, we got to above 6,100 and then the market kind of sort of sold off and closed under it. So we'll see if there are some outflows bunched up to the end of the month. But that's very, very near term. NASDAQ about 0.21% higher. The Dow was down about 0.25%. So kind of mixed signals in that sense. I just want to talk about one or two single stocks. NVIDIA was up 4%. That's hit a new all-time high. That is part of the magnificent, fantastic 5, 7, however you want to count it, but the big tech, right? So NVIDIA hits a new all-time high. The graphics will come up on your screen. The other one, of course, is BP, British Petroleum. British Petroleum at one point was trading up 10%. It finally closed about 1.5% higher. There were reports that Shell is in an early stages of a potential acquisition. Shell BP. Now that could be a big one. Perhaps implications here in India as well, because you've got, the companies listed in India, in terms of Castrol. So we'll see. Macro markets, not very much. US 10-year yield was down 1 basis point, so unchanged, 4.29, 4.3%. Oil prices went up a little bit. The stock of oil, which was reported by the US government, that fell more than expected, but nothing, 68, we're right there, pat there, so not very much. Now, the other bit of news, of course, is coming out of Europe, and this was actually happening while we were still trading. some bit of it, the Trump press conference with the NATO Secretary General Mark Rutte happened while at about 1:30, 2 o'clock. We'll play out some of those comments from Trump. But the headline is, as expected, NATO has agreed to increase defense spending to 5% of GDP by 2035. The question, though, is how much of this is actually going to happen? How much of it is rhetoric? Trump's term, remember, ends in 2029. So, do we really have the ability to forecast beyond that point how things will be? But for now, given all the threats, they've agreed to reach 5% of GDP by 2035. Spain withheld from the commitment. President Trump then threatened to increase tariffs on Spain. But he was positive otherwise as far as Europe is concerned and NATO is concerned. And he basically said that we are here to help Europe protect their countries. Remember, he's threatened to pull out of NATO by saying, well, why should we spend all the money on NATO to protect you while you are not stepping up your spending? That basically has been the grouse for a very long time from President Trump. So that's the news flow bit. I don't think there are any real implications straight away. Defense stocks run. Actually, if you look at even European defense stocks yesterday, it's not as if they were zooming up or anything. This is well advertised in that sense. Here in India, for example, defense index was down 2%. It was the biggest loser, and actually for the last 2 sessions, it's been seeing a little bit of profit booking. I'll just tie in the levels. So yesterday we got a good rally on the Nifty, and I was saying this yesterday, same time, that day before there was perhaps for some a little bit of hesitation whether the peace will hold, but yesterday it became clear and the market marched on. We ended at about 25,244. We need to take out 25,317 levels, which is the high of the week. And then after that, then you open up further upside levels. The weekly upper Bollinger Band stands at 25,823. So that is the target. On the downside, if you just look at the supports, 25,055, which is the 40-hourly exponential moving average, and then the 20-day moving average, which is 24,897. Bank Nifty needs to close, moving on to the next index, Bank Nifty needs to close above 57,049. And here the upper weekly Bollinger Band, which becomes the target. Next target is 58,877. Support, again, same sort of averages. 40-hourly is 56,260, and the second support at the 20-day, which is 56,040 levels. GIFT Nifty will give you a quick sense of how we are likely to start. It's up another 40 points. Surabhi.
Yeah, absolutely. So quiet in terms of news headlines for a change. It was the big headline was the NATO one, really, with the members deciding to increase the individual defense spend from 2% to 5% of GDP, and all those sort of, headlines that you had around that. By the way, Mr. Trump also was commenting on Iran. He said that he doesn't see Iran getting back in the quote-unquote nuclear business, and then he went on to say that if they do try to get back, then we'll be there. You can interpret it in any way you want, but basically they're watching and they're not allowing Iran to go back to their nuclear program. There are talks as well. That's what Trump said. Some of the other aides from Washington are also indicating that talks with Iran could resume next week, but the Iranian side has not confirmed that. So let's see how this plays out. And then, of course, he was going on to deny the recent security reports that came out in the U.S., suggesting that the program has not been entirely dismantled, but only set back by a couple of months. There's apparently a briefing that the U.S. Defense Secretary is going to be doing later this evening to perhaps set the record straight on what was destroyed and what really happened, the obliterated comment that the US president made. Anyway, something interesting from the Fed, because yesterday was day 2 of the Fed testimony that continued, and again the Fed chair continued to indicate that they'll be data dependent. But aside of that, the Fed is now looking at the proposal of easing capital requirements for large banks on Wall Street. This could be really significant and a big departure. Norms were tightened after the global financial crisis, and now there seems to be a growing clamor to ease some of those norms. What I'm talking about is the enhanced supplementary leverage ratio. It was taken higher after the GFC, and now they're saying there are enough capital buffers with large Wall Street banks. Perhaps it's a good time to reduce the sense of that leverage or that particular norm. So let's watch for this. Asian markets this morning, they're mixed, largely range bound, but the Japanese market actually is doing very well. It's up and about almost 1% higher on the Japanese Nikkei. The mainland China market, the Hong Kong markets, they're subdued. You can see on the screens there, Hang Seng is down about 0.7%. For us, we had a final break out of the trading range yesterday. The bulls prevailed. 25,200 has been taken out. So let's look at the distance from the highs. The Nifty is just about 4% away from the all-time high. The Bank Nifty is, barely 0.5% away from, clinching that level again. The mid-cap index about 3.4%. Small-cap index is a little further off, 5% away from the all-time high. So both U.S. equities and Indian markets flirting once again with 52-week highs. The fund flow situation continues to be really patchy and mixed. Again, we had selling from FIIs, but you have to remember that all the fundraising and the block action data could be skewed. FIIs sold off stocks worth about 2,400 crores yesterday. In the cash market, domestic institutions were buyers, so it was nicely offset, almost an equal amount of buying and selling. So net result was not very impactful in terms of flows for the market. Just to talk about some stocks, since we're talking about fundraising, I'll keep an eye out on more names. AU Small Finance Bank, the board is going to be meeting on the 28th to decide their fundraising plans. That could include equity. And Canfin Homes is also looking at a mix of equity and debt raise. And on the equity side, it could be 1,000 crores of a QIP as well. So we'll be watching for some of these names. Nigel.
Well, I'll tell you what, today's expiry day and the bulls will want to drive home the advantage. So we have been in this 800-point range on the Nifty. The good news is we're getting into expiry day at the high point, and the bulls will want to end this series with a bit of a flourish. Let's see how that goes. First up, in terms of the rollover picture, both on the Nifty and the Nifty Bank, more or less in line with what we've seen in terms of averages. So that's in line. Moving to what happened with regard to the FIs on the index futures, they covered some mild shorts in yesterday's trading session. They remain net short with close to 77% of their positions on the short side. The interesting aspect is, if you look at the index options data, both the FIs and the clients, there was some sense of writing of puts in yesterday's trading session. And that's heartening, right? On both those two, FIs as well as clients. But for the markets on the whole, the call writers, they still believe they're in the game. So the bears believe they can defend the higher levels. Even in yesterday's trading session, if you're looking at strikes at around 25,200 call, well, that was fairly active. 25,250 call, 25,300 call. All of them were fairly active in yesterday's trading session with a good amount of open interest build-up. So at higher levels, the bears believe they can defend it. So just plugging in the numbers, if you plug in the options data with the premium and you look at the recent high, the reference point or the resistance mark you're looking at on the upside is 25,320. That's a recent high, right? A couple of sessions ago, we went out there. So that's the important marker. And also you're looking at around 25,250 on the upside. Support zones, 25,050, 25,100. That's the important mark you're looking at. Yesterday, the Nifty Bank actually was off color. But in today's trading session, you'll want to keep an eye out on that. And as long as it's holding above the first reference point at around 20 DMA, you'll see that this one, in fact, is pretty much good for more. So we'll have to keep an eye out on this large constituent of the index. The banking names, yesterday a little under the weather. Today, they'll have to perform. And the IT index, I'm going to keep an eye out on that because the IT index got hammered. Remember when the NASDAQ was getting hit, we had the IT index as well that got hit. Now the NASDAQ is on the verge of making a fresh all-time high. But the IT index, the Nifty IT index, well, it's still a distance away. It's actually 15% away from its recent 52-week high. So I want to see whether or not the IT index as well has further legs in it. In the last couple of sessions, that has come back in terms of strength. Stock that I'm looking at is BEL. It's corrected. As you all mentioned, NATO looking to spend more on defense. This one could be a potential beneficiary if India needs to be a bigger constituent in terms of exports. And also, it's ended closer to around the 20 DMA. 20 DMA is around 395 rupees. If that level holds out, maybe, in fact, frontline name, valuation's pretty okay, and there is an export opportunity as well. I'll keep an eye out on BEL with that 395 as the first reference point. Back to you guys.
Okay, all right, got it. Thanks for that, Nigel. So let's quickly get started with the equity call of the morning. Lawrence Belanco of CLSA says the Nifty looks all set to resume the original breakout from the February-April double bottom pattern. He says a close above 25,116 to 25,222 would confirm the resumption of the original base breakout that supports an upside target of 26,333, essentially a retest of the 2024 highs. At the stock level, he says they feature Indus Towers, Shriram Finance and Cholamandalam Investments as buy candidates. So basically, the Nifty has closed above those critical targets or levels that Lawrence was talking about. CLSA sounding upbeat on the technicals.
Absolutely, and we'll speak with him later over the coming days as well. Satyam Pandey is Chief US and Canada Economist at S&P Global Ratings. He's with us. Satyam, good to have you with us here. Thank you for your time. I think we can stop talking about, not stop, but talk less about geopolitics and maybe start talking about trade and its impact on the economy. What are you modeling in, Satyam, as that we get to that deadline almost just over a week away? Universal tariffs, I don't know if letters will be sent or how it'll be done. Or do you think, since this was a self-imposed deadline, that 9th of July deadline, if the Trump administration feels that maybe we are getting close, but we need more time, they just extend it. I mean, so it's not sacrosanct in that sense.
It could be, yes. It could very well be. You have the July 9th deadline coming in, but there are some trade negotiations that are on way right now. If they're not done, if there's been sort of an honest, faithfully done negotiation that they think is going to lead to some form of a solid deal, they may very well just decide to roll it over with that particular trade partner, right? But in general, it seems like at least by July 9th, you should expect a minimum tariff rate of 10% across the board, sort of a global tariff rate. And then with various trade partners, you would have individualized tariff rates. And specifically, think about the strategic products like semiconductors and pharmaceuticals, some critical minerals. Those are going to have higher ratios, like the steel and aluminum, and the cars, like 25 maybe perhaps. But altogether, we are of the view that perhaps it's going to converge into a 15% effective tariff rate that the U.S. imports are going to be facing altogether. Of course, it's going to be varying for different countries. Like China is probably going to be seeing higher than that, maybe around 40%, while Canada and Mexico lower than the 10%. But overall, 15% sounds reasonable right now at the moment, of course.
So, the question is whether he'll kick the can down the road, as they say, right? Whether July 9 holds or not. But, Satyam, I think, and that's exactly why markets are rallying. Markets are unperturbed because as of now, growth is fine, corporate numbers look okay, inflation numbers don't look too bad. And therefore, the US equity market is where it is. What do you forecast for the second half? I mean, do you see a more serious pickup in inflation? And if that's the case, would it be foolhardy to expect any rate cuts from the Fed?
We do have a pickup in inflation in the second half. We do think there's going to be a slow motion, sort of a slowdown in economic growth as well. So you've got the loss of purchasing power in the consumer class, because a lot of these assumption of tariffs and some of the tariffs already in place, it is going to be passed on to the consumer at the end of the day. Right now, you may not be seeing it just because a lot of the inventory accumulation, the stock that the companies had actually front run before the tariffs, that is going to have to be restocked again. And that is when it's going to be very difficult for them to not pass it on to the consumer. So we do think inflation is moving up in the second half to about 3 to 3.5% on a core CPI basis. That means you will have a slowdown in the economy as well. And it's not just the inflation, we've got high interest rate that has been affecting the domestic demand in the housing sector on a lot of other interest sensitive activities, right? So we shouldn't lose sight of the other domestic issues going on. All of those combined together, second half looks like we will see more like a 1.1% GDP growth by the end of the year, compared to what we saw 2.5% last year in the fourth quarter. So that's a material slowdown in growth picture, although not a recession.
All right. Hi, Satyam. Good to see you, Ben. So for the year, then growth estimates would be what? Around 1.6, 1.7% in the United States?
Yeah, on average 1.7, but a weakening profile as we go through the year. And then once you get some of these tax cuts and the incentives that are embedded in what we call the reconciliation budget discussions right now, once they kick in and the Federal Reserve starts to perhaps lower rates, then you will start to see the usual pickup, the cyclical pickup in the economic cycle, which should get you back towards 1.92% by the end of next year.
Okay. All right. So a couple of points then on that front. Do you believe that the U.S. will ultimately move into a recession? Point number one. Point number two is the Fed's, the Fed's role plays a crucial part out here, right? For this year, I think you're factoring around 50 basis points cut. And I think for next year, you're factoring in a bigger one. Could you run us through what are you moving with regard to the Fed action?
In the first point, in terms of the probability of a recession within the next 12 months, let's say, we have currently pegged 30 to 35% probability. Now, that compares to sort of 13 to 15% in a normal time. You always are running some probability of a recession, right? That's somewhere around 13 to 15% in the US. But this time, given all the uncertainties, either it be geopolitics or uncertainty in business investments due to policies, we do have it a little bit elevated to about 30 to 35%. Now, so it's not a recession in our base case, but we do have a weakening profile. That means you are going to see unemployment rate drifting up. And that means the Fed does have to make a decision. It's a tough one because we are saying inflation is also moving up. At the same time, the economy is weakening. So the Fed has to make a decision. And I think they are probably going to lean towards cutting rates by the fourth quarter of this year, 50 basis points. They will look through this inflation uptick as a one-time inflation uptick. And they would rather give an insurance cut looking at the labor market. And then you will start to see another 75 basis points rate cut next year. So most likely getting us back around 3 to 3.25% by the third quarter of next year.
Okay, all right. We'll leave it there. Thank you very much for joining us. Good conversation and good perspective with those numbers as well coming through. Well, let's just quickly run you through what's coming up here over the next 2 hours or so. So we've got lots of stuff lined up. 8:35, you'll hear from the management of Senco Gold. And we'll talk about the demand trends and how they're shaping up. 9 o'clock, we'll have Krishnan ASV of HDFC Securities to talk about key trends in the banking sector. 9:20, Vikash Kumar Jain of CLSA is the market master of the day. 9:30, Team Lees and Pawan Goyal of Naukri.com will be with us to talk about the impact of AI on jobs and hiring and if it's sort of taking a bite out of it. We have the management of Keystone Realtors talking to us at 9:40 on what's happening in the Mumbai real estate market. 9:50, you'll hear from Pulkit Patni of Goldman Sachs, and we talk about key trends in the consumer durables space. And towards the end of the program, you'll hear from Vijay Sales, and Retailers Association of India on how the consumer sector, consumer durables, and others are holding up. Okay, we'll take a quick commercial break here. We're going to come back in just a bit from now, and we'll get you stocks to watch out for with our research team.
Welcome back. So we've got a mixed picture across Asia, but it's more green than red. So that's the bottom line. A lot of the markets like Japan are doing quite okay. Singapore's flashing some green as well. So not too bad. The Hong Kong market in mainland China is flat. Hong Kong's down about well, 0.4%, so not too bad actually. That's the implied open. It's suggesting that the bulls will continue their forward march, keep taking small steps on the way up perhaps. Let's see. We've got, of course, a couple of stocks that we need to watch out for, stocks and news. Plus, as usual, there's a lot of deal action. So let's start with that actually first. Nimesh is joining in. Nimesh, what's bubbling today?
Hi, sir. So before the trading window closes towards the end of this month, you're going to see a lot of blocks in the next couple of days. But in today's market, two important blocks to track. First is PB Fintech. The promoters are selling close to 1.1% equity. The deal size is $106 million. And the floor price is at 1,800, which suggests that the deal might happen in the block window. If that is the case, you might see a bit of short covering as well in PB Fintech. The other big name is MobiKwik. There is a large block. 8% equity is likely to get changed hands. The price indication is up to 8.5% discount. So to start with, you might see a bit of red on MobiKwik. But for PB Fintech, on back of short covering, the stock may recover if the deal happens in the block window.
Got it, Nimesh. Thanks a lot for that. Well, let's hop across to Upasana. She's here to tell us about some stocks that are in the news. Morning, Upasana.
Good morning. First up, let me start with AU Small Finance Bank. The board has approved its annual fundraising plan and the board meet is scheduled on 28th of June 2025. Now, Canfin Homes also on our radar. The company has received board approval to raise up to 10,000 crore via debt instruments and 1,000 via QIP route. JSW Energy is also the next one. The company has signed a power purchase agreement with NHPC for 300 megawatt solar wind hybrid capacity, and this agreement is signed mainly for the supply of power for a period of 25 years with a tariff of nearly about 3.49 rupees per kilowatt. Now, company has also filed a petition in Andhra Pradesh High Court against the denial of payment of 506 crore is what the company has indicated. Next one is Lloyd Metals. The company has received environment clearance for expansion of its iron ore mining capacity to 55 MTPA, and in the initial years, the company will mine nearly about 26 MTPA of direct sales ore. And lastly, Texmaco Rail also on our radar as the company bags order worth 535 crores from Camalco, and this is mainly for 560 wagons and also a 20-year maintenance contract. There is also provision for additional order is what the company has indicated. So all in all these stocks will be on our radar today.
Okay, well, thanks very much for that. We'll shift our focus to the commodities market. Manisha is here. Manisha, good morning. I guess oil takes a bit of a break.
It does, Prashant, yes, and there's a bit of a consolidation, even a breather that you can see across commodities. The crude oil prices gained up by 1% overnight after declining 13% in the previous two sessions. Well, the truce between Iran and Israel seems to be holding, and the IEA data, which tells you that the U.S. crude inventories, even the gasoline inventories, declined for a fifth straight week, tells you that the demand seems to be picking up, and that is supportive for the crude oil prices. Overnight has been a good market, actually. Not just crude oil prices, but copper gained 0.5%, gold and silver gained between 0.5% to 1% as well. Platinum gained up by 3%, palladium is up 2.5%, and many of these other commodities, rubber, for example, sugar is seeing some support. So we've seen some buying happen in the overnight markets.
Okay, all right, got it, Manisha. Thank you very much for that quick roundup. We will take a short break on that note. Come back on the other side. Deepan Mehta is going to be with us for some fundamental stock talk.
Okay, welcome back. Was 30 minutes to go for the pre-open session. Now, as the NATO alliance, that's the grouping of 30 European countries, is agreed to increase defense spending from the current just under 2% of GDP to 5% of GDP by 2035. There is a lot of interest around whether Indian defense companies can supply to European countries. I spoke with Benjamin Heelan of Bank of America Securities on exactly this. So just listen to Benjamin Heelan. Essentially, his point is, there are strong mandates in European countries that they got to buy European, which means that if you're selling to European countries, at least the advanced platforms, etc., they better be made in Europe. Listen. And if you want to get there quickly, you're going to not sort of make all of it at home. You're going to be buying it from elsewhere as well. US defense contractors, we spoke about some of this last time. Companies out of Korea, for example, I've seen one or two reports how they want to make in Europe. I mean, they're setting up manufacturing within some of these countries, Korea Aerospace, Hanwha, etc. I mean, just take us through your latest thoughts on how your thinking has evolved on this.
Yeah, look, I think that there is a very, very strong buy EU mandate from the European governments, right? The European governments want to make sure that we are investing in and building up the European defense industrial base. And obviously there is a multiplier effect because you're putting capex and employing people in the region. And so, yes, I think what we've seen over the last couple of months, we've seen a lot of JVs announced between US companies and European companies. So there was a Lockheed Rheinmetall joint venture. There was an Anduril Rheinmetall joint venture. And obviously there are a lot of companies looking at putting capex and actually building businesses in collaboration with certain countries in areas like Poland. So you mentioned a couple of them there. So I think that how are you going to be able to gain access to the EU defense industrial base and the defense market here? You need to put money and investment in the region. And I think if you do that, you can be seen as a local player because you're producing stuff locally. And that's what will give you access to the European defense market over the medium term. And I think that theme is going to be very real for India. It's going to be very real for Japan. It's going to be very real for Australia, countries that are looking at building their own defense industrial bases as well. This idea of sovereignty around the defense industrial base, I think is just going to be an extremely core principle of what governments are looking to achieve over the next decade.
All right, let's get to addressing stocks then. Deepan Mehta from Alexa Equities joins us on the show. Hi, Deepan. Good morning. Good to see you, Ben. What are you making of the defense pack? Last couple of trading sessions, it's been good on the geopolitical front, and the world is going to be a better place because of the ceasefire that was announced. But the defense companies that were running up earlier, they have cooled off a little bit just in the last two sessions. Now NATO is talking about upping the spends out there. So that could be an export opportunity. And for India, from around 25,000 crores of exports, the target is that we go to around 50,000 crores. What's your view on the defense names and a couple of stocks that you still like at these valuations? Okay, all right. I think we'll have to wait for Deepan to join in yet again. But I think let's take a quick check on what the GIFT Nifty is suggesting. Remember, yesterday we managed to go ahead and cross that 25,200 odd mark. Globally, things were quiet, though you have the US markets that are on the verge of recovering all the losses that we saw. Case in point being in the month of April, the S&P 500 was 20% away from its all-time highs. Now, in a matter of 3 months, it's within 1% of hitting an all-time high yet again. So that's the kind of recovery that we have seen. That said, let's get in. We'll wait by for Deepan. Let's focus on gold. Prices are off their record highs. To discuss this and more, and the demand trends as well, we're joined by Mr. Suvankar Sen, the MD and CEO at Senco Gold and Diamonds. Hi, Suvankar. Good morning. Good to see you in. Thanks a lot for joining in. Well, gold prices have cooled off a little bit, which may not be such a bad thing, right? Because maybe your clients were finding a little bit unaffordable. Tell us, how are the demand trends, and cooling off of gold may not be such a bad, aspect for you?
So if we look at the quarter and look at the numbers for the particular quarter one of this financial year, the numbers are looking positive. There is about 20% growth in terms of value that we are seeing as we are ending the quarter. However, it's been the April month which has been a much more stronger month where we have seen a much higher growth compared to the last year's April. May was somewhat average, but the gold prices started moving up more, post, I would say, mid of April. And if we look at the month of June, I think that it's been a little bit of a, under stress in terms of footfalls and in terms of the consumer traction, because there haven't been that many weddings this summer. But all in all, in terms of value, if we look at it, yes, we are seeing a robust growth. And the most positive thing that has happened in this particular quarter has been that the probability and the chances of diamond jewelry that have got sold, the consumer interest towards diamonds have been much higher compared to what we had seen in the last year's Q1 or Q2. And the growth that we see in diamonds is much higher than the normal 20% growth that we're talking about, which will hopefully have a much better impact and and the results in terms of profitability for the company could be on a much better side because of the higher sales and the ratios and the stud ratios of diamonds. So yes, it's been a mixed quarter. The footfalls in the last month has been a little under stress because of the high gold price. And now that the gold prices have come down a little bit from the all-time highs, I think consumers are just waiting and watching. The moment they see that, yes, the gold prices have found a stability and it looks as if, things will not be so much volatile, I think that they will be, kind of getting back into the picture and start buying in a strong way again.
So cooling off of gold may not be such a bad thing. Cut that, Subankar. A quick couple of questions. I think most of your gold is hedged, right? 80-85%?
Yes, we usually hedge 80-85%, but this particular quarter, just to inform you, that our hedging has been in the range of 55 to 60% because the gold has been on an upward trend and the geopolitical tensions were very much on the higher side. So, to protect the liquidity, the margins, our hedging has been closer to 60% particular this quarter.
Okay, all right, got that. Subankar, so give us a sense of, your estimates for the year. When we spoke after the fourth quarter, you said about maybe high teens growth for this year would be possible, maybe 18-19%. Given that now gold prices are cooling off, and if they continue to be on this trajectory, would you be confident of doing even better than that? I mean, what is the overall sales estimate you're working with? Same-store sales growth you're working with?
So the Q1 numbers, are looking positive. The value growth, as we said, that is 20% plus. So therefore, I think that, yes, as we go through the Q1, it looks as if the 20% number for the whole year is possible. But we need to be very, very, cautious in terms of looking at Q2 also. Any kind of incidents or any kind of volatility in gold price, whether that gets impacted or not. But till now, it looks like value-wise, Q1 growth of 20% and the annual growth of 20% looks very much possible.
Okay, so 20% growth does look very possible. What is your mix in terms of studded and non-studded right now? And what's happening on the studded jewelry side of the business? Because that's also where there's a lot of change going on with diamond prices. I mean, earlier they were correcting natural diamond prices and lab grown was growing. So just give us a sense of the studded business as well.
So the studded business, what the good thing that we've seen this particular quarter is that our traction towards diamond jewelry has been on the higher side. So for last year, our overall stud ratio was about 10.9%. But if you look at this particular quarter, our stud ratio is above 11%. So that gives a very, strong and positive thought in the mind and in terms of the results also, since the margins from the diamond jewelry is comparatively higher than in gold jewelry. So this will give a boost to the margins as well. And I think that because of the high gold price, the consumers are also looking at lower caratage option at 14 carat, 18 carat, studded with diamonds. So I see that the growth rate of diamond jewelry has been higher than that of the normal plain gold jewelry. So that's a good sign overall on the margin side.
So, Subankar, just a quick question. Since the proportion of gold that was hedged was lower, that will have a positive effect, right, in the near term?
Yes, since the hedging has been on the lower side, we are expecting that there will be a positive effect for that in the near term. Yes, you're right.
And just to go back to the studded piece, since you're saying that there is more traction, here we're only talking about natural, right? Because you do have a separate vertical, I believe.
See,
for lab grown.
even the while we have about 4 to 5 stores for our lab grown diamond stores, and there also the growth rate, because the base is very small, the growth rate will look positive, but that is nothing substantial that will be impacting much on the overall scheme of things. But the fact that natural diamonds have also grown in a larger manner, so that will give a boost to the natural diamond business and the overall margins as well.
All right. So, Ankur, good speaking with you. Thank you very much. Golden conversation. Appreciate it, as always, here on CNBC. Well, 40 points on the GIFT Nifty is what you have. Deepan Mehta is with us from Elixir Equities. Deepan, good to have you with us here. Good morning. We lost the line earlier. Just a quick word. I think we'll get to gold if you have thoughts in a bit. But that first question on defense, which Nigel was asking you, if you have any thoughts. Markets usually try to price a lot of this in, and this has been well advertised. What's your sense? I'm talking about the defense, the NATO defense bump up, spending bump up. Would you buy anything out of the lot? BEL, of course, I think is on the record saying that, I think their exports are about $100 million, and that'll perhaps go up to about $120, $130 million this year. And that's the sizable one. Anything you like from a defense export opportunity, Deepan?
Good morning, Prashant, and thank you for having me on your show. No, I think that exports are still playing a very small portion of the business for a lot of defense companies, except for maybe DCX, which has got an Israeli connection, and therefore they have a lot of exports over there per se, and there could be one or two other companies as well. But PSU defense companies, which are sitting on massive order book position and which stand to benefit tremendously from higher defense spends within India, I think their export proportion is pretty limited, and sure, it can go up, but these things take a lot of time. But nonetheless, as far as strategy for defense stocks is concerned, I think wait for more peaceful times, and a lot of the attention and the momentum will go away from defense stocks. They can correct 15, 20, 30% also, as we have seen in the past. And that's a good entry point because earnings visibility remains strong, and all these geopolitical events I don't think are going to end pretty much soon. It's part and parcel of life. So whenever there's a flare-up anywhere in the world, defense stocks will come back into focus. So a simple strategy, buy these stocks at correction when entire defense or any kind of conflict is not in focus, and when these stocks are just kind of lying low.
So buy during times of peace. And then sell during times of conflict. But not sell, but buy when there's peace.
Buy when there's peace, and then war is when typically those prices soar, and that's what we've seen in the past.
Surabhi, just one thing. The flashes are at the bottom of the screen, and maybe we played the sound bites out, and I thought it was interesting, and I wanted to put this out for our viewers because there's a lot of excitement around whether we'll be able to, because the numbers are so large, right? They look so tempting.
The European spends as they go up.
So at 3.5% of European GDP, it'll amount to, because GDP is also increasing at very slow rates. But it'll be 850 to 900 billion euros, right? From the current 450 billion euros. So the numbers are massive.
Yeah.
And but as that Bank of America analyst I spoke to pointed out, he said there is a lot of this. We got to buy European. We don't want to buy anything because at times of war, like for example, what we are doing, right? We want to buy in-house because how can you rely on other people? So you got to invest in Europe to be able to actually. I'm not talking about. It's not going to be everything. Because we've heard from lots of companies we've spoken to, things like artillery, etc., that you can make here and supply. But the slightly higher end stuff,
the integrated systems, etc., they'll have to be done in Europe.
You know how much Russia spent on defense last year? Around 150 billion approximately, which is 7% of their GDP. And that was up by 38% in the last year. So it's clearly showing the kind of focus on defense spends globally as well.
Yeah, but 150. But this is, 6 times, 7 times. If they get to the European. But Russia is the big bear in terms of what's leading to all this higher spending.
Called him, sorry, just to complete, since we're going on a tangent, yesterday's comment was Putin is misguided. He's just a misguided man, right? That's what he said. Mr. Trump said
He did?
that.
He's
He's just misguided, yeah. He didn't call him out saying he's a bad person or anything. He's misguided. Yeah. That was yesterday's comment.
Yeah, no, absolutely. And, more on this one in a bit. But as we were pointing out, the defense index, of course, down about 2% or so yesterday. Deepan, what else is on your mind in terms of specific stocks? I mean, the mid and small cap part of the market is really, at least yesterday worked itself into a frenzy. A lot of action, a lot of chatter, a lot of news flow. Anything comes to your came to your attention?
Well, Prashant, basically my mind is still now looking forward to 9th of July. The 90-day pause ends, for all these tariffs, Trump tariffs, and what's going to be the outcome at that point of time? Is it there going to be a further, time limit given to get into individual deals with the US? Are tariffs going to come back the way they were? So all of these things are very important from the market perspective, and the sideways movement which we have seen with the broader market indices, I think that may have a decisive move depending on what the outcome is. End of the day, geopolitical events do not have such a massive impact on the underlying fundamentals of the economy or corporate profits, but tariffs certainly will. And that I think is an important indicator to watch out for. At the same time, I think, from a longer term perspective, really hoping for earnings to move up, earnings growth to move up. Last year was not that great in terms of earnings growth. There are a lot of variables which should lead to higher earnings growth, lower interest rates, lower taxation, better monsoon, pickup in consumption. But we need to see the actual numbers in the corporate profits before we can bid stock prices up higher, because this is only so much that PE expansion can take prices higher.
Got it. Okay, all right. Deepan, stay with us for the time being. Just keep an eye out actually at the bottom of your screen. One of those large trades that we're looking out for on PB Fintech, that's got done 50 lakh shares, 920 crore worth of a deal has got executed in the block window. So that's the one that will be in focus when market opens as well. Sometimes these stocks, they wait by for the large share to get out of the way, and then they continue their course of action in terms of a stock price move. So that's the one we'll keep an eye out on. Slip into a short break, come back. Technical trades on the other side. Mitesh and Sudarshan are waiting for you.
Welcome back. We've got Sudarshan Sukhani and Mitesh Thakkar who are with us with what they'd want you to do as far as specific trades go. Gentlemen, good morning. Great to have both of you here. Sudarshan, you go first. How are things looking? Yesterday, of course, day before yesterday, you were saying stay away. We got a bit of a wobble. Yesterday, of course, market looked much steadier. And your call was it's a buying day to buy. What about today? How are things set up?
Good morning. Yesterday was a day to buy, and today I would think that there is a continuation of that buying opportunity. See, yesterday was a narrow range day. The chances are that we should break on the upside. Now, whether that breakout comes today or tomorrow becomes difficult to predict, but I think it's imminent. Most markets are near their lifetime highs, and the chances are we could also do that. So the trade today is if you are long, stay long. If you are not long, then look for any minor dip or consolidation to go long and carry the trades for the next settlement. That is not just today, but for tomorrow and Monday. Keep a stop loss at 24,100. I'm sorry, 25,100.
Okay, all right. Mitesh, what about you? How are you set up?
Morning, Prashant. So, this market has given a couple of breakouts and then retreated. And then again, yesterday, finally, we got a closing about 25,200, which is slightly positive. I would say that 25,080, 25,100 is the key support we got in the short term. And with that as the stop, I think we look for targets of around 25,450, 500 to begin with, and maybe even 25,700. So the setup is positive, and I have all buy calls as well as a positive view on the indices.
Okay, let's get to stocks then. Good morning, gentlemen. Mitesh, go first. What's on your radar?
Morning, Nigel. I have, as I said, I have all buy calls. So a buy on a short tail with a stop at 240 half for targets of 254. Z, which gave a big breakout a couple of days back and then a pullback, is a buy with a stop at 141 for targets of 158. A buy on Birla Soft. Keep a stop below 434 here, look for targets of 465 plus. And Aarti Industries is a buy with a stop at 460 for targets of 490.
Okay, got that. Sudarshan, what about you?
Well, it's also an all buy list. Indian Hotels is a buy with a stop under 765. GNFC is a buying opportunity with a stop under 542. Something's going on in fertilizer stocks. Hudco is a buy, HUDCO, Hudco, with a stop under 234. And another of those PSUs, NBCC is a buy with a stop under 122.
Got it. Okay. All right. Thanks a lot, gentlemen, for that. Another large trade takes place. Delivery now. More than 1.1 crore shares changing hands in the block window, close to 300 and at around 390 rupees per share, 388 rupees per share, which is yesterday's close price as well. Well, we'll slip into a short break. On the other side, we'll be joined by Krishnan ASV of HDFC Securities. He'll be talking about the outlook for PSU banks.
Welcome back. We'll start getting our actual opening rates in about 15 odd minutes. Let's go back to Deepan for some more questions before that. Deepan, want to discuss once again Vodafone idea with you. There's never a dull moment. Now there are reports which are indicating that a consortium of banks is coming together. It could be led by SBI to give a bit of a helping hand. They could be willing to offer a loan. I mean, numbers are all kinds of numbers are doing the rounds. Could be as much as, I think the company wants to raise 25,000. Now, how they convince the banks to lend is another question. And then there was this other report that maybe the government could look at deferring the AGR payments, etc. Any point looking at Vodafone?
No, I don't think that unless there's a comprehensive revival plan where the government chips in, the banks chip in, and there's a proper road way to profitability or even survival, I think till that point of time, serious investors will not enter the stock. You will, of course, have punters buying into a stock. It is low priced. You can buy in bulk, 4 or 5 paise also. If it moves up or moves down, you can make a profit or a loss. So it's a punter's delight. But from serious institutional investors, long-term investors' perspective, unless we don't see strong intent followed up with plans, definitive plans how to turn it around, I don't think investors will buy into the stock. And if any bank or consortium of bank on its own is trying to make a plan, then I think investors may not look at those banks also in positive light, because that at some point of time, NPS could creep up on that account as well. And we have seen how corporate accounts, when they've gone bad, how they have impacted the stock prices of these companies. I think Yes Bank, IndusInd Bank, and some of the other companies and the PSU banks in the earlier era, they were all impacted very heavily by corporate accounts going sour.
Oh, point taken. Absolutely. That's a good word of caution to put out. Need to watch out for how the story progresses. Indeed, if they get banks to lend, which will those banks be? And then who's the guarantor to those loans? Okay, so that's a Vodafone idea. That's a no-go for Deepan. Deepan, very quickly, PB Fintech. Nimesh was just telling us that today there could be a block. Maybe promoters sell a little bit of their equity. And we know that they're setting up their separate healthcare vertical. Maybe some of this money goes there. We don't know. But on the listed business, what's your view?
I think it's a good business, and unnecessarily the management is trying to get into healthcare. And that too, when I saw the plans, I didn't think they were anything different from what some of the other hospital companies are doing. Core business is doing well. This is just causing a lot of distraction from investors' perspective, and which is just not needed at this point of time. But nonetheless, I think stock price should be the stock should be kept in mind, because it's a solid growth company and a good play on insurance sector.
Deepan, any thoughts on Castrol? I mean, again, it's a global deal perhaps in the making. Shell, apparently, there are reports that Shell is looking to buy British Petroleum. British Petroleum owns 51% in Castrol. We don't know if it will happen or not happen, but that's going to be the mother of all oil deals, at least. Any thoughts?
No, Prashant, I think Castrol has just fallen off the grid for many investors and analysts because of very slow growth. And it was a great stock when I grew up back in the 90s. But at this point of time, I think it's off the radar. And a deal like this may take place. It may cause an open offer, some amount of trading volumes. But end of the day, I'm not convinced of the long-term growth story because of competition, because of track record. So it's an avoid for me.
Just a couple more names. As I said, I mean, mid and small cap space, real amount of action. And exchanges were at the center of it. So there was MCX, right? There was that brokerage note, MCX, 10,000 rupee target, UBS. IEX, there was a Bernstein note saying, well, the stock's fallen enough and maybe it's time to buy. And of course, we reported that NSE is the National Stock Exchange is filing for a consent, essentially looking for a consent terms with the regulator. And that'll be kind of the big step ahead. The IPO may be far away, but this is the crucial step. So just wanted your sense on this space, Deepan.
No, we've been positive on MCX, and that's given great returns. But look, valuations are really stretched at this point of time for a business which we know is a monopoly, but has got a lot of earnings volatility because their revenues are dependent on volumes, and volumes are not steady. So at this point of time, the risk return doesn't favor buying any exchange. Better to buy them when there are bearish trends and markets volumes have come off and these companies are reporting poor profits. That's the time to enter a cyclical business like an exchange.
Any sense on these amine businesses, Balaji amine, alkyl amine? I mean, I don't track them very closely, but somebody was saying that maybe things are starting to turn here. Things are starting to look up for these businesses, if you own them or track them.
No, Prashant, I think it's a very good investment theme or a sector to track. Specialty chemicals per se, I think, are after 3-4 years or other 2-3 years of down cycle, a lot of the sectors and products are doing very well. Crude oil prices and basic material prices have stabilized, so that's offering comfort on the margin side. At the same time, this China Plus One strategy is improving the export market. Domestic demand also is improving in terms of pickup in industrial consumption. And it's a great investment theme to track. It's just that it's a complicated sector. And if you buy these stocks as a basket, maybe you are better off. But yes, I think all these amine companies and some of the other specialty, I think numbers which came from SRF, Naveen Flooring were all quite interesting. So I think you can get a few winners over there, but you need to, research them far more stringently because of the complexities of the product and the business.
Okay. All right, got it. Deepan, good conversation. Thank you so much for joining in. We look forward to catching up again soon. We are rounding up at just around 9:04. Quickly, let's look at what the pre-open is telling us. 7 points up on the Nifty. That's very quiet on the Nifty in the pre-open. Not much moving at this point in time. So as more rates trickle in, let's look at a very interesting report that's come in from HDFC Securities. The report is talking about PSU banks and suggesting that PSU banks could be experiencing early signs of a secular turnaround. And HDFC Security feels that selectively there is good risk reward and plenty of opportunities out there that investors could look at. So let's discuss this with Krishnan ASV, who of course looks at the banking space very, very carefully from HDFC Securities. Krishnan, great to have you on. Thank you for joining us this morning. So, just before you joined in, we were discussing this lending consortium that apparently is looking at giving a loan finally to Vodafone Idea. And our previous guest, Deepan, was saying that if anything, that's going to cast a shadow on banks, particularly the PSUs who do the bidding. But that aside, I mean, just take us through the genesis of that thought process. What do you see ahead? I mean, X of this Vodafone issue, is there a real opportunity in PSU banks now?
Yeah, hi. I mean, many thanks for having me on the show. So look, I think as you put it in your opening remarks as well, what we are seeing is early signs of a structural turnaround in quality of customer franchise, quality of loan book, and quality of earnings in the PSU banks. These are still early days. We believe these are not transient. These are fairly structural. There is a secular turnaround here. And as I said, it starts from the fact that the customer franchise has been worked on. In fact, one of our hypotheses is that PSU banks will remain retail heavy in their loan book, and hence the lumpiness that you saw in the 2015 cycle is not something that will play out in PSU banks anymore. Retail is far more kind of granular. Banks have become a lot more sensible, a lot more scientific in how they identify risk, how they manage risk. And so we believe a lot of PSU banks are beginning to catch up. It's already reflecting in some numbers over the last couple of years. Just to put a couple of numbers there, gross slippages and net slippages, PSU banks are actually more superior than private banks, right? As far as corporate is concerned, as I said, a lot of that corporate capex has generally bypassed the banking system. Not just a lot of the corporates are deleveraged. They are essentially able to borrow from the bond markets at cheaper rates. And so it will continue bypassing the banking system.
Okay. So, the thing is that you're saying that the book has been growing more on the retail side and therefore, you're expecting things to continue. But Krishnan, what about the pickup in the corporate cycle? So there's two parts to it. One, of course, the quality of the book, which perhaps is a lot better now after the last cycle. The second is the growth aspect itself. I mean, what kind of growth numbers are you ascribing to the PSU banks? And would that include a turnaround in the corporate credit cycle anytime soon?
So, as I was saying, I mean, what we're pricing in is roughly about a 13-14% kind of CAGR for the PSU banks. That's not going to be very different compared to where the rest of the system is going to be. So, there will be outliers.
Oh, okay. I think we have Krishnan on a bad line, so not able to hear him. But for the benefit of our viewers, just sort of outlining some of the points here. They actually have high conviction buys on BOB, on Indian Bank as well, I think. They like Union Bank. They've initiated coverage on Union Bank. So these are some of the names where they seem to have conviction going forward. Let's see if we have him back. Do we have Krishnan Bank? Not yet. We'll go back to it. Thesis seems to be that PSU banks are offering both growth and valuation comfort, and 12 to 13% is the kind of growth in the book itself that HDFC Securities is pricing. And we'll go back to that discussion once that line is through again. Quick check back on the screen now. Look at what the pre-open Nifty is suggesting. Very quiet session. So we've had a great pop yesterday, a break through the range yesterday. So even if today turns out to be a little sort of a slightly quieter day, perhaps the bulls will take it with both hands. Right now, 24 points up on the Nifty. And the stocks that are pushing higher right now, Nestle, BEL, there's NTPC. But again, these are gains about just 0.5% gains. It's really quiet. Not too much to report. Some of the tech names are lower actually, at least in the pre-open session. So watch out for IT because your Tech Mahindra, HCL Tech, Infosys, these are some of the names on the downside for now. Let's do one thing. I think we have our technical experts with us. So maybe we can go to them and quickly do the 9-10 calls. And then we'll go back to the banking conversation. So Darshan, morning. So what's the stock you'll go with?
Yeah, good morning. GNFC. Buy GNFC with a stop under 542.
Okay. And Mitesh, what about you?
I think a mild pullback in tech would give a good entry point in Birla Software. So buy here for targets of 465.
Okay. All right, gentlemen. Thank you so much for that. We do have that line back with Krishnan. Krishnan, go on. I mean, we lost you there. You were just completing the point, explaining how the growth is going to be 12-13%, which is in line with overall system. Just complete the point. So then, is it the valuation comfort that's drawing you towards PSUs? And give us some top ideas as well.
Sure. So, as I said, growth for the large banks is likely to stay within the 13 to 15% band. There's a Bank of Maharashtra, which we believe because of the base effect will probably do better. But generally, these PSU banks are in a very sweet spot. The kind of runway seems fairly clear in terms of where they are headed in terms of the loan book and the quality of the book. Purely in terms of our pecking order, we have State Bank of India right at the top. We like Bank of Maharashtra, Bank of Baroda, and Indian Bank.
Krishnan, just that one quick point, it's a bit of a tangent, but I must ask you, if indeed there is this move to lend towards Vodafone Idea, and I'm not talking about the actual exposures, it's going to be a consortium. I don't know how much they'll do, 20,000, 10,000 crores. We don't know. It's a story that's out there right now. Will the market view this very negatively? Will that at all change your view, given the moral sort of implications around it?
Yeah, I think I kind of agree with the earlier expert. It may not be looked upon very positively by the market, right? I mean, it still depends on whether this is rescue capital, whether this is growth capital. Given where the franchise is, I would assume this is likely to be rescue capital again. Rescue capital is not something that the market looks upon very positively. I mean, these are still in the media bites, so we really don't know how this is going to pan out. But as I said, generally, we believe that the entire banking system has actually been able to ring fence itself from corporate credit. Corporate credit cycle, the large corporate credit cycle, especially the CAPEX part, generally tends to bypass the banking system nowadays. We believe that will continue. That will continue to pan out as well.
Okay. Krishnan, just one quick question before we let you go. SBI could possibly be looking at a fundraise. If you could tell us whether you're factoring that in, what are the current ratios and how would that change things?
So right now, I think they looked at about sub 11% kind of a CET1. Look, they just did the Yes Bank stake sale. They are looking at a couple of other alternatives, plus the QIP of about 25,000 crores. So roughly about 40,000 crores that gets added to their kitty if everything goes well. They are bracing themselves. I mean, of course, there are going to be mid-sized MSME corporates that are likely to come through as well. We are in a stage of the rate cycle which will kind of stimulate growth. So I think they are poised for growth. They are poised for growth capital, and this will probably improve their capital ratios by roughly about 200 basis points at the very beginning.
Okay. All right. Got it. Thanks very much for that, Krishnan. Good conversation. By the way, I just want to point out Dr. Reddy's. In the pre-open, Reddy's is down very distinctly. The rest of the market is a little quiet. Last I checked, Reddy's was down 1.5%. Yeah. There's a Citi call on Dr. Reddy's. Citi's put a sell target on Reddy's, and they basically are saying that this whole semaglutide opportunity has been overestimated. So we'll watch out for this, and we'll go back to this report as well. But speaking of reports, Nimesh is here with the standout brokerage report of the morning. Nimesh, which one is it?
Hi, morning, sir. Today's standout is on Voltas, an interesting upgrade from Avendus Spark to a buy from Reduce, and they have a target price of 15.16. They've actually upgraded the stock after 3 long years on back of a couple of reasons. The first reason is the RSA demand is likely to see a growth driven by low penetration as well as higher discretionary spend, especially in the second half of this year. Second, the UPC margins are likely to improve on the back of backward integration as well as higher utilization of new facilities as well as price increase. The third one, which is the JV, the Voltas Beko JV, which has been a pain point, that is likely to see an improvement and expected a break-even in FY27. And lastly, the order inflow momentum in the project and MEP segment has bottomed out. So on back of all this, a double upgrade on Voltas by Avendus Spark to a buy now, and they have a target price of 15.16 on Voltas.
All right, Nimesh, thank you very much for that. So keep an eye out on this one as we open up for trade. But there is, the pre-open session, of course, the Nifty will come up on your screen, gives you a quick sense of where we're likely to start. And then we'll pick it up from there. First rates, 24 points in the Nifty. The Sensex up about 130 points. And, just about starting, looking at indices first, as always. So I think we're starting to trade 25, 260 on the Nifty. It's up, but up small, 82,840, 850 on the Sensex. That's about 130 points higher. And the mid-cap index is at up about 80 points at 0.16. The small cap index will come up on your screens as well. And there as well, I think we've got some gains. Remember, the small cap index was up in a very distinct way, even as compared to the mid cap index, ended about 1.5% higher, the small cap space. So that's the opening kind of rates coming up. 25, just under 25, 300 is where we are at. The Nifty heat map is on your screen. Bulk of everything which is starting out is up in the green. You just have about 6 or 7 names which are starting in the red at this point in time. Let's get to stock, Surbhi.
Not much to speak of. It's so quiet out there. 30 points up on the Nifty. So let's look at the gainers. You have only 3 stocks which are at least putting on a 1% gain. And they are BEL, Nestle, the top 3 over there. Eternal up about 1% as well. Some of the global-facing stocks, metals, for instance, they're doing well this morning. JSW Steel, Hindalco, Tata Steel. So all the metal stocks are shining. Bharti Airtel is putting on about a 0.5% gain. Ditto for L&T. Bajaj Finance, again, 0.5% higher. And then it starts fizzling out from there. BEL is doing well, but 1.2% on BEL. On the flip side, Reddy's, like I was mentioning, that negative note from Citi, down about 1% on that stock. ICICI Bank, Kotak Mahindra Bank, Axis Bank. Banks are basically lackluster this morning. Bank Nifty is very, very flat, at least early on. Just want to point out from the broader markets, Texmaco Rail, that's the one stock that stood out. They've managed to bag an order worth over 500 crores, if I remember correctly. So that one is, Tex Rail now up 7.5%. So that one's sparkling, but otherwise it's a quiet start to trade, Nigel.
Well, that's right. Another one that won an order actually is Western Carriers. They have bagged a 550 crore logistics contract from Jindal Stainless. So it's giving Texmaco company on the upside. So big up move is what we're seeing on that particular name. Lloyds Metals, they've got the environment clearance for expansion of mining capacity to 55 million tons. This will help them because last year they did around 10 million tons. Q4 was a washout because they had already exhausted their capacity, but they had guided by the first quarter they will get that green signal, and the EC clearance has come about. So they'll be on track to do around 24 to around 23 million tons for this year. Keep an eye out on Coforge at the bottom of your screen. 10 lakh shares getting traded out there. 1.5% equity, I think, changing hands. So that one is up for you on the screen as well. SMS Pharma, let's pull up the chart out there because the US FDA has issued 0 observations for the Hyderabad-based central laboratory. That's the other one, actually, that's flying away. Keep an eye out on Tejas as well. We had Aditya Sood that was talking about that name yesterday. He said that, the orders ultimately will come about. For the time being, there is an opportunity that's emerging in the international markets. Tejas and Rakuten Symphony, they have inked a 5G open RAN development deal. So that's why that stock, in fact, is up and about in today's trading session. One of the top gainers, actually. And KNR Constructions, towards the end of trade, they won a big order. Yesterday, it was up close to 10%. Today, it's seen some follow-through buying as well. And Belrise, the other newly listed company, up 2%. All of these moving on very, very large volumes. Prashant.
I know lots of action, lots of activity is what we have at this point in time. Well, we'll come back with more names. It's all about mid and small caps and the amount of action that we're seeing there. So really vibrant in terms of price action, vibrant in terms of the conversations, chatter, and everything which is going on. So good-looking screen, all told. Vikash Kumar Jain is joining us now. Vikash Kumar Jain is India strategist and head of India research at CLSA. Vikash, great to have you with us here. Thank you very much for your time. Appreciate it. So, since you're on the program after a while, Vikash, as always, let's just get you a quick kind of sort of context in terms of where you are in terms of your thinking. Because that evolves as the market has traded on and it's done quite well despite all these geopolitical tensions, etc. The next one, I guess, we are going to focus back on trade with this tariff deadline. U.S. markets are less than 1% away from their highs. We're not very far away here either in India. What is your sense, Vikash?
Sure. Hi, Prashant. Thanks for having me. So, I think where we are today is the point where the first half has been very action-packed, very volatile, where market went from fear to ignoring the fears and all of that. I think now is the time when possibly things start settling down. From an India perspective, we had the good news of strong rate cuts, large rate cuts by RBI, and that has fueled some kind of an expectation. And there was also the period where there was worry around global trade, and that's something that worry as a corollary played well for India as a hiding place. Going into the next part of this year, the second half, there are a few things that we need to look through. Firstly, the tailwind that we had in terms of a surprise announcements and the extent of rate cuts kind of start going a pause, at least, for a period. Because if you see now we're in a monsoon, the RBI has already said that it's put down its inflation forecast. And unless inflation is significantly lower than that, it would not really do anything incremental at this point of time. Plus, at the same point of time, the CRR cut will come into effect with in due course. So the next RBI action is unlikely before the end of the year or so. So from a more domestic perspective, other than we signing a trade deal with the US and EU, which is, at least the US bit is now, has been talked about for such a long time that perhaps it should be in the price. Our domestic linked triggers would be rather limited. So I think from that perspective, whatever is happening globally is what will drive price action or on a bottom-up basis. And the problem that we've had on a bottom-up discussion has been earnings cut. In fact, we've come out of the report just today talking about earnings, where the problem has been that the kind of earning cut we've seen, for example, small caps as a universe has seen about 11% cut in earnings YTD. But the problem is where expectations are today. Of the NSE 500 stocks where there is enough coverage, more than half of the stocks expect earnings growth to be over 20% CAGR over the next 2 years. More than half, at a time when nominal GDP growth may struggle to be even 10%. So that, to me, is possibly quite optimistic expectations. So from a bottom-up perspective, my worry is that earnings cut might very well continue. So what we are seeing is not really any big, strong news flow to drive a massive rally in the market. So we might be in a range-bound market like we've been for the last 12 months or so. The market hasn't really moved up much on a 12-month basis. The other problem is around flows. Now, July, August, September last year was a pretty good period, the period after election results. And now in this quarter, when investors look at their performance sheets on a 12-month basis, they might start seeing negative numbers, even large cap investors. And that is where I think domestic flows, which have been coming off, could see some kind of an impact, because other asset classes that we as Indians like have started doing very well, like gold and silver and some of those. In fact, even duration bonds did very well, YTD. So equity, in fact, has been the worst performing large asset class, both for domestic investors as well as foreign investors, because India has also underperformed EM and world markets. But the problem has been that despite this underperformance, we are still expensive because of earnings cut. So, it's really a mishmash of these things, which means that we are likely to be at best in a range-bound market. And perhaps then we gradually derate to more palatable valuations.
So, a voice of caution, I dare say, I mean, maybe not bearish, but just realistic and cautious. We don't have too much of that in the market these days, Vikash. And, we picked that out from your note as well. You're citing, twin-pronged issues here. One is that earnings estimates are still elevated. And the second is what happens if the flows stop being as generous as they have been. And we've seen that. I ask that question to mutual fund CEOs all the time, that flows have become half of what they used to be. Let's just, play the devil's advocate. Let me do that on the other side. The other side of this debate, the narrative is that look at how generous the RBI has been. Then you have the income tax cuts and they'll start, making their way into people's hands. And then you get into the festive season where anyway India spends more and the monsoon has been bountiful. So all things put together, the macros should add up. The gods should come and smile on us in the second half and then things should pick up. That's the narrative of the bull camp. How do you counter it?
So, I'll say that we can see both camps in action in the market today. I think the part of the sell side earnings estimators are actually in that camp, whereas the ones who are talking about GDP growth, etc., are not in that camp. So I think one of those camps need to come right. If it is those estimates, which is half the companies delivering 20% EPS CAGR in the large NSE 500 universe, then perhaps that's the camp that you are talking about. Then, maybe today's estimates will be met. But the problem is that even on those estimates, we are also at very high valuation multiples. So with those estimates being met, maybe we will get reasonable returns on the market. My worry is that what if those estimates are cut, plus we have a valuation worry? I think that might create a, reasonably underperforming kind of a market. So I would say that some of those, what you're saying is pretty much what is in earnings estimates today, but it may not be in the top-down GDP discussions yet. So, yeah, I think it's partly in the price.
Hi, Vikas. Taking the caution on board, maybe the earnings may not be as good as estimated, and maybe, bulk of the RBI bazooka is already in the price. That said, one clear tailwind for the economy as well as for markets is the way crude oil prices has corrected. What are you all working with in terms of crude oil prices? And how do you approach the beneficiaries, OMCs, paint companies, aviation companies? How do you approach them? Because for the OMCs, this is a big tailwind. We don't have state elections for the next few months. And valuation-wise as well, things looking pretty okay. Your take?
So Trump's called this a 12-day war. I think crude prices have just gone back to where before the war started. So we're back to where we were at the start of this month. So it shouldn't be, that's what has exactly happened. We had a spike and we're back. And in fact, if you look at equity market action, honestly, it's also, kind of back to where it was. So I would say that that whole crude price thing is what has helped some of these companies from the start of the year to the correction that we saw till early July. Yes, there was a little bit of a crude price scare that we got, but that's now done and dusted. And I would say that since wearing my oil analyst hat, yes, OPEC has been trying to, OPEC says inventory to be pretty low, and that's why they're releasing crude price, more crude in the market. But the actual production has not kept track with their announced crude release. So unless they actually increase production like they have talked about in their plans, I think crude prices would be possibly in this range of $60 to $80 that we are in, and we are closer to that range of about 65, 67 today. So I would say that yes, this kind of a benign crude price is something which helps India, and also that is the reason why inflation should be low. So I'm not really talking of any shocks for India. And I think this is something which should allow inflation to be very low. And so some of those beneficiaries should continue to see benefits, which not only the direct oil beneficiaries, but inflation being low means rates being benign. Even interest rate sensitives could kind of on a slightly longer period keep on seeing those benefits.
All right, Vikas, I think the call that you'd made earlier this year was the FMCG staples. That would be the anti-consensus call. Holding on to that?
Yes, at this point of time, we've also added to one call just about 6-8 weeks back where we have gone overweight on IT. The logic for that is incrementally, like I discussed in my starting talk, was the triggers are likely to be more based out of foreign markets. That global trade is now settling down. Perhaps the US market is not looking that bad. And all of that will give confidence for IT companies in terms of the commentary that they give. And that commentary was the one big problem when they last reported results in April. I think with that commentary becoming a little bit more confident and their stocks have come off, valuations are not that extended like they were a few months ago. I think this becomes an interesting space in terms of amongst defensives. So what I'm trying to say is that, see, this is going to be a range-bound market, but incrementally, narratives are going to get more positive on the IT side. And that's where also one should start looking at it. See, there is a preference for defensive because I'm trying to more protect capital in a range-bound market, and that's where I'm overweight all the defensives effectively, IT, utilities, as well as FMCG or staples.
Yeah, because two questions. One, but IT as a sector has done quite well, right? Off the lows, in some cases, really well. So, I mean, it's going to now run into a better sort of new setup, as you're calling it. But will that mean stocks do well, or it's already in the price? That's one. And then you also like materials as a space, right? You think they'll earnings, etc., should be much stronger relative to their weight in the indices. So just talk to us about that as well.
Sure. So, we firstly on IT, see, I think there is a little bit of a dilemma that we are in because although some of these parameters that we discussed are not really looking, bullish, but our sentiment gauge suggests that sentiment is also neutral. It went to extreme bullish, extreme bearish early April, but it's kind of had a rally and now it's neutral. So all of that also means that there is no immediacy for the market to correct in any big way. So what might happen is market keeps chugging along, but that chugging along will be driven by international factors and international news flow. And that's where I think, IT will, where sentiment turned quite negative, would start seeing more positive action, possibly as we hear them in the upcoming result season. Materials, the other one that you brought out, we were actually quite overweight materials at the start of the year, but then we've taken some profit off. But what I see incrementally, and this is our note on earnings today, where materials is expected to be one sector to be a big contributor of earnings growth because both metals, cement, and some of the other places in materials are possibly going to come off on see EBITDA, unit EBITDA expansion, and also because there was some of it was depressed at the starting base, and that should possibly help. Maybe we will look at a better entry point to come back into that space, but clearly that is one space where incremental earnings growth, it looks like they will be punching above their weight in the benchmark.
Vikash, I just want to go back to that other risk factor of lower flows. So we discussed that on the DII side. I don't know what you're hearing from foreign clients because FI flows are absolutely patchy, right? Maybe they're also looking at the same concerns like you. I mean, that when earnings come back in a roaring way, maybe the money will come in as well. As of now, that's not happening. But then there's a huge supply side issue as well, right? These blocks happening on a daily basis. IPOs are also happening. Is that another risk? Are we anywhere close to an oversupply zone risk for the market?
Absolutely. So, I mean, let's talk about flows and let's talk about flows for the listed space because these are two different things. Because there is a big leakage in the middle And that is really the supply side factors that you're talking about. Firstly, like we discussed, the domestic flows. Now, if you look at foreign flows, now I have a firm belief, although we've seen this period of continuous inflows from domestic investors, my firm belief is investors everywhere are the same. They would want to invest in assets classes which will give them return, and that confidence on returns comes from performance. So performance gives confidence, and confidence is what drives flows. Now, if we look at performance for the last 12 months being patchy, that confidence is coming off, whereas confidence in precious metals and, even I would say certain urban clusters, the real estate prices, or even foreign markets, all of that is improving. So an expensive market like India, a foreign investor, when, looking at earnings being cut, markets being expensive, and the narrative not really being completely in India favor like it was in 2024, there is no desperation for them to add, money out of turn of foreign to India, which is the big fundamental change that we have seen. And that's where now that we have the TINA factor of India is getting challenged, they might look at investing in other markets as well. So there is no big desperation for them to put more and more money immediately into India. Everything that I say is not questioning the longer term story, but they might time it a little better. On the other hand, like you were saying, there is this big pipeline of IPOs, little bit of a jubilation by the market and things looking good. We see IPOs coming, blocks coming. And that's where all the flows might come in. They might not even reach the listed secondary markets, which is what we track in Nifty and others. It just might be going through IPOs and through these blocks, which means the secondary market has a bigger struggle for flows at this point of time.
So, Vikas, putting everything that you say together, you won't be surprised if fixed income as an asset does better than the Indian markets in the near term. Longer term, no debating, but 9 to 12 months, could that be a possibility?
Yeah, so in fact, I would say that that's what my belief has been. And in fact, that's what has happened for YTD and 12 months. I think it could continue. I would have been happier if this would have happened without much earnings cut, because that would have allowed multiples to become more palatable. But the problem is this has happened with earnings cut. So multiples stay extended and equity has underperformed. I think this could continue.
Okay, caution. And earnings. The moment those earnings come in, everything turns around, right? I think that's really what we're waiting for. Let's see. I mean, the stars have aligned in terms of the monetary and the fiscal aspects that we discussed. Maybe we do get a pickup. Thank you very much, Vikash, for joining in. Good perspective and good conversation. And we look forward to the next one as well. Okay, let's quickly turn our eye back onto the screen before we carry on. Market's actually doing very well. 100 points up now on the Nifty. 25,370. The bulls are continuing to march on. This is looking good. I mean, we are at the highest levels that we've been at, I think, the last many months now. So it's a good-looking screen. Now let's talk about another aspect or another area of concern, which is the impact of AI on jobs. Recently, there's been a lot of chatter and big debate on social media as well as to whether AI could be disrupting jobs here in India, particularly service sector jobs, and whether that will have a ripple effect on the economy, given the large share of services that we have. This was a debate that was sparked by the CEO of Atomberg, I think, the company. So let's take this forward with Ramani Dati, Chief Financial Officer at TeamLease, and Pawan Goyal, who's Executive Director and Chief Business Officer at Naukri.com. Thank you very much, both of you, for joining in. Pawan, let me get your thoughts in. Now, this is always there in the background. What will AI mean for the regular white-collar jobs, the starting or the mid-level IT services jobs in India as companies go through AI adoption? I mean, what's your reading so far? Do you expect any disruption in hiring?
So this question of whether AI will lead to job disruption has been there for a while, but this is not a new question. Meaning anytime there's a technology disruption, there's this fear of white-collar job losses. And if you look at that 400-year arc ever since industrialization started, it's not turned out to be true. It's always led to more job creation. Of course, there are short periods of turmoil and the mix of jobs changes, but that's what we've seen from a historical standpoint. Now, if you take more just, let's say, year to date and see how white collar has performed, our jobs peak index for the last 5 months is a modest 3% year-on-year growth. Now, in that, non-IT has performed well, like FMCG, real estate, hospitality, pharma, insurance. Well, IT has been modest at flattish at -1%. Okay. Now, how do you read that? Is this because of impact of AI, or is it overhang of all the excess hiring that happened in past? It's hard to say. Now, there are a couple of secular trends which I want to bring to your attention. One is what we do see is senior level hiring is where there is demand. It's certainly outpacing the demand in the mid-level hiring. So experienced talent, 16 plus years, 13 plus years, that's where we see demand. The second place where we see demand, and I was actually surprised, is if you say less than 5 lakh salary kind of a segment, and still white collar jobs, there's fair amount of demand there as well. I was surprised to see the demand for BPO in that segment, BPO jobs in that segment outstrips the supply at this time. Okay. So the third trend which we see is in every job seeker segment, talent which is at premium, which is getting high salary, they are more in demand. Okay. Now, one would have expected that if AI was really impacting the jobs, the BPO's jobs in the less than 5 lakh segment would have been impacted, but we don't see that yet. Now, this is not to say will it impact in the near future, what kind of changes it will have. It is all possible. It can lead to, suddenly will lead to disruption, whether it leads to net job growth or loss, we have to see. At this time, I don't see any evidence supporting the thesis one way or the other.
So as of now, there is no impact in terms of rate of hiring. That's what you're saying. Just to get that out of the way, Pawan.
So the jobs peak is at a modest level. It's 3% only year on year. But there's whether it is because of AI, that thesis we cannot we have no evidence for yet.
Okay. When you say jobs peak is at 3%, which means what? Rate of growth is 3%.
No, jobs peak is yes, roughly you can say that. Hiring intensity is growing by 3%. So it's fairly modest.
And we're talking about IT jobs.
Now, this is across the sector. IT is flattish at -1%.
Okay. And -1% compares to how earlier? What's the earlier?
IT has been in this range bound, very flattish for several quarters now.
Okay. And when we are asking this question, is AI impacting hiring trends? Should we look at that 3% number or -1% number? What is the right metric to look at? IT jobs or overall jobs?
So I think the current thesis is IT will probably first disrupt meaning the calling, the customer support kind of jobs and developer jobs. So we should look at both those BPO and software jobs, because that's where it is likely to have impact first.
Okay. Ramani, hi. Thanks for joining in as well. Prashant here. So, I mean, similar kind of questions. I mean, on social media, but there's a lot of fear and panic on social media as well. You know, you don't, all kinds of things, right? I mean, I just saw a post this morning that 25% of the graduating class of Harvard is unemployed. And then there were, but you know, there's so much nuance. People have not made up their minds in terms of what they want to do. Some want to do, you know, further studies, PhDs. But as far as the workforce and hiring is concerned, Ramani, what are you seeing? How can you answer that question one way or the other in a definitive kind of way? Is AI and adoption of AI impacting hiring in a big way so far?
So, Prashant, definitely AI is impacting hiring, and whether all the slowness that we are seeing across sectors in the general overall hiring numbers, is it all attributable only to AI? Definitely not, because even the outlook for GDP growth is kind of moderate between 6.5% for this year, as well as there are macro level slight shrink in the demand, and also the global trade frictions are on. So there are multiple factors impacting the overall hiring trend. But in sectors like IT, BPO, education, entertainment, and media, definitely AI is impacting jobs, especially the jobs which are in 0 to 4 year category. We are seeing that being impacted. It's not just impacting the number of jobs, Even the salary levels, to some extent, have come under pressure because of the AI impact. Having said that, on blue collar side, we are seeing very good outlook for H1 of this year, especially EV infrastructure, manufacturing, FMCG. So these sectors are doing very well.
So this is, I mean, factory floor, on the ground kind of jobs, right? Which you're saying is doing much better. Okay, got that. Just a quick question to both of you. Are there any segments where you're seeing demand for jobs as well, so-called AI jobs? What kind of jobs are these? That'll mostly be in the tech space. Ramani, if you want to go first.
Yeah, sure. So with GCC clients, we are seeing very high demand, especially for AI-related jobs, AI and ML-related jobs, 4-year plus experienced profiles. And also, as Pawan rightly mentioned, at senior level, we are seeing very good demand. Even for white-collar jobs and IT jobs, there is a good demand. But since the bulk of the jobs get generated between 0 to 4-year experience, there we are either seeing the outlook being stagnant, or for medium-sized and small-sized companies, in fact, the outlook is negative. They are planning for more headcount reduction in H1 of this year.
Pawan, same question to you.
Yeah. So GCC as a sector has grown 10% year on year from a job speak point of view. So demand in GCC is robust across different job roles. Now in AI and ML, it's seeing a phenomenal growth. The growth numbers have varied from 50% to 30% all throughout different months in the year. So job in AI ML, whether it is in GCCs or non-GCCs, we are seeing a significant growth there.
All right. Hi, Pawan, as well as Ramani. Thanks a lot for joining in. Well, various reports indicate that if you have AI engineering in your resume, the probability of getting the job goes up. Would you agree? And also, they say the pay scale is very, very different for someone who has AI engineering in their resume. Interesting. But Pawan, you go first. Tell us, what is your comment on that?
Yes, certainly. We are also seeing people adding AI skills in their resume, and that addition rate has gone up significantly. However, just having that will not make a difference. You will need to really have those skills. Yes, if you have those skills, there's a huge demand, and the probability of getting a job is very, very high. I don't have specific data on the salary difference between AI engineers and regular software engineers, but anecdotally, it is a substantial delta. Even within our company, we have a substantial delta between those two roles. So yes, from a future job standpoint, developing those skills will put you more in demand and lead to a higher salary growth.
All right, Ramani, come in on this. My kids are too small, but I'm just thinking many, many years ahead, what all they'll have to do, to get their resume to stand out. But tell us your comment on this. Having AI engineering in your resume, how does it impact the probability and the pay scale as well?
Yeah, on this point, I completely agree with Pawan's comment, because having a keyword may help with better chances of getting shortlisted. But the final interviewing and the placement, getting a job, is all dependent on having the right skill set or not. And as far as the salary levels are concerned, definitely the niche skills are getting a much premium salary, be it AI, ML skills, or cloud management, cybersecurity. These kind of niche skills are definitely having a premium over the regular engineering, coding, testing kind of jobs.
Okay, Ramani and Pawan, now let's look into the future. Maybe a year, or maybe even if you can gauge 2 years down the line. None of the large IT services companies so far, your Infosys, TCS, none of them have publicly spoken about reducing campus hiring or any kind of AI disruption. If anything, every time we interact with these companies, they say that in fact they're investing far more in upskilling their workforce to make them AI ready, to work smarter, etc. So nothing publicly on record in terms of cutting down jobs. But would you expect some sort of a disruption ahead? What should both employees as well as investors be aware of as these companies go up the AI adoption curve? Ramani?
See, it's very, I think it's too early to comment on this aspect because, even the large companies are still assessing the kind of impact AI and ML can have on their processes and overall jobs. Definitely, it will help increase the productivity of the existing employee base. And as far as the large IT services are concerned, as you rightly mentioned, they're all investing heavily in upskilling their existing talent towards AI and ML related skills, and this will help increase the productivity of these employees. But at the same time, can this, in the short run, impact jobs? In our view, maybe in the short run, definitely it will have an impact, especially at the fresher level hiring. But in the long run, it will create more new jobs in different categories.
Okay, Pawan, your thoughts?
So AI, there is no question AI will increase productivity. Now the question is, will you do more with less or do you do more with more? And let me explain that a little bit more. So as productivity increases, you can address segments, scenarios, and things which were not possible earlier. Okay. So if let's say if you have I know of a social media company which has said, look, I could not provide customer support because it was prohibitively expensive. But now I can put a layer of AI and then put humans behind it and provide a much better support. Okay, so something which was not feasible earlier starts becoming feasible. So now which of these two scenarios will unfold, whether it's more with more or more with less, it remains to be seen. I'm cautiously optimistic that will be the more with more scenario. But this is something that we'll have to wait and see.
Okay.
All right. Pawan and Ramani, thank you very much, both of you, for joining us. I guess from a company perspective across, it doesn't matter which industry, when a position opens up, I guess that question, hiring managers and, the leadership, of course, is asking the question whether we need to, whether this can be done, whether this can be automated, whether AI can do it. That whether it can be, cannot be is a different matter. But that question, of course, is being asked across the board, has been asked for a while now. Thank you both for joining us. And we'll continue to sort of come back to you and as we track this story going forward. We'll take a quick commercial break here. We have the management of Keystone Realtors joining us on the other side to talk to us about the FY26 outlook. Stay tuned. Coming back.
Welcome back. Well, let's focus on the real estate theme then. Keystone Realtors, that's the next management on the show. The company aims at 33% growth in pre-sales to around 4,000 crore rupees in FY26. To discuss this and more on how the trend's shaping up, Baman Rustab Irani, the chairman and managing director, joins us on the show. Hi, Baman. Thanks a lot for joining in. Always good to have you on the show. How are things looking on ground? Demand strong enough? And tell us a little bit about your launches as well. Last year, they were a little lower than what the street had expected earlier. But this year, you're talking about 7,000 crores. Break it up for us, geography-wise and project-wise.
Well, Nigel, always good to be on the show. So very good morning to all the audience that is out there. I just want to tell you that, probably in terms of real estate terms, we've had the highest number. We, as in the real estate industry, has seen 40,248 registrations taking place in the last quarter. which is a decadal high, right? And so the markets are extremely good. I can tell you with regards to us, we've done extremely well in the year. We've gone exactly as per the guidance given by us. We've clocked 3,028 crores, so we've given a guidance of 3,000 crores for the year. We're making ourselves more and more a predictable company, which can kind of give a growth path and then stick with it. With regards to your launches, yes, you're right. We were one project short of thrilling our investors, but that did not happen due to certain environmental, points that are there. But I'm happy to state that that project is already launched in this quarter, and I've seen fantastic sales come out of it. The markets are extremely strong, especially in the micro markets where we operate. You're aware that we have acquired 22 projects in the last 2.5 years, of which about 18 are redevelopments and about 16 are in the mid-market space. Mid-market and aspirational is the largest growing segment that is there in Mumbai. And we believe that this market, and all the data also points to the fact that this market will continue to grow. And we are serving that audience extremely well. At the same point of time, our focus on premium and uber premium properties also stays high. We've already moved towards the city. We believe that a lot of development will take place, given that 3.5 lakh crores has already been invested by the government in infrastructure, whether it's a coastal road, the metros, and of course the boom that is coming. Like I told you, 40,248 properties that got registered in the last quarter.
All right, so 7,000 crores of launches, you're sticking to that. The project that got delayed, it's going to see the light of day, and the initial feedback to your launches has been good. Is that correct?
That's absolutely right. 7,000 crores, and this year we might thrill our investors by actually crossing the number that we are giving. We're giving a very, I would like to say, conservative guidance this year of 4,000 crores in pre-sales. Again, over there, we plan to kind of, in a way, knock it out of the park. Let's see how it goes. But the year is promising.
So you've taken your stance, and hopefully you're in good form by the end of this year. That said, I just want to focus a little bit on the redevelopment part of the business. There are a lot of players that are getting in. Just wondering, competitive intensity as well as going up out there. If you could help us out with the profitability breakup. First of all, how much is redevelopment as a percentage of your total mix? Where do you see this number headed to? And a comment on the, on the competitive intensity, because it could put some pressure on margins. Your take.
When you look at about 60,000+ buildings in Mumbai, wanting to go for redevelopment, not because, or needing to go for redevelopment, and many more wanting to go for redevelopment, I can tell you the market is extremely large. I'm extremely happy also, I must say, from being the only organized developer that was in this space. Seeing that everybody else wants to come into this space is a validation of our early mover and what we've done. I've already said this plenty of times, but we're one of the developers that is probably the developer of choice in most of the redevelopments that we enter. Not because of anything else, but the fact that we are well capitalized. Today we are a listed entity. People can kind of view our financials online. At the same point of time, we've rehoused more than 2,000 families in new homes, and these people have a point of reference or a point of check, and they could go to any of these redevelopments and check them out. So redevelopment is getting intensified in terms of the number of developers wanting to get into this. But we are totally fine with that. The process is also becoming a lot more organized, and there's a lot less ambiguity. Yes, competition always makes the prices go high, and that's a very strong, robust internal mechanism.
Yeah. Bhavan, sorry, just to get some specifics, good morning, Prashant here. What is the size of redevelopment opportunity every year in Bombay? And how many players would you say are serious contenders for that opportunity now?
Prashant, let's start off with how many developers there are in Mumbai city. So at last count, I was told 5,000+. We as CREDA and CHI know that we've got 1,400 members of our own. And there are a lot many more who are not our members. So there can be 5,000+ developers. A lot of these, Prashant, are very micro market operational. So I know developers who work in the Ghatkopar or even in the Bandra West area who will not step out of this geography. So it's very difficult to say how many developers, but let me give you an idea that if a good redevelopment is advertised in the papers today, it's easy to expect more than 20 or 22 companies making a bid for it. Of course, the societies have started appointing PMCs who are also very, very choosy and are able to kind of, create entry barriers in terms of size and scale of developer, the kind of redevelopment that's been done. And I think all this is extremely healthy because, there's no point in spending a lot of time or just wasting a lot of time dealing with developers who've got no clue on how redevelopment will be carried out.
And the size of redevelopment, Bowman, size of annual opportunity, as you see it?
Difficult for me to put a number, quite honestly, Prashant. Very difficult for me to put a number. But like I told you, 60,000 plus buildings needing redevelopment and more, maybe double that size wanting redevelopment given the DCPR rules that are available, which would allow them to have a better home and a better life. I think just one line from me. I look at this as the rejuvenation of this city. The city has been very constricted for new space for a very long time. And given the market's appetite today and also the fact that people are moving from smaller homes to homes that they always wanted or desired, and having the pockets and the financial means to achieve that, I think this is a great trend for us.
No, absolutely, Baman. While I agree with that, as a resident, every time I see a 30-story tower come in place of a 5 or 6-story building, while it's great amenities and looks great, one just wonders what's happening to the civic infrastructure around it and whether the civic authorities are going to keep pace with the pace of redevelopment. That's a debate for another day. But I actually asked your peer company, which is coming to the market, Kalpa, through the same question. We're trying to understand this. From a business dynamic perspective, a redevelopment project versus a regular, development that you're doing, where are margins better? I mean, is it timing that's better? Like, they were explaining to us that redevelopment projects are more time bound, so perhaps quicker than, acquiring land parcels and then developing ground up. But just your thoughts on the profitability and the business matrix, redevelopment projects versus the regular projects.
So, let's look at it this way. The largest part of the pie is the redevelopment. Okay, lands in Mumbai will only come in from government tenders as of right now, or any large corporate that wants to sell off its land. Very few land owners are there in the city. Today you have 35% gross margins as a base at which one should enter a redevelopment, and at least one should target at a 15 to 17% PAT. Redevelopments, contrary to what people believe, is not the easiest to be in. And as a matter of fact, it takes a lot of skill and art combined together, Surabhi, to be able to get redevelopments timely completed. And that is where Rustomji scores a march over most, because we've been part of the redevelopment process since 2001. And so we have a 24-year lead on our understanding and our experience on redevelopments.
So 35%, right? Baman, what you're saying is that you would typically take up a redevelopment project if you're at least assured of 35% margin, right?
It's become very important now to be able to screen projects that do not make money just because there are a host of developers who are trying to go in and try to get that project. And it's happening. And I'm happy to let it happen because, these developers will have to go through the learning curve.
All right. Just to dovetail into the earlier conversation we were having with on AI, etc. You'd imagine that real estate on the ground, hard infrastructure is least affected by AI. But I was talking to somebody in the real estate space, another company, Bombay-based. They were saying that all these, we see all these project videos, right? The promotional videos. A lot of it is now being created with AI, with the help of AI. So you don't have to go to the site, shoot, spend days, you can come up. I don't know if that's true, Bowman. Sorry, off tangent question.
We are very, very soon moving towards a virtual world. And, when we had Facebook and all of them start selling real estate space on Facebook and, on Meta and stuff, we were wondering what's happening. But honestly, it's really moving towards that. And if one of the things that should give a CEO sleepless nights, it is actually AI. And the real estate industry is no different, and that's why we have PropTech startups almost coming to us every single day, everything from legal to drawing up your brochures or creating these videos. But very importantly, and on a serious note, Prashant, we are using AI extremely well. We are using various bots on our sales side in terms of gathering data. We are also using bots on our CRM. We're using technology to go ahead. BIM has been integrated into AI, with allowing us to kind of I would say economize the construction timelines, if not the cost, using AI. And designs are getting a lot more edgy with the fact that you can almost do all the tests online before you actually put the building out there to launch. So it's something that we are working strongly with.
All right, very quickly, Baman, I think this year you'll have to bring your holding down, right, from around 78% to that 75%. So that deadline's coming about. We're hearing about plenty of supply in the market. Looks like your time has come as well. Should we expect it in the coming quarter?
We have 2 quarters for that, but Nigel, thank you very much for making it a public announcement. Yes, we will be kind of trimming ourselves down to 75 as it's mandatory. We are well capitalized at this moment in time, so the internal debate is exactly whether we go in for a QIP or a block, and we will decide that hopefully by August.
Right, 3 years after listing, that's the mandate out there, and I think that date is approaching. But thanks a lot, Baman, for joining in, sounding optimistic about business, plugging there that redevelopment debate as well, and also telling us that you all are evolving with AI as well. Thanks a lot for joining in.
Thank you guys.
For the time being, slip into a short break. On the other side, Nilesh Gupta, Vijay Sales, as well as Kumar Rajagopalan of Retailers Association of India, as well as Pulkit Patni of Goldman Sachs will be waiting by for a discussion on consumption trends here in India.
Welcome back. Let's get a status check as far as the consumer sector is concerned. Now, Goldman Sachs expects consumer durables and electrical company growth to moderate in the first quarter of FY26. But lower inflation, tax cuts, favorable interest rates, lower interest rates, that is, should reflect in demand for the sector and sentiment in the second half. That's essentially the widespread belief. We have Pulkit Patni, Goldman Sachs, from Goldman Sachs, Nilesh Gupta, Director at Vijay Sales. We also have Kumar Rajagopalan, CEO at Retailers Association of India, to run us through whether, this expectation is rooted in solid grounding. Gentlemen, great to have all of you here. Thank you very much. What we'll do, of course, is get that expectation out of the way, and then we'll get a real sense of where demand is as of now from both Nilesh and Rajagopalan, who will be able to help us with that. But Pulkit, let me start with you. As you say, demand is moderate, but H2 perhaps should be much better. What gives you the confidence?
Thank you for having me. So if you look at the next quarter, which companies will report, I think given an erratic summer, it is evident that any company having a summer portfolio is likely to see weak demands. Or our channel checks are suggesting that whether it is with EMS companies or with brands, Q1 is looking to be a weak quarter. And that gives us the confidence that we are looking at a weak quarter in general for consumer durables and electricals. Having said that, the other underlying message we are trying to give is that we don't want investors to miss the forest for the trees, i.e. that there are a lot of factors which should support growth in the second half in the year thereafter. And that's some of the factors that you highlighted, that inflation is at the lowest. We've had tax cuts. We have interest rates which are at its lowest, and plus a favorable base, and which is where diversified electrical companies. So we want to be very clear. We are not talking about single product companies only. Companies that have diversified product base, we think are well placed in that scenario of a second half pickup.
And that explains your calls, Pulkit. I'm just seeing, I will put up the graphics as well. Goldman has buy calls on names like Crompton, Havells, even KEI Industries. And as he's sort of talking about it, a lot of these are diversified names. Voltas is a sell. Voltas, obviously, a large part of their business comes in from cooling solutions. So just to point further on this, Pulkit, for these diversified consumer durable players or electrical appliance players, what are you working with? What kind of growth, or will the second half be a story of margin expansion? Or would it be both? What makes you positive on them?
Well, growth numbers obviously vary by each subsegment depending on penetration, depending on the base. If we look at few underlying drivers, first, the previous speaker spoke about real estate, and we know we've been in a 3-year real estate upcycle. Now, whatever gets launched will get constructed, and that's why cables, wires, switches, switch gears, we expect demand to be reasonably strong. Plus, the base effect for some of these other diversified electrical companies should also actually augur well for the second half. So while for the AC segment, we are working with an annual number of just about a mid-single-digit growth after 2 strong years of about 30% growth, FY24 and FY25. For the rest of the segments, we are looking at early double-digit growth, and that comes off a reasonably decent base. And that acceleration is what gives us the confidence of a second half and a FY27 recovery for these sectors.
All right, got that, Pulkit. Well, let's get in, Mr. Rajagopalan, into the discussion. So what are your observations with regard to how demand trends on ground? And if you could tell us geography-wise, where you're seeing the largest or the highest traction?
Yeah, if you really notice the business up to April, most of the retailers, at least across various sectors, told that their growth was around the 4 and 5% levels. It's in the month of May that our reports have just come in. We're seeing the growth is at 7% across all the sectors of consumers. And I think that's a good indication of where things could really land up into. The level of 4 to 5% is obviously not something that retailers want. The 7% is reflective, I guess, of the way in which the market is. The inflation levels are not anymore so much of an issue. Globally, India's got a decent stand to be able to manufacture enough and send. We've also got decent rains that's happened end of May, and that's also, I mean, it was earlier than normal, and that was good news, and it became rain. It was not pre-monsoon, so that also was a good indication all told. So I think things are looking decent. We've gone on to a 7% level. We'll have to wait for the June numbers to come, but my guess is that June will also reflect good numbers. I think retailers look forward to the double-digit growth that they are otherwise accustomed to.
Okay, all right. Cut that, Mr. Rajagopalan. Let's get in Mr. Gupta. Mr. Gupta, you know, you have a store here in Mumbai, in Bandra. Whenever I go, it's always full. And I've been quite satisfied as well, just as a personal feedback. What are your observations, though, in terms of demand trends? How was April, May and June? Lower than expectations or in line?
Good morning, everybody, and thank you for the feedback. I think in the retail as well as in more in consumer durables specifically, what is important is the consumer sentiment. And I think the consumer sentiment is still strong. Yes, we've had a poor summer sale because of the erratic summer. We had monsoons all across. The south and the east was actually a washout. But that does not mean we should be calling there's a problem in the market. Yes, the other categories are growing. And what we feel is, except for the coolers, because coolers is specifically a summer product, it doesn't sell at the end of the year. But in the last 3 to 4 years, what we have seen is air conditioners do sell at during the rest of the part also, and it's pretty strong. And in some parts of the country, during the October, we have a second mini summer also. So we are hopeful that we'll be able to cover up whatever losses we have made in the summer season. Also, we have to understand that February and March were very strong for cooling products. So there, I think it slightly helped us to reduce the negative what would have happened otherwise if the February and March is not having strong. Going on the other product categories, the televisions are holding pace. We are seeing a growth of around, although it's a single-digit growth, but at the same time, we also have to understand that the penetration level, at least in the markets where we are, is pretty high. And then washing machines, after 2 years, last year also we saw slight growth happening. This year it's again growing, so that's a very good sign. Refrigerator has been a flat. I think that's primarily because of the summer. But mobiles are doing well, laptops are doing well, small appliances are picking up. Overall, I think, yes, the first quarter has been weak because of the summer and nothing else. The consumer sentiment is good, so we should see a good Diwali. And the rest 3 quarters should be much better than last year. That is what my...
Yeah, Nilesh, good to get that granular breakup from you. Hi, morning, Surabhi here. Would it be possible to put a rough, number range to it? Like you're saying that refrigerators as a category is flat, but because you're saying that the second summer, so to speak, the October heat period, that should make up for the weakness in the early AC sales. So let's say ACs is a category this year. What would the growth estimate be? And these personal electronics, mobiles and laptops, which are fast moving, where would you expect their numbers to be? I mean, would it be single-digit growth, 10%? Would it be possible to put some sort of a range?
So AC this year we expect, since we had a poor summer, we should be still landing up in a 7 to 10% growth scenario.
Okay.
If the latter part of the year picks up, which we are quite hopeful. On the numbers of mobile and digital category laptops, what we feel is number-wise there won't be, volume-wise there won't be growth. But what is a big change which is happening, the value is going along. So we should see a growth of around 50 to 20% in value, and number growth would be hardly low single digits. But value is what counts at the end of the day, and that is what we are seeing across all categories, that premiumization is happening, and ASPs, the average sales price of each product is going up. And that's also a very positive sign.
Oh, okay. Oops. I have to, I think, redo my math now on buying a new laptop because Nilesh is saying
I just bought one.
Oh, the value estimates are going up and up. I think I have to relook at my own numbers, jokes aside. But on this part on EMS, Pulkit, coming back to you, how do you rate the listed stocks over here? Because, like Nilesh is pointing out, mobiles, laptops, and this is a fast-moving category. But then the question is, what is left on the table in terms of stock prices? I mean, many of the stocks are trading at 90 times, 100 times, if not more. So, I mean, how are you looking at EMS as a space?
Sure. So for EMS, we think there's no doubt that the TAM is growing and growing very rapidly. We think there's a lot more electronics that are going to be made in India over the next few years. Having said that, one has to look at the way the market is evolving, which means for especially categories which are high volume, low margin categories, as we come to the end of the PLI in the next couple of years, we think there are going to be pretty significant market share shifts because PLI did allow companies to consolidate market share, in which at high valuation, the investors have to be confident of continuity of growth for some of the companies. Hence, what we are seeing many companies do is basically get into component manufacturing, which will make the client base a lot more stickier. And so in that context, I think EMS is a very interesting space over the next few years where market share shifts will happen, but companies that are able to do components, which are able to do backward integration, probably have further right to win going forward.
Okay. All right, gentlemen, thank you very much. Good perspective coming in from all of you. Helps us understand and map the mind of the consumer a little more clearly. Thank you for joining us this morning. Well, with that, we have to move on. I think we'll take a quick break. Yeah, we'll take that break, come back on the other side, and then Manisha Gupta will join in with all the latest from the commodity markets. Welcome back. Let's shift the focus to the commodity markets now. We have Manisha joining in. Manisha, what are you tracking today?
Well, I'm looking at silver because when you look at the overnight markets, while we've seen gains come in for various commodities, but silver clearly continues to shine bright. And the other thing is that going forward, while various banks and brokerages are changing their forecasts for other commodities, but when it comes to silver, almost everybody is on the same page that silver will outperform gold and will continue to surge higher going forward. So overnight markets, we've seen a percentage point in case of silver, 9% up in the month of June itself, and we are trading 23% higher for this year until now. There are various supportive factors that we've seen in case of silver. One, it's a deficit for a fifth straight year in 2025. When you look at production and consumption, those numbers have continued to mismatch. Apart from that, the macros have been supportive as well. You have weak US dollar index trading very close to those 3-year lows, which has been supportive for dollar-denominated commodities. The safe haven buying that we've seen in gold has also rubbed off in case of silver, which is part precious metal and part industrial metal. It also has to do with geopolitical tensions and very strong industrial demand that continues to keep silver in favor. When it comes to industrial numbers, well, everything about electronics and electricals as a segment is now using silver. So from your smartphones to your switches to tablets and 5G networks is using silver, and this usage only is going higher. It's also about electrification of transport, whether it's about electrification of buses or smart trains. We've seen silver usage there as well continue to gain up. Then it also has been about photovoltaic, medicinal uses. Silver really seems to be almost everywhere. The markets also have put out various estimates suggesting that by 2050, much of silver, almost 85 to 98% of current global reserves could actually be used within solar energy. This is an area where you have seen silver continue to be used quite a bit. And apart from that, you have electrification, investment demand, jewelry demand, artifacts demand. All of that also continues to be quite on the stronger side as people invest in silver. An interesting statement that came in a couple of months ago was that Russia is expanding precious metal holdings into silver as well and will acquire worth $535 million in the next 3 years. And we do understand that those numbers have started to work on ground as well. So this is, Russia and Mexico actually produce or account for 21% of global silver production. And we know what's happening in both of those countries. That also has led to decline when it comes to production numbers there. If you look at the overall numbers there, in 2010, silver production was at around 1.07 billion. 2024, we are lower that at 1.03. So clearly, production has not increased in last decade. We've been in deficit for the last 5 years as well. So silver perhaps is your go-to metal. Let's take a look at why or what most of the banks and brokerages are saying. Citi, for one, talks about $40 an ounce for the silver prices in this year itself. Currently, we are trading anywhere between 36 to 37. $40 a barrel, $40 an ounce is what Bank of America and Saxo Bank also seems to be talking about. JP Morgan, in the meanwhile, says $30 is what they're targeting by the end of this year. So clearly, very bullish cues coming in for silver.
Okay, so silver indeed sparkling bright. Thank you for that, Manisha. Well, with that, it's time to wind down on this edition of Bazaar. We're leaving the market, at least at the large cap level, very steady. The Nifty is still up about 130 odd points. But watch for the mid-cap market. There's some profit-taking going on in mid-caps. The mid-cap index is down about 40-odd points. The advanced decline ratio is still positive, but let's watch this space because otherwise the large-cap market is all right. I'll just leave with a couple of stocks, the large-cap names that are taking things higher. Jio Financial has had a very good week also so far, and again, it's having a good morning today. Stocks up about 2.5%. Jio is up 6% so far this week, so good run for Jio Financial. There's Bharti Airtel. Bharti Airtel is up almost 2% as we speak. And some of the other financial names like Bajaj Finance and HDFC Life, basically the non-banks. Non-banks is where the buying is this morning. Well, on that note, we'll take your leave on this edition of Bazaar. Thank you so much for watching. Chartbusters coming up next.
Wild swings in shares of MobiKwik. The stock is now up 6% after following an early trade. This after 9% equity worth nearly 170 crore rupees changed hands in a block deal. Sources say Net1 Applied Technologies sold stake.
Voltas is in focus after Avendus Spark upgrades the stock to a buy rating from reduce with the target price of 1,516 rupees. They're expecting the room AC demand to witness growth driven by low penetration.
Texmaco Rail also surges as it wins an order worth nearly $62 million from Cameroon.
Shares of Western Carrier surge as it wins a 558 crore rupee logistics order from Jindal Stainless. The stock has surged over 25% in the last 1 month. Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. The good news is the Nifty is up closer around 100 points. The problem is the mid-cap index is mildly in the red. But par for the course, it's the final day of the series. Let's see whether or not the Bulls can drive home the advantage. Hey, Mangalam.
This is advantage Bulls, Nigel. No two ways about it.
Yeah.
We are higher, above the Monday's high as well, and we are holding above those levels. Yes, we did go to the 23,400 mark, and from there was a mild dip, but nothing really to worry. We're doing extremely well. Towards the second half of trade is where a lot of the action is expected. Keep an eye out on oil marketing companies. They've been doing well ever since there was a big dip in crude prices owing to peace in West Asia. But we now have another round of buying in HPCL, IOC, BPCL. The intraday charts of all these companies should come up for you. So we'll watch out for that. The oil marketing companies is something that we're looking at right now. BPCL, there is a spike as there is one on HPCL and IOC as well. FMCG continues to do well from yesterday. We have Britannia, which has moved higher. ITC2 is at the high point of this morning. Good time to get in Sachi. I'm going to take her off Trade Bulls for a quick technical check on the market. Sachi, we're holding above 25,350, give or take 30, 40 points. Do you think this is good news for the Bulls and towards the second half there could be an up move, or the weakness in mid-cap index suggests that there could perhaps be some selling in the second half?
Good morning, Mangalam. Good morning, Nigel. I think Nifty has already made an attempt to, surpass that 25,500 hurdle. But I think if you look at the data, it looks like more of a consolidation here. We may see the Nifty again spending, time within this particular range. On the lower side, we don't see it, breaking that 25,200, bottom support. We may see Nifty oscillating within this range of 25,400 to 25,230. So I think the probability of a breakout about 25,500 looks weak. Even if you look at Nifty Bank, we were expecting that there could be an expiry somewhere close to 157,000. But looking at the data again, the data is suggesting a range-bound movement. Probably the resistance at 56,800, 840 will stand intact for the day. And on the lower side, we may see support somewhere close to 156,550.
Okay, got that, Sachidanand. So that's the call in terms of indices, but you have, I'm sure, a couple of individual picks for us. Tell us, which ones are they?
Nigel, there is a good amount of strength in all the cement counters, and from that particular pack, we are confident looking at the price action of Dalmia Bharat. Disclosure would be that we have recommended it to our clients as well. Now, if you look at the weekly charts, there is a bullish flag formation exhibiting a price target somewhere close to 2230. There's a good, strong positive crossover on its 5 and 20 exponential moving averages as well. So we are expecting that this particular momentum may continue towards 2230 during the coming week itself. The stop loss for the trade can be placed at around 2095 on closing basis, and we are recommending building fresh aggressive long positions in Dalmia Bharat for a pattern target of 2230. The other stock which we have recommended is TVS Motors. Yesterday we saw a very confident breakout and very strong rollovers there. If you look at the structure, it also looks like a bullish flag formation on a daily scale. After a strong consolidation, we have seen a very good elevation of support. The stop loss should be placed at around 2885 on closing basis. And we may see this particular rally getting continued towards 3060.
All right, we take that point. Meanwhile, do you have a view on Nykaa? The stocks moved slightly higher. It's been doing well all through this week, just about 10% away from its 52-week high. They've held an investor day. We'll talk about the key takeaways from the presentation which has been uploaded. But technically, how does that one look?
Nigel, I think there is a very strong, up move which is ongoing. We have seen, days of consolidation within the same. Price structure wise, we are expecting that this rally would continue towards 220 eventually. From a trading perspective, we have a target in mind close to around 213. And if you look at the data, I think the support at 200 has been very confident. Even in the coming July series, we may see this particular support being very significant. So one can keep a stop loss at around 198 on a closing basis and build some aggressive positions for a trading target of 213, followed by a pattern target of around 220 from a trend perspective.
All right, we take that point, Sachi. Thanks a lot for that. As we speak, the stock has moved higher. We'll keep an eye out on how this goes, but also watch out for a couple of other stocks from the broader markets. Dilip Buildcon is up around 5.5%. We also see some traction in Cello World. That's the other one, which is up around 4%. So, yeah, there are, some weakness in the mid-cap index, but we are seeing a lot of stocks move higher as well as we speak. We take a short break, but as we do that, some good news for our viewers. The business news leader of India, which is CNBC-TV18, is online and it's on your fingertips. Why do we say that? Because it's the CNBC-TV18 app. The all-new app which gives you access to breaking news, in-depth articles, financial world updates, all of them at your fingertips. You can download the CNBC-TV18 app from either the Apple Store or the Google Play Store, or just scan the QR code which is up for you on the screen out there. Welcome back. Among the stocks that are doing good today are a bunch, but there are a couple which are not doing well, and they belong to the spirits space. Why is that? Because there has been now, the first written report coming out from a brokerage on the Maharashtra excise duty hike that has happened, and as a result of which, there has been a target price cut on United Spirits as well. So Kotak Securities this morning came out with a note. They're saying that the Maharashtra government duty increase has resulted in a 30 to 45% price increase in retail price for popular, lower prestige and mid-prestige segments. How much do these segments account for in their overall sales? It's about 13% of their volumes and 11% of their value sales. Remember, Maharashtra is among the top two markets for the company in terms of revenue and EBITDA. So the total contribution of Maharashtra is about 16%, of which 11% comes in from lower prestige, mid-prestige and popular itself. Premium and luxury, which accounts for the next 5%, their prices are relatively stable or virtually unchanged, between 0 to 8%. That's a positive. However, the bigger problem is that this increase in Maharashtra excise duty brings back unpredictability around policy, and that brings some uncertainty on that space itself. So basis this, they've cut their FY26 to FY28 EPS anywhere between 3 to 6%, and their target price stands lower by 50 rupees from, or rather 100 rupees from 1575 to 1475 rupees. But amidst all of this, there are three key triggers to track. One, there is a new excise policy likely in Delhi. So would they go the way of Maharashtra, or would they be a little more favorable is something we'll watch out for. Bihar elections in November 2025. Remember, Bihar is currently a dry state. Post that, could things change? That would be a positive trigger. And thirdly, the formal implementation of the UK Free Trade Agreement is something that we'll be watching out for very closely. But for now, a 30 to 45% increase in popular, lower prestige and mid-prestige segments eating into the EPS of United Spirits. I'll be interested to see how, Allied Blenders and the others react as well on this, because they have a higher salience coming in from lower prestige and mid-prestige segments, especially the Officer's Choice whiskey that Allied Blenders sells. So if there is a 30 to 45% increase, then there could be some sort of volume hit. Even though everyone's looking at the premium space, this is where a lot of the volumes comes from. So I'll be very interested in watching that.
All right, we'll keep an eye out on those names. Thanks a lot for that, Mangalam. Let's hop across to Vinny. She's here to tell us about Dr. Reddy's that's trading with a cut after Citi cuts its target price on the stock. Vinny, tell us more.
Hi, good morning. So yes, we are seeing that Citi has cut the target price. They have a sell call already on Dr. Reddy's. Now target price is cut to 990 rupees per share. Previous target price was 1040 rupees per share. What are the reasons behind this? So now they did some deep diving into the Canada's GLP-1 opportunity, which was one of the first ones to come up for Dr. Reddy's in terms of the synergies. Seems like the market is suggesting and the street is anticipating now that those expectations will be tempered down. Other than that, additionally, the timely approval will be key to monitor for Dr. Reddy's, and if it misses that approval, then obviously the opportunity that comes in, first mover kind of an advantage, that starts wearing off, given that there are so many players now in GLP-1 opportunity. So on that note, that approval will be key, and these are complex approvals that everyone is watching out for. The decline in Revlimid sales and related PLI is something that will result in a bit of a drag coming in for Dr. Reddy's, and that would be in the EBITDA front as well, of around $750 million to $780 million. So Revlimid sales, anyways, everyone knows that that's going to be decreasing from FY26, and from now also we are seeing that effect coming in, and that will be a pressure point coming in for Dr. Reddy's. EBITDA impact will be difficult, especially to offset for Dr. Reddy's, and supply of the remaining quality of and quantity of Revlimid, in the month of May and later on in the next couple of quarters as well, is something to watch out for.
All right, Vinny, thanks a lot for that. So that's about Dr. Reddy's. The other stock, we have spoken about Nykaa with Sachidanand earlier, but here are some key takeaways from that nearly 150, 160 slide presentation that the company has uploaded ahead of its Investors Day today. Nigel, a couple of things. One, the macros and then the micros. In terms of the macros, they believe that the online beauty and fashion market, which is currently at around $23 billion, which was $6 billion just about 5 years ago, over the next 5 years can grow all the way up to $70 to $75 billion. So there's a big move out there is what they're expecting. And in this, online beauty market is likely to be about 14 to 15 billion versus 5 billion right now. And online fashion market is likely to be 60 billion versus $18 billion right now. And in that as well, it's the premium fashion market, which is expected to become 3x by FY30. Who's buying all of this? Gen Z. Why is that? Because, Gen Z's contribution to sales right now in beauty and personal care is about 44%. Fashion and accessories is 47%. Footwear is about 50%. So all these factors working for growth out there. The here and now, three most important things according to me. One, they've launched a quick commerce thing called Nykaa Now in 7 cities, which will fulfill orders between 30 to 120 minutes. So this is directly competing with some of the quick commerce apps out here. If you can go and get your products on Nykaa itself, that's something we'll be watching out for. Secondly, their own brands, House of Nykaa, has reported 2,100 crore of gross merchandise value. They believe this can compound at 30% over the next few years to reach 6,000 crores by FY30. And this would be led by fragrances, bath and body, and clean beauty. And finally, on fashion and footwear. Fashion, remember, brokerages were saying would be a bit of a drag on the company, and they were watching out for operational performance out there. They said that this business can grow 3 to 4x in the next 5 years. Big marquee launches planned in the second half of this year, but they will break even in FY26. So that's a big headline coming in. They will break even in the fashion business in FY26. By FY28, the margins will be mid-single digits, and steady state margins for the fashion business seen between around 10%. And finally, some of their growth drivers, which is the wholesale business, Nykaa e-Superstore, they believe they can grow 3x from here on the geographic expansion that they're doing, but break-even won't happen. Break-even happens at 4x of their current scale. So it's a small business, but growing very fast, will be a growth driver for the company going forward. 3 key takeaways: they launch quick commerce, own brands likely to do well, and fashion business breaks even in FY26.
Got it. Thanks a lot for that, Mangalam. So that stock clearly a little bit excited. It recovered considerably from the low point of the day. Well, I think time to slip into a short break. But remember to tune in to the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, where we focus on currency, commodities, and cryptos, and Global Lens at 8:30 p.m. Welcome back. Actually, the markets have slipped a little bit from the highs of the day. We're still holding at around 25,340, but some kind of profit taking has crept in. The Nifty Bank for the second day running, that's actually underperforming. And which are the other stocks that have slipped? Well, you have stocks like Bajaj Finserv. That one, in fact, is still up, but it's slipped close to 100% from the day's high. Similar is the case with Shriram Finance. That as well has come off a little bit. And we're just talking about Dr. Reddy's. But Sun Pharma, a stock that was trading in the green with close to around 0.5% gain, that in fact has moved into the red. So Sun Pharma is another name that should be on your radar. Well, on to some international updates though. NATO leaders backed the big increase in defense spending that Trump had demanded, with the new defense spending target at 5% of GDP from earlier target of around 2%. Take a look at this report.
War is always changing as technology advances, and in a bid to increase their country's defence capabilities, NATO leaders have endorsed a big new spending target at a summit in The Hague. NATO members will aim to spend 5% of their economic output on defence, a big increase on the current goal of 2% agreed at a 2014 summit. That's 3.5% of their GDP on core defence, such as troops and weapons, and 1.5% on broader defence and security-related investments, such as cybersecurity, protecting energy pipelines and adapting infrastructure for military vehicles. Hitting these targets could eventually mean spending hundreds of billions of dollars more a year. Doubling down on cyber investment is one of the ways to improve the alliance's defence. That's according to Benjamin Jensen, an international relations and security specialist.
So I think the biggest challenge for NATO on the horizon is the intersection of the low cost of shooting waves and waves of long-range attack drones alongside rapid targeting adjustment using AI and offensive cyber. Russia has proven it will attack NATO member states with cyber any time of the day.
And money could be used strategically. Due to technology, he said, low-cost systems like $1,000 drones can now destroy high-cost assets like planes.
In the ideal case, we would have entire NATO drone brigades like what we see in actually Ukraine, but maybe manned by a multinational battalion or battle group.
Moscow's continued war in Ukraine is one reason, along with concerns about a possible future threat from Russia. That's alongside pressure from US President Donald Trump to boost investment. Europe's preparing for the possibility that Washington will withdraw some of its troops and capabilities. Targets are expected to be met in 2035, but can also be adjusted when they're reviewed in 2029.
All right, and speaking at a press conference at the end of the NATO summit in Netherlands, US President Donald Trump said that Israel and Iran are tired, but the conflict between two countries could start again, bringing about some more uncertainty here. Listen in.
They fought very, very hard and very viciously, very violently, and they were both satisfied to go home and get out. And can it start again? I guess someday it can. It could maybe start soon. You know, Iran has a huge advantage. They have great oil, and they can do things. I don't see them getting back involved in the nuclear business anymore. I think they've had it. They've been at it for 20 years, and I don't see that happening either. Now, if it does, we're always there. It won't be me, it'll be somebody else, but we're there. We'll have to do something about it.
Well, Donald Trump also commented on the Russian-Ukraine war. Let's listen in to what he had to say on that one.
I know one thing, he'd like to settle. He'd like to get out of this thing. It's a mess for him. He called the other day. He said, can I help you with Iran? I said, no, you can help me with Russia. You help me get a settlement with you, with Russia. And I think we're going to be doing that. Vladimir Putin really has to end that war. People are dying at levels that people haven't seen before for a long time.
Right, interesting, important commentary coming in out there from Donald Trump. There's a funny line, right? He said, can I help you with Iran and Israel? And he said, no, you can help me with Russia. That's what Trump said.
He said it the previous day as well. You know, he said that Putin called up and he asked, can I help you? And he said, no, I want some help with you.
Be that as it may, the market though has come off the highs mildly. The Nifty Bank has, slipped back into the red as we speak, and even the mid-cap index has been flitting between red and green right now, down about 114 points for that index. And pull up the advanced decline chart as we move into the short break. Just do that, and you would see that the lines have intersected with more number of stocks declining than the number of stocks which are advancing. So that the crisscross lines come up for you on the screen as we leave you on Chartbusters right now. Take a short break, come back. On the other side, we have the team of Trading Hour coming up.
Hello, good morning. You've tuned into Trading Hour, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. With me is Hormaz Fataki as well. Hormaz, good morning. And Nifty is exactly where we spoke about in, Power Breakfast. 25,300, above that market was indicating and that's what it's holding on to right now. But the broader end of the market today, not doing well.
4 days of gains for the broader markets are taking a bit of a pause here, Vinny. And yeah, of course, the expiry-related jitters as well. Of course, you can't call it jitters, of course. It's some volatility as expected on the monthly expiry. And the Nifty, after hitting highs of in excess of 25,400 in today's session, has cooled off slightly from the highs of the day, still holding on to gains of 120 points. And as Vinny highlighted, it is the broader markets that are seeing some bit of subdued moves in today's session, of course, after 4 days of gains. So the mid-cap index is down almost around 200 plus points from the highs of the day. The small-cap index too, currently at the day's low, having slipped into the red, that too has corrected just about 100 points from the highs of the day as well. Some of the movers though in the broader markets in today's session, the one that I would particularly want to highlight is MobiKwik. And if we could get the off day's low graphic on air, and if we could see the recovery that the stock has seen from the lows after the block deal that took place earlier in the day, the stock is now up 12%. To see that the stock had opened 6% lower after the block deal took place, where around the number of shares that were supposed to be traded, and since then the stock has seen a one-way move on the higher side. Mind you, of course, it is a significant underperformer still. The post listing highs of 700 rupees, still at 274, but it is nearing the IPO price of 278 is where MobiKwik currently stands at. So that's one of them. But of course, there are a lot of other movers in the broader markets. Fertilizer shares not doing well. Fact is the top loser on the Nifty 500 today, 5.25% lower. UPL is down 3% as well. And some negative news flow related to RCF, and that too has seen some bit of an impact. And at the bottom of your screens, you can see Reliance Infra. That too is at a 52-week high, Vinny.
Absolutely. But you know, Hurmas, one stock that I was shocked looking at also was Raymond Lifestyle. That is buzzing away in trade, 8-9% uptake, no specific reason as of now that we know of. So Raymond Lifestyle, and other than that, one of these other retail textile plays is Wellspun Living. That is also buzzing in trade. So keep an eye out on these names as well. But let's focus and start the show by talking about plastic pipes. That sector overall is in focus today. Why? We have a note that came in from Motilal Oswal. And to talk to us about what are the details of this note, which stocks is Motilal highlighting, we have Ria joining with us for that. Ria, good morning.
Good morning, Vinny. As you said, today Motilal has come out with a note on the entire pipe sector. Now, they remain bullish on the entire sector. They're expecting core industry growth to accelerate to about a CAGR of 14% over FY24 to 27 versus the 10% growth rate that we saw over the last decade. They've initiated coverage on 3 companies, Supreme Industries, Astral Limited and Prince Pipes, with a buy call on all 3. They believe that these companies are well positioned to gain further market share and deliver healthy earnings going ahead. Coming to Supreme Industries, buy call with a target price of rupees 5,400. They believe that the revenue, EBITDA and adjusted net profit is estimated to grow at a CAGR of 14%, 20% and 23% respectively over FY25 to 28. This growth is to be driven by healthy volume growth of a 13% CAGR and an improving margin profile as well. Coming to Astral, buy call on this one as well with a target price of rupees 1,800. They're expecting the revenue, EBITDA and adjusted net profit to grow at a CAGR of 16%, 17% and 23% respectively over FY25 to 28. And this growth is also to be driven by a volume growth of around 12% CAGR. The last one is Prince Pipes, buy call on this one as well with a target price of rupees 500. The revenue, EBITDA and the adjusted net profit are expected to see a CAGR growth of around 15%, 38% and 73% for the net profit over the next 3 years. And this growth will be due to a lower base and will also be driven by a 12% volume CAGR going ahead.
Okay, thank you so much for that, Ria. Keep an eye out on all those pipe stocks. But let's move on and shift focus to the railway names also. We have Texmaco Rail and Engineering, that's in focus today. Why? Is it surging at rate? One, they've secured an order that's coming on, and it's an international order. 535 crores is what the order is, and it's from Camelco SA, which is one of these international companies. This is to order is for supplying 560 open-top wagons and providing 20-year maintenance for this as well. The deal will include potential expansion to 1,040 more wagons as well. So yes, as of now, the first order is of coming in of 560 top wagons, and then there's a probability that there could be an extension coming in as well. So on the back of this order win, a big order win coming in for the company, we're seeing that the stock is buzzing in trade as of now, holding on to gains of almost 5% in today's trading session.
Interesting there, and a lot of other stocks reacting to order wins as well that were reported last evening. Western Carriers is one of them. That too won an order from Jindal Stainless. That is of a similar quantum as well. So 7% higher on that stock as well, Western Carriers. The stock is up 25% in the last 1 month, still well below its IPO price of 172. That's one of them. And KNR Constructions, the order that it won came during market hours yesterday. The stock ended 9% higher and it was building on to those gains in the initial part of the trading session, but has now given up all of those gains and has now turned flat and has almost slipped into the red as well. But the other stock that was our standout brokerage of the day, and that is Voltas, and Nimesh is here to tell us more on that. Nimesh.
Hi, Majano. The stock hasn't reacted today, but interesting report on Voltas from Avendus Spark. So today they have upgraded the stock to a buy from reduced, and they have a target price of 15.16. They have actually upgraded the stock after 3 long years, and there are a couple of reasons for that. First and foremost, the RSA demand is going to witness a strong growth on the back of low penetration, as well as the higher discretionary spend, which is expected in the second half because of tax benefits. So that's the first big reason. Second is the UPC margins are likely to improve on the back of backward integration, as well as higher utilization of the new facility, as well as price hikes. The third is the JV, which has been a pain point for them, which is the Voltas Beko. That is expected to turn around and actually break even in FY27 according to the Avendus note. And lastly, they expect the order inflow momentum in the project and MEP segment to have bottomed out. So these are the 4 reasons why they've turned constructive, and hence a big upgrade on Voltas to a buy from reduce from Avendus, and they have a target price of 15.16.
Okay, an important one there. Keep an eye out on Voltas as well. So those were the stocks that are buzzing in trade today. On that note, we're actually going to sip into a break, and after the break, we'll come back and discuss what's happening in the world of commodities with Manisha Gupta.
Welcome back. Shifting focus to commodities now. Manisha is here with us to focus on cobalt. Manisha, good morning.
Well, thank you for that. Yes, cobalt is what I'm looking at because after a very long time, we've seen a lot of action come back into this one. And it also is news-based right now. And if you look at the prices itself, we are trading at a 3-month highs. In this year, until time, cobalt prices have gained up by 35%. Well, the news report, the reason that you've seen this spike in the overnight markets is that Congo has extended concentrate export ban for another 3 months. And now this is expected to impact nearly 100,000 tons. Congo has been putting ban from Feb onwards and has extended now for another 3 months is what is bothering the space. It's not just Congo, which is a strong producer. 80% of global cobalt actually comes in from Congo. But it also has to do with China because that controls 80% of refining stage. Also, China also dominates when it comes to battery production or manufacturing using cobalt as well. And that really seems to be making the market slightly jittery right now. When you look at cobalt, it's used in batteries, electrodes, magnet in electrical motors, and also wind turbines and various other things as well. One thing that the street has looked at in last few months is that because the cobalt prices have been very, very volatile, so we've seen competition from nickel-rich material and also lithium iron phosphate. So this is what the markets are looking at. Having said that, the expectation is that 57 to 60% of overall cobalt consumption in battery market will just about continue, and that would support prices going forward from here.
Interesting. I must say the last time I heard about cobalt was when we were in school and studying the periodic table, Vinny. You should remember that, the symbol of CO.
But today Manisha is still twinning with cobalt blue. Manisha, is this intentional that you decided that I will? But okay, that's the word coming in on the commodities front. Thank you so much for that, Manisha, for always joining in with us as well. But let's actually move on and bring in some technical front and technical check coming in. We have Vishal Malkan of malkanviews.com joining in with us for that. Vishal, good morning. Thank you so much for joining in with us. Overall, in terms of markets, what are we watching out for in levels specifically today, given that it's monthly expiry? And going forward also for Nifty, Bank and Nifty, what are we watching out for?
Yeah, good morning. And I think Nifty and Bank Nifty have been moving into a range since last almost a month now. And Nifty has poked out its head around about that 25,300 level, but it needs to close above that well, especially on a weekly closing, which is like Friday closing, that then it could be a good breakout on Nifty. And as far as Bank Nifty is concerned, I think we need to cross 57,000 on a closing level basis. Then only we can see some trend. Otherwise, indices are more or less into a sideways market, and we should be more on stock-specific ideas.
What are those stock-specific ideas, Vishal?
And a couple of stocks which I would like to highlight right now is one of them is BSoft, which has given a breakout about that 440 levels. And I would go with a buy on that with a stop of 430 for targets of 475 and 485 in the next few trading sessions. And the second one would be AB Capital, which is again showing good momentum on daily and weekly charts above that resistance levels of 260. So I'll go with a buy on that with a stop of 262 for targets of 285 and 295.
Okay, Vishal, thank you so much for joining in with us and giving us your views on the market and individual stocks as well. But on that note, we're going to actually step into a very short break. And after the break, we will bring you the latest trends from the real estate sector, specifically on the commercial side. So stay tuned in. Welcome back to Trading Hour on CNBC-TV18. Markets managing to hold on to 25,300 levels, but mid and small cap is seeing a bit of a decline. But let's shift focus and put the spotlight on the real estate sector. And in a recent report, mid-year 2025 report review, that it's showing that India office leasing market, Anarock has found that 2024 was a landmark year for office leasing and even surpassing pre-pandemic highs. Now, to discuss more on commercial real estate side, office leasing space, we have Anuj Puri, who's the chairman at Anarock Property Consultants, along with Vinod Rohira, who is the MD and CEO at K. Corp, joining in with us to talk to us about these recent trends. Mr. Puri, as well as Mr. Rohira, thank you so much for joining with us this morning on the show. Mr. Puri, I'm going to start with you. What are the trends that we're seeing in the first 6 months of 2025? Are they as strong as what we saw coming in 2024? And what is the growth outlook that we have for this year in office leasing, commercial real estate side?
First of all, very good morning to all of you in the studios and to your viewers. 2024, as you rightly said, was a landmark year. It was the best year in office leasing that India had seen since independence. So in the last 75 years, we've not seen this kind of gross leasing activity that has taken place in India. And mind you, office is a bad word if you were to look at the Western economies, Europe or the US, because they're still reeling under the pressure post-pandemic where the employees are still not coming back to work. And India, we are saying is that it was the best ever year in 75 years of a history of independent India. Your question is that how the first 6 months have been for 2025. We believe the 2025 calendar year will surpass the leasing that was done in 2024. There are indications coming in from the GCCs, the global capability centers. And, interestingly, these global capability centers are not only in IT/ITS. They are coming in industrial, engineering, BFSI, pharmaceutical. Nearly 45% of the leasing last year was done by these GCCs. So, it's a fantastic opportunity at this moment in time. My only two concerns are that the vacancy levels have come down dramatically and the built-up supply is not as much as what the demand is coming in. And then perhaps Vinod can throw a little bit of light is that
absolutely
the rents will start to go up. And that is not very nice for the occupiers, given the demand is seeming, much more larger what the existing completed supply of office spaces in India.
Okay, I'm going to throw that question to Mr. Rohira as well. Mr. Rohira, good morning. Mr. Puri is highlighting not enough supply there. There is an increase in terms of demands for commercial real estate. How are you grabbing the opportunity? How fast can we expect development increasing on this front as well? And in terms of rents also, higher rents, we're all worried about that. So commercial real estate side, how do you see that moving?
Okay, first, thanks for having me on your show, Vinny. It's always great to have Anuj, because he has all the data right at his fingertips, but makes life easier for all of us. Commercial real estate, I think I would urge us to look at it at a 5-year window or a 10-year window going forward, right? We are looking at 1 quarter at a time and 2 quarters at a time. I think there have been some tectonic shifts in the way commercial real estate is being looked at. I don't think historical numbers will matter in the next 3, 4, 5 years. There are multiple reasons for this. One is cumulatively, India's GDP is going to contribute towards doubling in the next 5 to 6 years. If we believe in that story, you will see a lot of large domestic companies becoming serious players for competing in global markets, wanting to be seen and heard in global markets, and they will come and grab the best commercial real estate demand in the prime cities. Number 2 is infrastructure is the key and the governments are pushing through the agenda of making sure cities build their infrastructure, and that infrastructure backbone is going to change the demand dynamic for cities that actually deliver infrastructure. Thirdly, with point in rents, we're still average $1 rent per square foot. And I think it's high time that this rent really went up. Even if it goes to $1.50 a square foot, it's still 2 to 3% of their operating costs. We have to understand that no longer are these low-cost contact centers that the GCCs are bringing in. They're actually bringing in the heartbeat of their businesses, which is real business services, cumulatively running the entire operations out of India, and the intellectual capital is sitting here to deliver their businesses. At that point in time, it's about capturing talent, retaining talent, taking the best real estate in the best micro markets possible to retain them and grow their businesses globally. Rent is incidental. So 10, 20, 30 buck rent increase not going to hurt them at all. They are in fact looking at paying higher, creating a far better experiential environment for their offices to capture right talent and then retain that talent and groom them to grow. So in my view, it's a fantastic opportunity for India 2.0 in the commercial space to really build grade A++ global standard office, whether it's for tech companies, GCCs, or for front office CBD in markets where infrastructure is playing out right, and you will see the game completely change in the next 5 years.
Interesting observations there, Vinod. Gentlemen, good morning. Thank you for joining in. Anuj, to you this time around, what are the sectors that are contributing to this? Now, you mentioned the fact that 2025 will outpace what 2024 was, and considering how good 2024 was, which sectors do you expect this to lead this kind of move, particularly because the general trend has been that, okay, IT sector is the one that has been the leader in all of this in terms of leasing office spaces. Do you see a different trend this time around?
It's a very interesting question, and I'll take it from where Vinod left. He used a beautiful word, is that, these largely the American corporates are bringing their heartbeat into India. So, many, many years ago when we started to do office leasing, it used to be, what Vinod called the contact center, or for ease of your viewers understanding, it was the call centers. From the call center, it moved up to BPOs. From BPOs, it moved into software development. From software development, it moved into KPO. What is really today fueling the demand is the R&D. So these corporates are now coming not for cost arbitrage to India, which is what they came in when it was the call center and then BPO. Then they started to move into the talent, software development, KPO, now R&D. So they're purely coming in for the talent in the quantities that they require. Today, ITS is only 35%. The balance 65% is, engineering, new car designs are happening in here. The banking financial services, 23% leasing last year was, from the banking financial services, pharmaceutical companies, industrial manufacturing, who are coming in here for their new designs. They're employing, engineers. The BFSI is employing like chartered accountants. The pharma are employing doctors. As a result of it, what's happening also on the real estate is that the quality of real estate for the office is going up because these are highly qualified people. And also the office, which was moving to the periphery of the city, and corporates will, put in people in a bus and take them in the morning and make them work there and then bring them in the evening. That all is changing because all these knowledgeable talent is saying we need office space within the CBD, not necessarily on the periphery of the city.
To Vinod on this one, Anuj, in your first question, you mentioned about the concern that you have is that the fall in vacancies as well. Vinod, do you share that sentiment? What are the current observations that you are witnessing right now at Mindspace? Has there been a drop in vacancies? And more importantly, with the change in the Special Economic Zone bill that has come in for commercial real estate, does that lead to a further decline? What is the current observations on ground?
So just to lead from where Anuj left out, he's absolutely bang on. They are looking only at quality real estate. And when you say quality real estate, is not just the building with its glass facade and a nice lobby. They are looking at services, infrastructure, the experience that you can provide, the cumulative handling of the asset management piece, the services management piece. All of that is extremely critical. So if you have a strata title building and it's not well kept and the toilets are not right, you ask for 50% of the rent down, the guy's not going to come and take the space. So what that is doing is grade A++ office, the vacancies are single digit, and they're going to further decline because there is no quality supply of grade A++. At the same time, on the macro level, you will continue to see vacancies because they are either grade B buildings or they're strata title buildings or they're buildings that have finished their age for the provision of what kind of businesses space is looking at right now. So you will continue to see a overhang of vacancy, but really if you deep dive, to the profile of customers that you're really catering to, those guys are not going to go to those buildings even for free. So that's really what's going on. So if you look at grade A plus vacancies, they're in single digits and going down. New supply is coming. Predominantly, grade A supply is very, very diminished, and there are very few players who are bringing in quality supply. So that is going to contribute to how the market is going to shape. So the rents will firm up, certainly, and they will, in good quadrants where good assets are there, rents will not matter. Customers will pay you the rent.
Sure. Mr. Puri, just a quick word in terms of geographies. Where are you finding too much of this demand-supply mismatch? Obviously, we have seen Hyderabad also picking up pace in terms of GCCs. So are we going to be expecting more commercial projects there? Bangalore, Mumbai, what are we looking out for here?
Very interesting. It is the southern Indian cities. They are definitely, way ahead of the rest of India. So it is Bangalore, which is nearly 1/3 of the leasing activity across India is coming into Bangalore, followed by Hyderabad and Chennai. So, between the three of them, they take the major chunk of the leasing activity. Then the other cities like NCR, Pune, Mumbai really follow. So clearly, hands down, South India play.
All right, gentlemen, Anuj, Vinod, thank you so much for sparing time and joining us on this very insightful conversation that we have had on commercial real estate. And we look forward to having you at the time when 2025 surpasses 2024's trends, as Anuj was highlighting. Thank you so much for joining in. We take a short break here on Trading Hour, but just as we do that, remember to tune in to the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impacts on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV18 Prime at noon for the Global Reset, at 1 p.m. for the Big C, and the Global Lens at 8:30 p.m. Short break, back on the other side. Welcome back. Still 120 points higher on the Nifty. 25,360 or 350 and thereabouts is where the index currently stands. The broader markets, though, there are plenty of stock-specific movers. Just before we go to Ekta, Fact was the one that we highlighted at the start of the show. It's extended its losses slightly, 6.5% lower now on that stock at the lowest point of the day. The other one is Walk Hard, 5.75% lower. Of course, it's been a big mover over the last 12 months. So seeing some bit of profit booking there is Walk Hard, and has been a significant correction though from the highs of the day as well. Speaking of pharma, Ekta is here with us, but this time the insights are on Dr. Reddy's after a negative note from Citi. Ekta.
Well, yes, Citi has written on Dr. Reddy's. They have a sell call. Target price is cut to 990 versus 1040. According to them, a deep dive on the Canadian GLP-1 market suggests street expectations need to be tempered. The timely approvals going forward will be a key to monitor given the past misses on complex approvals. A decline in Revlimid sales and related PLI to result in a drag of around $750 to $780 million in terms of EBITDA, and the EBITDA impact would be difficult to offset supply of the remaining quantity of Revlimid, which may help the next 2 quarters look strong.
Okay, that's the word coming in on Dr. Reddy's right now from Citi. The stock is trading almost near the day's lowest point, down 2% almost in today's trading session. But thank you so much for that, Ekta. On that note, we'll slip into a very short break. Up next, we'll discuss market fundamentals with Chakri Lokpriya from LGT Wealth India. Welcome back to Trading Hour on CNBC-TV18. Now we have Chakri Lokpriya, who is the Chief Investment Officer of Equities at LGT Wealth, joining in with us to talk to us about the market fundamentals. What are the sectors that he's looking at right now? Chakri, good afternoon. Good morning, actually. Thank you so much for joining in with us on the show. Markets have seen a bit of a run-up this week. How are you seeing it in terms of valuations right now? Is it a good time to enter the markets right now? And if yes, what pockets are you looking at?
Good morning, and thanks for having me. In terms of the market, we believe that it does offer fairly sensible valuation entry points. It hardly trades at about 20-21 times, which is a very reasonable number in the context of the growth. And it's clearly that after all the estimates have been cut, still the market earnings are likely to grow between 10-12%. And even if it grows into that earnings, still that offers sufficient upside.
Chakri, good morning. Thank you for joining in. On the cusp of another earnings season, you're mentioning that earnings recovery could start in another couple of quarters. So it would be fair to say that you should keep your expectations tempered down for the current quarter as well, because a lot of people anticipate that this year, FY26, would be a lot better compared to last year, considering the fact that there'll be a low base.
Good morning. No, that's a good question. In terms of what has happened is, as we all know, RBI has done a very good job in cutting rates and therefore created a base, not just cutting rates, but also provisioning norms for the banks, injecting liquidity. All these good things have brought down and bringing down rather the cost of funds. This will help either both the corporate, the consumer, as well as the government to start spending. So for them but the tariff situation is still pending. So as companies gain more clarity, they would firm up their plans. That's the reason we believe that an earnings recovery is probably at least another quarter or two until the tariff clarity emerges.
Chakri, I want to understand your thoughts coming in also on these defense names. We have seen the run-up, but there is a lot that's happening on the defense side. And, just yesterday, the NATO alliance also came in with an announcement of increasing the spending towards defense. Do you think defense is something as a story that will continue, given that the run-up is already there? Valuations seem a bit more higher. Is that a play that you would look at?
No, you're absolutely right about defense. If you recall, maybe about 3 years ago, nobody talked about it much. There were one or two companies. Today, the face of defense in itself has changed. Defense involves not just making tanks and guns and missiles, but also involves a huge amount of technology. And India has done a good job in using those technologies in making anti-drone, anti-missile technologies. And now with NATO joining, saying that 5% of NATO's GDP is a very big number. And India, actually, thanks to the government, is positioned well in the last few years, Make in India. Number of companies have emerged. Today, there's a lot more companies which are growing in that space. Therefore, I believe that still it offers a great investment opportunity.
Still a great investment opportunity, even after the kind of run-up that you've had. Chakri, I was just reading a report on the pipe sector that has come out today from a domestic brokerage house, and they're mentioning that there are 3 companies that are poised for very significant growth over the next 3 years. Would pipes be an ideal real estate proxy to play as a theme? Or would you look at some of the other themes as a real estate proxy, be it cement or be it some of the other sectors?
Pipes and cement, both are real estate proxies. If you take pipes as a sector, it benefits now from real estate and also from agriculture and infrastructure spending. Now, companies like Supreme and Astral are leaders, and they vie for volumes versus margins. That's always been the case in this sector. And right now, what has happened is, with oil prices still on a year, despite the volatility, oil prices are down about 10% year over year. And against this backdrop, their main raw material, which is the PVC, UPVC, which are oil linked, and therefore they would have those not only inventory kind of benefits, they'll also have margin benefits in pricing their products. So this combined with the uptick in real estate infra spending will place Supreme, Astral, Finolex Industries, all these companies in great shape. As far as cement, yes, it is now between Ultratech and Ambuja, both market leaders, both are extremely well placed.
And recently you had the Adani's talking about further increasing the capacity of their cement companies. So I think therefore they'll be volume led and less price led, both great opportunities.
Chakri, what are your thoughts coming in on the CDMO players as well, right? Because now that's become a big part in India. We know CDMO players, the benefits that will come in for them as well. Anything you're looking on that front, or overall in the pharma pack you're looking at maybe other segments?
Pharma as an overall pack still looks okay, but given that we are on the cusp of a tariff announcement, it's supposed to be sometime in July. If that happens, we'll have greater clarity on what are the tariffs and therefore what will be the impact. Right now, the market is assuming a 10% tariff, which was announced 3 months ago, and based on that, we'll have a 4-5% cut. Now, therefore, if that is true, that is the 10% number doesn't change, then many of the frontline companies like Sun, Lupin, they all look good. On the other hand, CDMO is a far more involved space, growing space, higher margin. But again, we'll have to wait for the tariff impact, and therefore I'll wait and watch.
In wait and watch mode is Chakri on the pharma sector ahead of the impending tariff announcements from the Trump administration. Chakri, thank you so much for sparing time and joining us today. Looking forward to having you more often on the show. Chakri Lokpriya there with his views on the markets and on the sectoral preferences as well. By the way, flashes on your screen, HDFC Bank and PhonePe have partnered to launch a co-branded credit card. Mind you, HDFC Bank is at a record high in today's trading session, and PhonePe, of course, headed towards Dalal Street sooner or later. But just before we take that break, an update on the HDB Financial IPO, second day today. The NII portion is fully subscribed as we speak. The overall issue 2 is now nearing the 60% subscription mark. We'll take a short break. Just before we do that, here's some good news for our viewers. India's business news leader is now just a click away, and that is, of course, CNBC-TV18's all-new app, where you get business news updates, in-depth articles, and breaking news stories right at your fingertips. You can download the app from the Apple Store or the Google Play Store, or even scan the QR code that comes up on your screen to download the app. Take a short break. Back on the other side. Welcome back. And Cummins India, some flashes on your screen. They've launched the battery energy storage systems for India's clean energy transition. Some developments there for Cummins India. The stock at the highest point of the day. What is also doing well for itself today is Electronic Smart, 7% higher on that stock. And some of the other movers on the downside, though, is Shriram Properties is one of them, 4.5% lower in today's session. And Vero Infra, one of the movers in earlier this week after that order win, is also down 4% in today's session. And Credo Brands, the shareholder lock-in ended this week, and that too continues to grind lower, 4% lower on that stock as well. So the index continues to remain 90 to 100 points higher, doing fairly well for itself. But just as we wind down on this edition of Trading Hour, listen into some bites from Vikas Kumar Jain, the India strategist and head of India research at CLSA, and listen into what he had to say. Vinny and I take your leave. Thank you so much for watching. Halftime report on the other side.
The problem is where expectations are today. Of the NSE 500 stocks where there is enough coverage, more than half of the stocks expect earnings growth to be over 20% CAGR over the next 2 years. More than half, at a time when nominal GDP growth may struggle to be even 10%. So that, to me, is possibly quite optimistic expectations. So from a bottom-up perspective, my worry is that earnings cut might very well continue. So what we are seeing is not really any big, strong news flow to drive a massive rally in the market. So we might be in a range-bound market like we've been for the last 12 months or so. We have gone overweight on IT. The logic for that is incrementally, the triggers are likely to be more based out of foreign markets. That global trade is now settling down. Perhaps the US market is not looking that bad. And all of that will give confidence for IT companies in terms of the commentary that they give. And that commentary was the one big problem when they last reported results in April. I think with that commentary becoming a little bit more confident and the stocks have come off, valuations are not that extended like they were a few months ago. What I see incrementally, and this is our note on earnings today, where materials is expected to be one sector to be a big contributor of earnings growth because both metals, cement, and some of the other places in materials are possibly going to come off on see EBITDA, unit EBITDA expansion, and also because some of it was depressed at the starting base, and that should possibly help. Maybe we will look at a better entry point to come back into that space. An expensive market like India, a foreign investor, when looking at earnings being cut, markets being expensive, and the narrative not really being completely in India favor like it was in 2024, there is no desperation for them to add money out of turn of foreign to India, which is the big fundamental change that we have seen. And that's where now that we have the TINA factor of India is getting challenged, they might look at investing in other markets as well. So there is no big desperation for them to put more and more money immediately into India.
Heavyweights inch up as the fears of a Middle East conflict recede and trade comes back into focus. Energy and metals gain while realty and pharma drags.
State Bank of India has appointed 6 investment bankers to manage a planned 25,000 crore QIP that will help augment its capital base for growth. This move comes on the back of RBI's big liquidity push for credit.
There's a block deal rush waiting with big trades seen in PB Fintech, Coforge and Delivery, as well as one MobiKwik aggregating to over 1,700 crore rupees. The flurry comes ahead of the start of first quarter earnings season.
There has been a dip in IT services jobs lately, and some of this may be attributed to the AI effect, but experts say the jury is still out on whether AI will cut or create jobs. Meanwhile, entry-level hiring has slumped. Seniors with AI ML expertise are in big demand. Hello and welcome to Halftime Report, live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra and with me is Mangalam Malu. Well, it's turning out to be a session where we are seeing steady gains come in for the market because of the kind of geopolitical risk that has eased. So we have the Nifty, which is up around 0.4%, up around 100 odd points, but at that 25,350 level, so sustaining that. We have the Bank Nifty, which is doing well, so up around 0.3% currently for the Bank Nifty. And the mid-caps could be wanting a little more, but if you look at it on a week-to-date basis, it hasn't done badly, in fact, outperformed the Nifty. So the mid-cap index on a week-to-date basis is up around 1.5% as compared to the Nifty 50, which is up around 0.9%. But overall, steady day, even keel for the advanced decline.
Even keel for the advanced decline, Ekta. You know, what's interesting is that it is the June series expiry today, and the Nifty is put on about 500 points for the June series, making it the 4th consecutive series of gains. What happens in July is something that we'll be tracking very closely, largely because I don't remember the last time we made 5 consecutive series gains. It's been a long time since then. And each of the July series that we've seen over the last 5 or 6 years has been on the positive side. So after having added around, 5 series of gains, does that continue into July or not is the question. Nifty holding around the 25,350 mark, which is a 2025 high. Where does the Nifty go from here? The big onus of that lies on the Nifty Bank, and a large part of the Nifty Bank, where that goes, depends on what SBI does. And that exactly is the top story that we're tracking this afternoon. The SBI has appointed 6 investment banks for a proposed 25,000 crore rupees QIP. Ritu joins in with more details on this one. Ritu.
Well, Mangalam, that's right. SBI has appointed 6 merchant bankers for this mega 25,000 crore rupee proposed share sale through a qualified institutional placement or QIP. And we've been given to understand that the 6 bankers that have been appointed include HSBC, Citi, Kotak, Morgan Stanley, ICICI Securities and SBI Capital Markets after, of course, its board had already approved this equity fundraise in a meeting last month. Now, while the board approval for this QIP is valid for 12 months, our sources in State Bank of India indicate that the timing of the QIP will very much depend on the market conditions. Now, keep in mind, this is not exactly growth capital for the bank. We understand that the primary objective of this fundraise is to really augment SBI's capital base. Keep in mind, as far as the CET1 ratio is concerned for SBI, it is among the lowest in its public sector banking peers. And the idea, therefore, is to cushion that CET base. As of now, SBI's CET1 ratio stands at 10.81% and its total capital adequacy at 14.25%. Now, the sources we spoke to in State Bank of India indicated that the bank's internal target is to get its CET1 ratio to 12% and the total capital adequacy to 15% by March 27, which is where this fundraise, of course, is going to help. Also, if you remember, SBI is going to get about 8,889 crores from the sale of its stake in Yes Bank. And then, of course, there is that proposed NSE IPO, which, if and when it happens, will also help SBI garner more capital. Also keep in mind, this 25,000 crore QIP, if it goes through, it will be the first share sale by SBI in nearly 8 years. The last one was in 2017 for 15,000 crores, and it will be one of the largest such share sales that we'll see through a QIP.
Okay, all right, Ritu, thanks very much for that. So that's State Bank of India, the big news today. But let's now focus on Voltas, which is in focus as Avendus Spark has upgraded the stock to a buy. Nimish is here with more details on that, Nimish.
Right, so the stock is not reacting, but an interesting upgrade on Voltas from Avendus Spark. After 3 years, they've upgraded the stock to a buy from reduce. and they have a target price of 1516. Now, a couple of reasons why they've upgraded the stock. The first is the RSE demand to witness strong growth on back of low penetration, as well as higher discretionary spends, especially in the second half of this year on the back of tax cuts and everything. So that's going to be a first big trigger for Voltas to do well. Second, the UPC margins are set to improve on the back of backward integration, as well as higher utilization of their new plant, as well as price increase. Third, the JV, which is the Voltas Beko JV, that's been a pain point for the company, and that Avendus believes is likely to see a bit of a turnaround and achieve a break-even in FY27. And lastly, they expect the order inflow momentum in the project and MEP segment has bottomed out. So these are the four reasons why they've turned constructive, and hence a double upgrade to a buy from Avendus, and now they have a target price in Voltas of 1516.
1516 is the target. Nimesh, thanks a lot for that. The stock mildly in the green in today's trading session, and otherwise underperforming mid-cap. And we'll take a short break, come back, focus on a bunch of stocks which are on our radar. Plastic pipes, we'll tell you what's exactly happening out there. Supreme Industries, Astral, Prince Pipes, all of them in focus.
Welcome back. Well, for the markets, we have the Bank Nifty, which is definitely picking up a little more pace as we speak. So we do have a couple of stocks which are managing to gain. So HDFC Bank would be case in point, up around 1.2%. Axis is doing well, so up around 1.3% currently for Axis. And ICICI also contributing on the upside, up around 0.8%. To watch out for a couple of these pharmaceutical stocks. Citi has a sell call on Dr. Reddy's. That stock is down around 1.8%. But giving it company is Sun Pharma, which is down around 1% as well. So do watch out for a couple of these counters. But plastic pipe stocks are in focus after Motilal Oswal's note. Ria is here with more details on this. Ria. Okay, well, maybe we'll just get back to Ria in just a bit, but there is a Motilal Oswal note on the entire pipe segment.
We'll just try and get back to Ria, but in the meanwhile...
I think Ria is back with us.
You can hear us, right?
Yes, I can hear you.
I think there was a problem in the plastic pipe that connected to you, but now that we have that connected, tell us, what is Motilal Oswal saying?
Well, yes, Mangalam, today Motilal Oswal has come out with a note on the entire pipe sector. Now, they believe that core industry growth can accelerate to a CAGR of 14% over FY24 to 27, and this is versus the 10% growth that we saw over the last decade. On the back of this, they've initiated coverage on 3 companies, Supreme Industries, Astral Pipes, as well as Prince Pipes, with a buy call on all 3 of these stocks. They believe that these companies are well positioned to gain further market share and deliver healthy earnings going ahead. Coming to Supreme Industries first, they have a buy call on this one with a target price of rupees 5,400. They are estimating that revenue, EBITDA and net profit is expected to grow at a CAGR of 14%, 20% and 23% over the next 3 years. And this growth is going to be driven by healthy volume growth of around 13% CAGR and an improving margin profile as well. For Astral Pipes, buy call on this one as well with a target price of rupees 1,800. Revenue, EBITDA and net profit for Astral are expected to clock a CAGR of 16%, 17% and 23% over the next 3 years respectively, and this growth will also be driven by volume growth of a 12% CAGR over the next 3 years. The last one is Prince Pipes, buy call on the stock as well with a target price of rupees 500. Revenue, EBITDA and net profit for this company are expected to see a CAGR growth of 15%, 38% and 73% over the next 3 years, and this high growth will be due to a lower base in the last few years and will also be driven by a 12% volume CAGR going ahead.
All right, we take that point. Thanks a lot for that. So that explains why some of these stocks, Prince Pipes in particular, are doing well in today's trading session. Meanwhile, you know, the Nifty Bank, don't lose sight of that. While we were talking about the pipe space, the Nifty Bank saw a vertical up move, and as a result of which the Nifty went back closer to that 25,400 mark. The Nifty Bank actually crossed its earlier 52-week high as well. So earlier 52-week high on the Nifty Bank, or a record high on the Nifty Bank, was 57,050, and today's high is just about 25 points ahead of that. A wee bit of selling from record high levels, but that's par for the course, still holding just around that 57,000 mark, and that's actually taken the Nifty higher once again, near 25,400. But amidst all of this, there is one stock which is underperforming in today's trading session, and that's United Spirits. Why is that? Because we've got a note coming in from Kotak this morning, and they have actually cut their EPS estimates and target price on the stock as well. Why is that? Because it's the first brokerage that is written post the Maharashtra duty hike and the impact on the EPS. They've said that post the Maharashtra duty hike, there has been a 30 to 45% increase in the retail price for popular, lower prestige and mid-prestige segments. How much do they account for in their overall sales in Maharashtra in particular? 13% of overall volume and 11% of sales value. Maharashtra is an important state for them, accounts for nearly 16% of revenue, and the second highest in terms of revenue and EBITDA. So the remaining 5% comes in from prestige and above, upper premium that is, where there hasn't been a much of a price change. It's been anywhere between 0 to 8%, as you can see on your screens. The important part, however, is that it reintroduces unpredictability around policy, and that is one of the risks that we're seeing with all these liquor stocks. So basis all of this that has happened, they've cut their FY26 to FY28 EPS estimates by 3 to 6%, and their target price now stands lower by about 100 odd points, or 100 rupees. The only 3 things we have to watch out for: new excise policy in Delhi, Bihar elections in November 2025, does Bihar not become a dry state again? And finally, the formal implementation of the UK Free Trade Agreement. That's why United Spirits lower. Okay, that's on United Spirits, but you're also watching Nykaa. Yes, Nykaa held its investor day today, and it's going on right now, but what we have right now is the 160 slide presentation deck that they've uploaded to the exchanges. The stock has seen a smidge lower from where it was in the earlier part of the morning. But remember, it has seen a decent rally all of this month and all of this year. What are they saying in terms of macros? One, the beauty and fashion market is likely to grow from $23 billion in FY25 to about $70 to $75 billion. Remember, it was about $6 billion in FY20. What does this market comprise of? The beauty market, the online beauty market, turns from $5 billion right now to $14 to $15 billion by FY30. The online fashion market has a much bigger total addressable market, increases from $18 billion currently to about $55 to $60 billion, led by premium fashion market or premium online fashion market, which is expected to triple by 2030. Now, for the here and now, there are three important things that they've spoken about. One is that the Gen Z will be driving consumer spend. Beauty and personal care, fashion accessories, footwear, anywhere between 44 to 50% of the spends right now are driven by Gen Z, so that will be their focus area. Second part is quick commerce, which is doing well for the industry, the consumer industry at large. Nykaa will foray in there as well by launching Nykaa Now, which will fulfill beauty and personal care orders between 30 to 120 minutes. They've launched this in 7 cities, so that's one offering that they're making. Secondly, their own brands, House of Nykaa that they call it, reported about 2,100 crores in gross merchandise value across 12 brands. They believe this is a number that can compound at 30% and reach 6,000 crores by FY30. And finally, we do have the beauty business, which rather the fashion business, which the street was circumspect about its growth. They expect that the fashion business can be 4 to 5 times by FY30, and they have some exciting launches in the second half of this year. On the operational profitability front, they believe that this business will break even in FY26, have mid-single digit sort of margins by FY28, and sustainable margins would be close to around 10% going forward. So positive commentary coming in. The stock's already run up. Let's see delivery, whether the company goes ahead and delivers on all those parameters.
Okay, all right, Mangalam, thanks very much for that. So that's on United Spirits as well as Nykaa's. Nykaa's stock is down around 0.4% at this point in time. The Investor Day is on and we'll keep getting you more updates on that. The Bank Nifty is making good strides, so up around 0.7% at the high point of the day, following the Nifty in terms of gains today. Advanced decline ratio holding at around 1:1. We'll take a short break. We'll dig deeper into the markets and the technicals. Aditya Agarwal will join in to tell us what he's strategizing this Thursday. Stay tuned.
Welcome back. 150 points on the Nifty right now. A good looking screen, at least on the frontline indices. The mid-cap index, which was marginally in the red when we started the show, is currently moved back into the green. The advanced decline ratio still in favor of declines, but you do have them at an even keel. So it's June series expiry today. It's an important day to look at how the Nifty has come around in this series so far. It's moving. It's 550 points higher. So March 1,050 points, April 655 points, May nearly 600 points. So after nearly 2,200 points, the Nifty has added another 550 points in this month itself. Where does it go from here is the big question. Has the Nifty made more than 5 consecutive series of gains? Not too far ago. In fact, we have the data between Feb and September 2024. The Nifty gained for 8 straight series. So is there room for more? Is something that we'll be watching out for. We're still a little away from the record high on the Nifty. The broader markets slightly underperforming in today's trading session, but they've done well all through this week. The small cap index absolutely flat, as is the mid cap index. And you look at the advanced decline as well. For with the green line being on top for most part of the day, now it's come slightly below the red line, but still at an even keel. Where does the expiry happen? We have the 25,400 call and the 25,350 put. Both of them fairly active. 25,350 put, premium of 43 rupees. 25,400 call, that's the one that should come up for you. That has a premium of almost 65 rupees. So those who are writing these options, they expect the Nifty expiry to be in the range of 25,300 at the lower level to 25,450 at the upper level. Now, if the Nifty sustains above 25,450 for a fair amount of time, then maybe these call writers will have to run for cover as well. The key to track is the Nifty Bank. It hit a fresh record high today, 57,076, as against the previous high of 57,050. Whether it sustains above that level or not, once more, is something that we'll track, and that will determine the course of whether Nifty goes on expiry day today.
Okay, all right, Mangalam. Thanks very much for that. So that's on the FNOQs. We have Aditya Agarwal joining in to tell us what he's strategizing this Thursday. Aditya, welcome to the show. Well, the Nifty is striding ahead, 25,400. What are the levels that you're watching out for? And similarly for the Bank Nifty, which is up 328 points now.
Good afternoon, Ekta. Good afternoon, Mangalam. Thanks for having the show. Clearly, it's more of an up move that we are witnessing on both the indices, especially led by the Bank Nifty. And if you clearly take a look at the way markets have been behaving for past few trading sessions, till the time Bank Nifty was participating, we didn't see this kind of an up move on the Nifty as well. Now, today, when Bank Nifty is actually on the go, and you're witnessing participation from large cap private sector banks, you're witnessing that kind of an up move on the Nifty as well. Having said that, 24,400 is something that, 25,400 is something that I'll be eyeing closely on the Nifty, because that is where the most option writing is happening. And today being an expiry day, markets could turn a little volatile, but the moment market starts to trade above 25,400, I think Nifty definitely has room another 300 to 400 points on the upside. So my sense is this bullish undertone that we're witnessing on the Nifty and the Bank Nifty is likely to continue in today's trading session. And as we move ahead, Ekta, towards the fag end of the session today, my sense is markets might just scale past 25,400 in trade today itself and inch closer to about that 25,500 mark and 25,600 mark. And for this, I think Bank Nifty will be the key trigger point. And Bank Nifty from here on is poised to hit new all-time highs. It almost did in trade today. My sense is it will inch higher from here on, and 58,000 to about 59,000 is something that should be on the radar. And especially private sector banks, I think, will lead the rally from here on.
All right, 58 to 59,000 for the Nifty Bank is what you're pegging right now. Let me just ask you, 2,800 points over the last 4 series for the Nifty. Where do you see, July series headed? And do you think there is case for the Nifty to hit an all-time high in the July series?
New all-time high, Mangalam, maybe a little still some distance away. I don't think July series will see a new all-time high. But yes, the positive momentum that we're witnessing in June series is likely to continue in the July series as well. Could be more of an up move led by the banking, as I mentioned. So closer to about, I think, 25,800, 25,900 is where Bank Nifty should settle down in the July series is what I'm looking at. The undertone will remain bullish, but I don't see markets hitting a new all-time high in the July series. Or for that matter, I think so August series, market will not hit an all-time high that early. It will take some time for markets to hit an all-time high.
All right. What about individual stocks? What do you have on your list today?
So I've got a couple of buy recommendations. One has to be from the banking space since I'm quite upbeat on the banks. So Axis Bank is something, Mangala, which is looking interesting to me. For a target of 1280, I'll be a buyer here to place a stop loss somewhere around 1200 on the downside. I think Axis Bank is one of the strongest within the private sector banks as of now, post HDFC. Second is ICICI Prudential. I think there is a lot of room in the insurance space, and this entire gamut of stocks do look interesting. HDFC Life has hit a new all-time high today. So ICICI Prudential is on my buy list for a target of 690 on the upside with a stop loss at 624 on the downside. I'll be a buyer here.
Okay, all right, Aditya, we're going to let you go on that note. Thanks very much for joining in and speaking with us. Well, we need to take a short break, but that is a CNBC TV18 exclusive. We'll just get to that in a bit on the insurance space and lapses around health claims of 8 insurance companies that were inspected. We'll do one thing, we'll take a short break. On the other side, Manisha Gupta will join in. She has with her Kunal Shah of Nirmal Bang Securities to talk about the commodity space. Stay tuned.
Welcome back, and joining us on the show now to talk about commodities is Kunal Shah from Nirmal Bang Securities. Kunal, hi, good to have you. I want to start with silver first because while the overnight markets have been good and we've seen crude oil gain, gold gain, many of the base metal prices also gain, but the best of the gains perhaps came in for silver.
Yes, there are two commodities which are fundamentally very attractive. One of them is silver. It is having a 8% deficit. The overall from last 3 years, this deficit is being rolled over, and now it is actually being felt in the market because we've been studying about the scrap supply, and that is significantly getting reduced from the domestic market as well as in international market. So I think silver is about to break out, and it is going to move up quite fast from here. Second, most important reason for this overall upside in commodities is the dovish. So yesterday, for the first time, we've heard from the Fed chairman, Mr. Powell, that now they may have to, cut the rate going forward in future. And Mr. Donald Trump is after Fed that they may change the Fed chairman going forward. So I think the next big move, we've seen a geopolitical event, but now the next big move in the commodity complex is going to come from the actions by the Federal Reserve, which will eventually lead to a sharp depreciation in the value of dollar, and that will lead to a quite bullish sentiment in the overall commodity segment. So silver looks very promising. It is heading towards 1,15,000, 1,20,000 in next two to 3 months period. One should go long at present levels, 1,06,000 odd. It is trading right now, and 1,15,000 first target, 1,20,000 will be my second target going forward.
Kunal, when you mentioned that you're looking at a very huge depreciation coming in for the dollar index, we're down by 9% already for this year. What kind of levels are you looking at?
I think we are heading towards 94 to 93 in next 3 months period, because remember, Fed has not rolled over its debt. They have to service their debt. And now we are at that period where with the 4.5% interest rate, it is going to be very difficult for them to service their debt and the kind of amount which is building up. On the other hand, they are talking about spending cuts, which eventually will lead to more deficit and more debt. So already Federal Reserve's debt have hit to $37 trillion. 1.5 years back, this was $35 trillion. In 1.5 years, the debt has risen to $37 trillion. So they cannot keep interest rate at an elevated level, irrespective of what is going to happen to inflation. I think the inflation mandate of 2% is just given for the sake of numbers. At some point, they will abruptly twist their and tweak their monetary policy the way we saw in 2019, where we saw 150, 200 basis point of rate cut immediately. So I'm expecting 50 to 75 basis of rate cut in next 2 months, 3 months, which is going to be very bullish for commodities.
Kunal, coming in for gold as well, and we're looking at a very solid consolidation coming in for this one. 3,500, 3,400 rather continues to be a resistance, but on the lower side as well, 3,250 seems to be a very strong support.
Yes, so gold's fundamentals are not bearish, but the alpha is not going to be made in gold, because gold is already outperformed and discounted. As per our understanding, it is discounted 50 basis rate cut. So I'm not bullish in gold, and I don't expect gold to move up sharply in the shorter term. $3,450, $3,500 seem to be the maximum upside. So in a percentage term, if you ask me how much upside I'm expecting, maximum 3 to 4% upside in next 2-3 months. On other hand, silver looks quite interesting because of its very bullish fundamental. So this year, the major catalyst for gold is the central bank purchase. I'm not expecting central bank to buy 1,000 tons of gold in 2025. That number will be at least 250 to 300 tons lower than the average of last 3 years, which was 1,000 tons.
You've talked about the higher side, Kunal, where you expect the gold prices to gain up between 3 to 4%. But on the downside, where do you see supports come in?
I think $3,200 or maximum $3,100 should be the good support. There is not a single evidence which indicates that gold is going to crash and go to. So I see, a lot of reports have come lately. Whenever you see correction, people talk about 2,800, 2,500. I don't think so that is going to come. $3,100 seems to be the good bottom, and that will be a reasonable level to re-enter long position, rather than entering it right now. So I'm expecting maximum $3,200 to $3,100. That's the downside.
Kunal, come in and also on case of metals, because overnight has been a stronger gain for these as well. I mean, I remember our last conversation when you said copper, aluminum, zinc, perhaps in that stacking is where you see many of these metal prices gain. It's been kind of quiet here. Are you still buying?
It's looking very bullish. There is no second thought. We have entered in a multipolar world. So what is going to happen, as per our understanding, the excess capacity in China in smelting in all of these metals is going to get weed off going forward, no matter what happens. Because if you see, because of the trade war and everything which has been going on right now, which has been a narrative right now in this multipolar world, there is no space for the excess capacity. They have to shut it off. You are going to see steel capacity in China definitely going to go down. Chinese copper smelting capacity going to go down. And they will try to focus building their more and reserve of concentrate. If you look at China's copper concentrate import, 5 lakh tons. So the copper imports of concentrate is going up. But because of the higher smelting capacity available in China, the prices are not able to shoot up. So like what happened in steel, even in base metals, the capacities, smelting capacities are going to go down, and that will lead to a sharp upside in the prices of base metals. So raw materials are the strategic assets for all big economies right now. They, in order to grow further in this multipolar world, they need to have a hold on the raw material in order to grow going forward. So metals like copper, silver, which are having a major green energy transition metals. So these metals are going to go up quite significantly. We've seen recently there has been a talk that copper is new gold, and I completely agree with that, because the supply side from the top miners of copper in South America, it is being weakening. The quality of ores going down. So copper, number one, second, aluminum, third, zinc. This continues to remain our top pick, and I'm very bullish on industrial metals.
Okay. All right, Manisha, thanks very much for joining in and giving us all of that perspective on the commodity space. Thanks. So that's what is taking place there. We need to take a short break, but remember to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back. Well, for the Bank Nifty holding up with a gain of around 0.5%, we have the Nifty also at around 25,400, so steady gains going there. Advanced decline ratio, like we mentioned, even keel. UPL is your top loser on the Nifty, so down around 2% currently for UPL. And Shree Cement is really, firm in today's trade, so up around 3% currently for Shree Cement, along with Adani Ports, which is following suit. So that stock is up around 2.6%. Overall, good texture for the markets, and we have the mid caps also just about holding their head above the water, so up around 0.12% currently for the mid cap index. But let's move forward now. Sources tell CNBC-TV18 that the IRDAI has found lapses around health claims of 8 insurance companies. Yash is here with more details. Yash.
Well, that's correct. So the insurance regulator, IRDAI, has been conducting inspections. The first lot of these inspections happened on 8 insurance companies. Out of these, 4 were standalone health insurance companies and 4 were multi-line insurance companies. What we've been gathering from our sources is that lapses have been found with respect to all these 8 insurance companies which were expected. I'll just give you the names of these 8 companies. These include New India Assurance, Tata AIG, ICICI Lombard, HDFC Ergo, as well as in terms of the standalone health insurance companies, these include Star Health Insurance, Niva Bupa, Care Health Insurance, as far as these companies which are inspected are concerned. Now, if you speak about the lapses, what I've been given to understand from our sources is that they are in different degrees in terms of ignorable and non-ignorable lapses against these companies. The specific segments in which lapses have been found, first one is with respect to non-compliance of the Master Health Circular. The second one is with respect to unnecessary deductions, claim rejections, delayed claim settlement. So these are the areas where lapses have been found against these 8 companies. As I said, some companies, the level and the degree of the lapses and problems are ignorable. At some places they are not, and where they are found to be not ignorable, IRDA is likely to take its action in the form of either penalty or asking the insurance companies to return money back to the policyholder along with interest. Now, one very important point is that after these lapses are found with these 8 companies, IRDAI has decided to expand the scope of its investigation and now inspect all general as well as standalone health insurance companies and not just these 8 companies. So that will be the action that will follow in the coming days to come. Just to give you some numbers, so one can understand in terms of what is the share of these companies in terms of retail health portfolio. Star Health share is about 32.6%, Niva Bupa is 9.4%, Care Health is 10.8%, Tata AIG at 2.5%, ICICI Lombard at 3.3%.
All right, Yash, thanks a lot for that. So those are important, stories or important policy changes that we will await clarity on. CNBC TV18 has written to insurers for a comment, yet to receive a response. With that, what we'll do is take a short break with the news that the market is doing extremely well, but though mildly off highs. The reason why it's come mildly off highs is because of the Nifty Bank, which after hitting a record high has seen some bit of selling. But as we take that break, let's get you some good news. India's business news leader, which is CNBC TV18, just a click away. It's the all-new app which gives you instant access to breaking news, in-depth articles, financial world updates, all of them at your fingertips. You can download the CNBC TV18 app from the Apple Store or Google Play Store, or just scan the QR code, which is up for you on the screen.
Welcome back. Just watch out for a couple of stocks. Abbott India is in focus because it is at a fresh 52-week high in today's trading session, so showing good volumes for Abbott India. We also have a couple of stocks which are in focus, such as AB Capital, which is at the best levels that it's seen in a year. We have Apar Industries, which is seeing a good amount of spurt in terms of volumes and one of the top gainers in the broader markets. AU Bank is actually also at a fresh 52-week high, and giving it company is Bharti Airtel, which is at the best levels that it's seen in a year. So good going in terms of specific stocks. Do watch out for a couple of losers, however, in today's trading session. So, for example, we do have Endurance, which is down and out in today's trade, and Infibeam, which is a little weak as well in terms of top volumes traded. But that's on the specific stocks. I'm watching one particular stock in today's trading session, and that's Citi. Citi has spoken on Dr. Reddy's. Dr. Reddy's is one of the top losers on the Nifty this afternoon. Citi has a sell call with a target price which is cut to 990 rupees from 1040. According to them, a deep dive on the Canadian GLP-1 market suggests street expectations need to be tempered, and a timely approval, according to them, will be key to monitor given past misses on the complex approvals that Dr. Reddy's has had. A decline in Revlimid sales and related PLI to result in a drag of anywhere between $750 to $780 million in terms of EBITDA. The EBITDA impact, according to them, would be difficult to be offset because of the supply of the remaining quantity of Revlimid, however, may help in the next 2 quarters, looking strong for Dr. Reddy's. So overall, they are a bit cautious on Dr. Reddy's, and they are saying that to temper expectations when it comes to the GLP launch in the Canadian markets. Well, that's all the time that we have on the show. It's a wrap on Halftime Report. Business Lunch will take all of the action forward.
Heavyweights inch up as the fears of a Middle East conflict recedes and trade comes back into focus. Energy and metals gain while realty and pharma drags. State Bank of India has appointed 6 investment bankers to manage a planned Rs 25,000 crore QIP that will help augment its capital base for growth. The move comes on the back of RBI's big liquidity push for credit. There is a block deal rush with big trades seen in PB Fintech, Coforge, Delivery and One MobiKwik, aggregating to over Rs 1,700 crore. The flurry comes ahead of the start of Q1 earnings season. There has been a dip in IT service jobs lately, and some of this may be attributed to the AI effect. But experts say the jury is still out on whether AI will cut or create jobs. Meanwhile, entry-level hiring has slumped. Seniors with AI ML expertise are in big demand. Hello, good afternoon. You've tuned into Business Lunch, coming live from the CNBC-TV18 Motilal Oswal studios. I'm Vinny Motiwala. Thank you so much for tuning in as always. And Nifty, as of now, also is managing to hold on to those 25,350 levels as of now. So that's a good thing that it's managing to hold on to, given that today it is the monthly expiry. The mid and small cap, look at that. Opened in the green, then went in the red, and now again back to the green, almost near the day's highest points. So recovery coming in the Nifty mid cap as well as the small cap, both holding on to gains of almost 0.1% as of now. Nifty Bank, looking at that as well, managing to hold on to gains in today's trading session. So Nifty Bank also is among the gainers, coming in with gains of almost 0.5%, though slight bit off the day's highest point, but nonetheless, 0.5% of gain coming in for the Nifty Bank. Individual stocks, First Cry, that's the one that's buzzing in trade as well. Brainbees Solution is the name on the exchanges as well. So 11% gain that we're seeing coming in. No specific news as of now that we know of. Nugent Software, that's another one that's buzzing in trade as well. And keep an eye out on that. 6% gains for Nugent Software. And lastly, Nuvama Wealth. That's the one I want to mark as well. That is also managing to hold on to very strong gains in today's trading session. And all these, if you look at the charts, they've picked up pace, post 9:30-10 that we've seen the pace pick up for most of these stocks. Now, let's get started with the show. And earlier on in the day, we actually managed to speak to Vikas Kumar Jain, India strategist and head of research at CLSA, especially coming in terms of valuations on Indian market, the sectors that he's bullish on, and the state of foreign investment into the Indian markets. What are his views on all of this? Listen in.
The problem is where expectations are today. Of the NSE 500 stocks where there is enough coverage, more than half of the stocks expect earnings growth to be over 20% CAGR over the next 2 years. More than half, at a time when nominal GDP growth may struggle to be even 10%. So that, to me, is possibly quite optimistic expectations. So from a bottom-up perspective, my worry is that earnings cut might very well continue. So what we are seeing is not really any big, strong news flow to drive a massive rally in the market. So we might be in a range-bound market like we've been for the last 12 months or so. We have gone overweight on IT. The logic for that is incrementally, the triggers are likely to be more based out of foreign markets. That global trade is now settling down. Perhaps the US market is not looking that bad. And all of that will give confidence for IT companies in terms of the commentary that they give. And that commentary was the one big problem when they last reported results in April. I think with that commentary becoming a little bit more confident and their stocks have come off, valuations are not that extended like they were a few months ago. What I see incrementally, and this is our note on earnings today, where materials is expected to be one sector to be a big contributor of earnings growth, because both metals, cement, and some of the other places in materials are possibly going to come off on see EBITDA, unit EBITDA expansion, and also because some of it was depressed at the starting base, and that should possibly help. Maybe we will look at a better entry point to come back into that space. An expensive market like India, a foreign investor when, looking at earnings being cut, markets being expensive, and the narrative not really being completely in India favor like it was in 2024, there is no desperation for them to add, money out of turn of foreign to India, which is the big fundamental change that we have seen. And that's where now that we have the TINA factor of India is getting challenged, they might look at investing in other markets as well. So there is no big desperation for them to put more and more money immediately into India.
Okay, that's a view coming in there from Vikas Kumar Jain. But let's focus and talk about some of the stocks that have been buzzing in trade, and specifically with specific reasons that we have for them. Vamakshi is joining in with us to give us the list of stocks that are buzzing today. Vamakshi, good afternoon.
Good afternoon, Vinny. Let me first start off with MobiKwik. The stock has surged after a large block deal, around 9% equity worth almost 162 crore, change hands at 231 rupees per share. And after that, we've seen a very strong up move in this counter. The other stock that I'm watching out for is Western Carrier. The company has bagged 558 crore worth of logistics contract from Jindal Stainless. SMS Pharma is one other counter that is surging higher in today's trading session on the back of this announcement that the US FDA has issued zero observations for its Hyderabad-based central laboratory. Texmaco Rail again in focus on the back of an order win. It's an order worth almost 535 crores from Cameroon. Dilip Bilcon has provisionally completed 1,060 crore of HAM projects. Tejas Networks also on our radar, and that is because they've partnered with Rakuten Symphony for global expansion through interoperable 5G solutions. And lastly, keep an eye out on Cummins as well, because they've gone ahead and launched the battery energy storage system, that is the BESS, and with that they've also expanded their sustainable solution portfolio. So bodes well for them. It's a stock high in trade today.
Okay, Vamakshi, thank you so much for that. But we're going to be putting the spotlight on Nykaa now, which is in focus today. Why? Because they have an investor day meet that is going on today. But they've given a presentation so far right now. Mangalam is joining in with us from the key highlights that are there from this presentation. What's looking interesting and what should we be watching out for Nykaa? Mangalam.
Well, where the runway for beauty and fashion as well as personal care growth is a lot in the country, three near-term takeaways that we got from the Nykaa presentation. One is the foray in quick commerce. We cannot disregard that, and Nykaa has announced an entry into quick commerce through Nykaa Now in 7 major cities of the country. And in that, what they will do is they will fulfill orders between 30 minutes to about 120 minutes. So that's a positive. The second thing that we'll be watching out for Nykaa is their own brands, which is House of Nykaa, which has reached about 2,100 crore in gross merchandise value. They believe this is a number that can compound at 30% over the next few years and reach by about 6,000 crores by close to FY30. That's another target that they have. And the third most important thing that stood out from their near 160-page presentation is that their fashion business, which is likely to grow 4 to 5 times from its current size, has some exciting launches in the second half of this financial year. But more importantly, on the operational front, will break even in FY26. By FY28, will have mid-single-digit margins. And on a steady-state basis, they are targeting 10% margins in that fashion business as well. All things said and done, the stock largely unchanged. But remember, over the last few days, has seen a bit of a rally.
Absolutely, Mangalam. In the last 7 days, it was up almost 5% as well. Today, a bit muted. And before that, almost a 5% gain in the last 15 days as well. But on that note, we're going to actually take a very short break, and remember that, to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back to Business Lunch on CNBC-TV18. Now let's shift focus, and the Defence Minister Rajnath Singh is currently in China. He's attending the Shanghai Cooperation Organization Defence Ministers meeting. At the meeting, Singh reiterated India's strong stand against non-state actors and state-sponsored terrorism. He hailed Operation Sindoor, adding that it was preemptive strike against cross-border terrorism. Meanwhile, sources told CNBC-TV18 that the Defence Minister did not sign the SCO joint declaration due to the dilution in the wording of the paragraphs related to terrorism.
And the proliferation of weapons of the mass destruction in the hands of the non-state actors and the terror groups. Dealing with these challenges require decisive action, and we must unite in our fight against these evils for our collective safety and security. It is imperative that those who sponsor, nurture and utilize terrorism for their narrow and selfish ends must bear the consequences. Some countries use cross-border terrorism as an instrument of policy and provide shelter to terrorists. There should be no place for such double standards.
And moving on to other international updates, NATO leaders backed the big increase in defense spending that Trump had demanded. Now, with the new defense spending target at 5% of GDP from earlier target of 2%, take a look at this report.
War is always changing as technology advances. And in a bid to increase their country's defence capabilities, NATO leaders have endorsed a big new spending target at a summit in The Hague. NATO members will aim to spend 5% of their economic output on defence, a big increase on the current goal of 2% agreed at a 2014 summit. That's 3.5% of their GDP on core defence, such as troops and weapons, and 1.5% on broader defence and security-related investments, such as cybersecurity, protecting energy pipelines and adapting infrastructure for military vehicles. Hitting these targets could eventually mean spending hundreds of billions of dollars more a year. Doubling down on cyber investment is one of the ways to improve the alliance's defence. That's according to Benjamin Jensen, an international relations and security specialist.
So I think the biggest challenge for NATO on the horizon is the intersection of the low cost of shooting waves and waves of long-range attack drones alongside rapid targeting adjustment using AI and offensive cyber. Russia has proven it will attack NATO member states with cyber any time of the day.
And money could be used strategically. Due to technology, he said, low-cost systems like $1,000 drones can now destroy high-cost assets like planes.
In the ideal case, we would have entire NATO drone brigades like what we see in actually Ukraine, but maybe manned by a multinational battalion or battle group.
Moscow's continued war in Ukraine is one reason, along with concerns about a possible future threat from Russia. That's alongside pressure from US President Donald Trump to boost investment. Europe's preparing for the possibility that Washington will withdraw some of its troops and capabilities. Targets are expected to be met in 2035, but can also be adjusted when they're reviewed in 2029.
And speaking at the press conference at the end of the NATO summit in Netherlands, US President Donald Trump said that Israel and Iran are tired, but the conflict between the two countries could start again. Listen in.
They fought very, very hard and very viciously, very violently, and they were both satisfied to go home and get out. And can it start again? I guess someday it can. It could maybe start soon. You know, Iran has a huge advantage. They have great oil, and they can do things. I don't see them getting back involved in the nuclear business anymore. I think they've had it. They've been at it for 20 years, and I don't see that happening either. Now, if it does, we're always there. It won't be me. It'll be somebody else, but we're there. We'll have to do something about it.
And at the press conference, a reporter also asked US President Donald Trump whether he thinks Russian President Vladimir Putin has territorial ambitions beyond Ukraine. Listen in to what he had to say on that front.
I know one thing. He'd like to settle. He'd like to get out of this thing. It's a mess for him. He called the other day. He said, "Can I help you with Iran?" I said, "No, you can help me with Russia. You help me get a settlement with Russia." And I think we're going to be doing that. Vladimir Putin really has to end that war. People are dying at levels that people haven't seen before for a long time.
And in an unusual diplomatic interaction between the NATO Secretary General and US President Donald Trump, the Secretary General called Trump daddy for using strong language to describe ceasefire violations between Israel and Iran. Listen in.
We've had a big fight, like two kids in a schoolyard. You know, they fight like hell. You can't stop them. Let them fight for about 2-3 minutes. Then it's easier to stop them.
And then Daddy has to sometimes use strong language.
You have to use strong language. Every once in a while, you have to use a certain word.
Let's also listen into Trump's response when asked by a reporter about the NATO Secretary General's remark.
He likes me. I think he likes me. If he doesn't, I'll let you know. I'll come back and I'll hit him hard, okay? No? He did it very affectionate. Daddy, you're my daddy.
Do you regard your NATO allies, though, as kind of like children, and they're obviously listening to you and they're spending more, and you're obviously appreciative of that. But do you hope that actually they're going to be able to defend themselves, defend Europe on their own?
I think they need help a little bit at the beginning, and I think they'll be able to. And I think they're going to remember this day. And this was a big day for NATO. You know, this was a very big day.
Okay, on that note, we're going to actually sip into a very short break. More news and updates on the other side, so do stay tuned in for that. Welcome back to Business Lunch on CNBC TV18. News now on the Global Vaccine Alliance, Gavi. Indian government is likely to commit $20 million over 5 years to the Global Vaccine Alliance, but this is well below the $100 million that is requested by Indian vaccine makers. Meanwhile, the UK has pledged $1.7 billion, becoming the biggest donor to the alliance. However, the United States has refused to fund the vaccine group. Last year, billionaire Bill Gates, whose foundation has pledged $1.6 billion to the Gavi Foundation, has already raised concerns over the US withdrawing funding from the alliance in an exclusive interview to CNBC TV18. Listen in.
You know, you've got coalitions like Gavi coming up for replenishment. Do you worry that it's just not going to have the funding available or necessary?
Certainly, I do worry about that. I'm, you know, a salesman for Gavi. They've given me a $9 billion quota, and I'm worried that I'm not going to. They're going to fire me, I'm afraid. No, it's a worthy cause. You know, as the foundation looks back on its 25 years, although there have been a lot of amazing things, helping with Gavi, helping to found it and support it, engage with it, is the top of our list. So it would be almost criminal for Gavi not to get fully funded and provide these vaccines to all the world's children.
Moving on to some domestic updates, 2 people are killed and over a dozen are missing in the flash flood triggered by cloudbursts in several districts of Himachal Pradesh. 2 bodies were recovered and at least 10 are reported missing in the Kangra district. Meanwhile, 3 people and several houses got washed away in Kullu district. Rescue operations are being carried by our SDRF and NDRF teams. The IMD has issued an orange alert in various districts as heavy to very heavy rainfall is expected in the next 24 hours. Moving on, the Axiom 4 mission carrying Indian Air Force Group Captain and ISRO astronaut Shubhanshu Shukla is all set to dock at the International Space Station in a few hours from now. The crew successfully lifted off into the space on board SpaceX Dragon aircraft, nearly a month of a delay and postponements. The Falcon 9 rocket and the Dragon spacecraft lifted off from NASA's Kennedy Space Center in Florida, and the spacecraft is slated to dock at the ISS on June 26th, which will mark the start of the crew's 14-day mission. Let's get you Captain Shubhanshu Shukla's latest message from the compartment crew.
I wanted to take this opportunity to thank everyone who has been a part of this. I understand that this is not a personal accomplishment. It is a collective achievement of each and every one of you who has been a part of this journey. And to make this possible, I really want to thank each one of you. Also to family and friends, you know, your support has mattered so much. This is so much because of all of you guys.
Okay, and on that note, we are absolutely out of time on this edition of Business Lunch on CNBC TV18. Nifty again back near that 25,400 levels, just a few points away from that. But on that note, we'll wind up this edition. Thank you so much for tuning in. Up next, Tip at Cap Radar.
Good afternoon and welcome to Midcap Radar, live from the CNBC-TV18 Motilal Oswal studio. I'm Bamakshi Thoria and with me is Vivek Iyer. Well, Vivek, a very good afternoon to you. It has been quiet in terms of headlines from the West Asian region. But, you know, the frontline indices, they're not as quiet.
That's right. Good afternoon, Bamakshi. Remember, it's expiry day, and that's also something that's playing out. Volatility index, while at this point of time quite subdued, especially in the last couple of hours of the session. Let's see how markets actually trade. But we have a lot lined up on the show, so let's start off with the top headlines. Heavyweights inch up as fears of the conflict between Iran and Israel recede and trade comes back into focus. Energy and metals gain, while realty and pharma drag. Mid-caps underperform.
There's a block deal rush with big trades seen in PB Fintech, Coforge, Delivery and One MobiKwik, aggregating to over 1,700 crore rupees. The flurry comes ahead of the start of the Q1 earnings season.
Texmaco Rail and Engineering gains after it bags orders worth 535 crore rupees to supply 560 open-top wagons along with a 20-year maintenance contract.
Cummins India gains after it launches battery energy storage systems to cater to the domestic market.
And Nykaa gains after revealing bold ambitions at its recent Investor Day. The company says they are aiming to grow its fashion and footwear business by 3 to 4 times over the next 5 years.
Well, we're back above the 25,400 mark for now. It's a good uptick that we're seeing in the frontline indices. The Sensex is also trading with gains of around 0.6%, but what's not doing as well as them is the broader markets. The advanced decline ratio chart will come up for you on the screens, and that will show that the declines far outnumber the advances. The declines have now moved, crisscrossed at somewhere around 11 a.m. and the scenario has still stayed the same. The mid-cap end of the market is also not doing quite well. Up only 0.1%. The small cap index too rather flat in trade today. Lots of sectors in focus as well. It's a mixed looking trading screen. Nifty Realty is one such sector which is losing out in trade today. We're seeing a big fall in stocks like Sobha, Prestige, Brigade. On the flip side, what's doing well is the metals pack as well as the energy index. But lots of individual counters moving around in trade today, and to highlight just those, we have Hormaz, who has walked across to the wall in our special segment, Midcap Movers. Good afternoon, Hormaz.
Good afternoon, Vamakshi. And you have the broader markets too, seeing some choppy moves, but there is some recovery on the anvil. But we'll start with the losers on the broader end of the spectrum and look at Infibeam now. It's at the lowest point of the day, 15% lower on that stock. Fertilizer stocks in general not doing well, but Fact is down 6.5 at the lowest point of the day. Manoj Webb of Gems, another recent listing, is down 7, and Walkhard is staging a slight recovery from the lows of the day, still down around about 2.5% in today's session. A sector that is not doing well today is real estate, as you just mentioned, and almost every stock on the real estate index trading with losses of between 2 to 3% at the lowest point of the day as well. Block deal rush that took place earlier in the day, the recovery in MobiKwik. The stock was down 6% when the deal took place, and since then it has staged a recovery of almost 15 to 16% from the lows of the day, 10.5% higher, but can't say the same for stocks like Delivery and for PB Fintech. Stocks that are doing well on the volumes front though, and you take a look at Brainbees Solutions, the top gainer on the Nifty 500 today, 12% higher on that stock. Look at Raymond Lifestyle, Nugent Software, Apar Industries is at the day's high, 9% higher on very strong volumes. And lastly, a pocket that has been buzzing in the backside is cement, and that too is Dalmia Bharat. Look at Shree Cement and Orient Cement, all of them trading with gains of 3 to 4% in today's session. Back to you guys.
Thank you so much, Hormaz, for joining us and giving us a sense of what exactly is moving as far as the broader end of the markets are concerned. It's a very good time to welcome Nagaraj Shetty from HDFC Securities for a quick technical check on the market. Good afternoon, Nagaraj. Thank you so much for joining us. Well, it's expiry session and quite a bit of volatility, quite a bit of cooling off from the day's highest point. Where do you see expiry pan out?
Hi, good afternoon. Nifty has been in a strong uptrend, no doubt, in the last couple of sessions. Though we have seen some volatility, market is clearly headed higher. And overall, chartically, if you see the broader range movement was there, which in the last couple of months is on the verge of decisive upside breakout around 25,200, 300 levels. I'm expecting a more upside from here onwards. And if you ask today's expiry, around 25,500 is going to be the next levels to be watched in the next 1 or 2 sessions.
So more upside from here on, but what are the stocks that you that are catching your eye?
Yeah, I have two stocks. One is from a financial front, Bajaj Finserv. Chartically, Bajaj Finserv has been in a larger consolidation pattern over the last few months and currently moved up from the lower levels and placed at the edge of moving above the important consolidation zone around 2030, 2040 levels. Currently at 2036, one can look to buy at this point of time. The upside target would be around 2140, 2150 levels, and one can place a stop loss at 1980. Second one is from a Tata Steel metal front. After the downward correction from 150, 152 odd levels, this metal stock has bounced back smartly from the lower levels. It has witnessed the upside breakout of the downsloping trend line. Currently trading around 157.50, one can look to buy at this point of time. And the upside target would be around 166, and one can place a stop loss at 152.
Thank you so much, Nagaraj, for joining us and giving us a sense, number one, of technical levels as well as your individual trading picks. Well, before we slip into a short break, remember to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big Three, and for the Global Lens at 8:30 p.m.
Welcome back. You're watching Midcap Radar on CNBC TV18. Now on to a CNBC TV18 exclusive. Sona BLW is the stock on our radar today. It has been recently in the news following the death of Chairman Sanjay Kapoor in the UK earlier this month. The board has announced changes with Jeffrey Mark overly appointed as the chairperson. My colleague Parikshit Luthria spoke to Vivek Vikram Singh, Managing Director at Sona Comstar, and began by asking him about how Sanjay Kapoor wanted to take the company forward.
His view was always plan for the next 25 years, plan for the next 25 years. He wasn't very into the short term of it. I mean, if you realize he's been a shareholder for so long, for him the longer term interest mattered far more than what typically your capital market investors ask, right? Capital market investors and you guys in the business press ask us questions mostly pertaining to 3 months to a year. His questions were more about 10 to 25. So that was the difference. Hopefully our new chairman, Jeff, who I've worked with for a long time, he too has that same mindset. So hopefully we can have a good working relationship.
You were a diversified company. You got into the railways business very recently, perhaps just about a few weeks before his death. 36 or 37% of your revenues come from electric vehicle components only. How did he want to diversify, enter new markets? Did he have a 10-year vision that he shared with you?
We used to make these 10-year plans of what is the next 10 year. So if you look at our journey in the last 10 years I've been in this company, 6 years I've run it, 4 years when Sanjay was MD, I was his CFO, then COO, head of strategy, did many roles at that time. 10 years we grew by looking west, adding new product verticals and getting into electric vehicles. These were the three things we did, and this is responsible for 90% of the growth delta. We've grown 10 times, 350 crore to over 3,500. The same strategy cannot work for the next decade because the world's shifting. Geopolitics is shifting, trends are shifting. So our new plan for the next 10 years, and it will be in our annual report, is this, that we actually ignored the East completely while we were looking west, which means we ignored actually India. We ignored China, Japan, Korea. So now the new strategy will be look west and east. We have to add many more new product verticals because the biggest delta actually came not from EV or West, it actually came from adding new products. We were a single product company 10 years ago, now we have dozens. We have to multiply that manyfold again in the next 10 years. And third, apart from EV, we have to get into the other trends that are coming in the wider mobility area. So whether it be eVTOLs, humanoids, AV, autonomous vehicle, software, the increasing software content. So that in a nutshell is what we wrote down for our next 10 years. And it's just sad that he won't be able to read it, but it will be in our annual report this year.
Right. Thank you for sharing that. I would also like to ask you about who now takes over from Sanjay Kapoor. All the day-to-day management of the company is being handled by you, Vivek, and immediately after his demise, that is what the board had also said, that you will continue leading the company and handling all the day-to-day management. But as the role of chairman, Mark Overly now takes over. Compared to the kind of role Sanjay played, and Sanjay was very active in terms of industry bodies, representing Sona Comstar before the government, before the industry. What role will Mark Overly play now?
Jeff's role as a chairman of the board. So the chairman of the board has responsibilities, as you well know. But when it's a non-executive role in a 9-member board, it is limited to guiding the board towards better decisions. Their biggest job is to basically ensure management team continuity, whether we are doing succession planning, risk management, have oversight. That oversight role, I think Jeff is more than qualified to do. He's been on a board long enough to know all the ins and outs. That bit, I am not even concerned an iota. Running of the day-to-day, I'm not concerned an iota. Yes, I will have to take on some of his industry representation and government things that I may not be able to be as good as him because I'm not that personality. I'm not that extroverted. I'm not that outgoing. But there is no alternative.
Speaking about the role of Priya Sachdev Kapoor, she has been appointed as an additional director in the company. Could you tell us what will be her role in terms of day-to-day operations, in terms of contribution to the board and the company?
So, as you know, she's been appointed as a non-executive additional director. So, non-executive director, like all the other 7 now, we have 7 other directors apart from the 2 executive directors. It's similar. They are there to provide oversight. They are there to look at whether the company is on its right path. See, management has a lot of control on how things are done. But we too need our conviction tested by a board. We serve at the pleasure of the board. The board is supposed to represent the will of all the shareholders.
My final questions would be about the roadmap and some of the crisis points that the government, the industry is facing right now. One on the issue of the rare earth crisis. How badly is that impacting you right now?
So look, the rare earth crisis is real. It's present. It's been there since 8th April. 8th April is when the export controls came into effect. And till China actually releases this crisis, I don't know what the resolution is in the short term. In the medium term, government is planning certain measures. We are trying our best to support and advise the government in their initiative to do that. There is about 7 to 8% of our revenue that comes from traction motors. A portion of that will be impacted directly. Now, what will be the indirect impact, Parikshit, is the hardest to understand because let's say we supply a part which has no rare earth magnets to a company in India, to a passenger vehicle car maker in India. And that company needs a magnet for some other part because of which there is a production loss. That could be an indirect impact, but there is no way for us to estimate that impact as of today. As we roll forward, we see it. But Parikshit, again, I mean, in our industry, you've covered us long enough as an industry to know that every 6 months there is a new crisis.
Right. So no production cuts? Are you looking at production cuts as a result of this crisis?
For our traction motor business, of course, there are production cuts. But for other things, the indirect bit, like I said, we have zero estimates right now.
Well, a very interesting conversation there with the new management as far as Sona is concerned after the unfortunate demise of the previous chairman, Sanjay Kapoor. They've given the way forward and they continue to hold on to the targets that they've set. But as we now slip into a short break, here's some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Welcome back. Final few minutes or hours of trades, and the Nifty has moved to the highest point of the day, 25,481, inching closer to the 25,500 mark just in the last couple of minutes. Some stocks that I'd like to highlight is Shriram Finance as well as Eternal. Both of these counters have surged by over 1% in the last 1 hour. You're seeing a very strong spike in Eternal as well. That the stock will come up for you on the screen. There it is, trading at 270. From the mid-cap space, what's doing well is Berger Paints. It has seen a very sharp spike in the last few minutes of trade. For now, it is at 575 thereabouts. There you go. Very sharp spike coming in for Berger Paints. Apart from that, keep an eye out on Poonawalla Fincorp as well. That stock has surged over 1% in the last 1 hour, up almost, trading with a gain of almost 2%. That's Poonawalla Fincorp for you. Apart from that, take a look at PB Fintech as well. Just a short while ago, my colleague, there was a flashes at the bottom of your screens which said that IRDAI may continue with expenses of management limits beyond FY26. That's stock trading for now with a cut of almost 1%. But that's all we have on this edition of Midcap Radar. From Vivek, me, and everyone who put the show together, thank you so much for watching MF Corner. When we return.
Hello, good afternoon and welcome to MF Corner on CNBC-TV18. I'm Vinny Motiwala and today what we're going to be discussing is very interesting for investors, especially who are looking for low-risk mutual fund options, but still want better returns. We always want better returns than traditional savings that we see in. So there are three categories that we're going to talk about today. That's equity savings, arbitrage funds and income plus arbitrage funds. Each of these funds come with their own risk, return profile, tax treatment and ideal investment horizons that are there. What is the best for you? So which one should you be choosing? To discuss all of this, and especially in a volatile market, what should you be looking at? To discuss this in detail with us, we have Raghav Iyengar, who's the CEO at 361 Asset, joining in with us. Raghav, good afternoon. And thank you so much, for joining in with us on the show.
Thank you.
Because this is such a time, everyone wants to know what they should be doing with their investments.
It's a very difficult question.
What and where you should be looking at, Raghav. Raghav, that's what is our job, and that's why we have you here to explain us that what we should be doing. Like I was saying, three types, right? Equity saving fund,
right,
arbitrage fund, and income plus arbitrage fund.
Yeah.
Now that's become the new trend.
Yep.
But I want to know, just for basics and starting for our viewers as well, what is the difference between all these three?
Okay, so let's just go back a step back before this, Vinny. I think, as you know, mutual funds are largely four categories. Yeah. So you have the equity funds, which is the popular category. Everyone knows it, everyone loves it. Then you have debt funds, which are also great. They invest in debt instruments. You have hybrids, which is a mix of two. And then you have the other special funds like gold, silver, etc. Now, what the equity arbitrage fund and equity savings funds are part of the hybrid category, which is that they invest in a mixture of debt and equity instruments. So the arbitrage fund is a very simple fund. It basically takes, there is a cash market, which we all look at, and there's a futures market, which is also very, very vibrant, right? And what the fund manager, what the scheme does is buys in the cash market, sells in the futures market, the same stock. There's a small price difference that happens, and it captures that price difference. So that is called arbitrage, but because they are categorized as equity funds, Vinny, they are given equity taxation.
Okay.
So your post-tax returns are much, much better than, say, other comparable instruments. So they are reasonably stable. The second category is, of course, equity savings. Yeah. Now, this is an interesting one because they link three assets. They have regular equity, then you have arbitrage, and you have debt. Yeah. So they are like moderately risky, but also in a market like this today, which is a bit volatile, which is a bit choppy, they're great places. The other one, which is the income plus arbitrage FOF, is a recent baby in the market. Little bit of the money, about 36% to 45% is typically kept in arbitrage, and the balance is kept in income funds, which are basically debt funds. So in some sense, they are a combination of arbitrage and debt. So again, because they are FOFs and they give you very good tax treatment, etc., they are a great category today. That's just come up there.
Okay, great. And that's really picked up pace because everyone wants to know a lot about that. But, obviously, we know some of the risks that exist, right? Like the credit risk that is there or some of these obvious risks that are there. But how does it work with all of this as well? Which are the other risks that we are keeping an eye out on? And overall, how should we be factoring all this in our asset allocation overall as well, in terms of specifically your risk and return? So asset allocation will become important then.
So I'll answer the second one first, Vinny. So arbitrage is a great place if you have short-term money. So they do much better because, as I said, the returns are reasonably stable. You're doing something, you're not taking any directional calls here. So in that sense, if you have, let's say, and because they categorize themselves as equity funds, the taxation is very, very beneficial to the investor.
Okay.
So if you have, let's say, short-term money, 1 year, 2 year money, you don't know what to do with it, I think it's a nice place to think of parking it. Equity savings funds are in people for, let's say, moderate return investors, because they will have a certain amount of arbitrage plus open equity or directional equity.
Okay.
And obviously a large part of it sitting in fixed income. So fixed income, as you know, acts as a bit of a cushion in volatile markets. And the last one, of course, is income plus arbitrage, which is pretty similar to arbitrage, but has an element of fixed income also attached to it. So again, in terms of predictability of returns, I think arbitrage and income plus arbitrage FOFs are very, very similar.
Okay.
And of course, equity savings are a slightly lower riskier version of normal equity funds.
Raghav, my point is that what is the return in all of this? I could just think like, okay, what is the return for equity savings, arbitrage, and what is the expectation normally that is there, right? If you're seeing moderate risk means then moderate return is what we're
It is. So I
right?
don't think, Vinny, one thing investors must understand is that these are not, these are more, how do I say, for conservative investors or for investors who have a slightly shorter duration.
Okay.
You're not really trying to double your money in these funds.
Okay.
These are not meant for very aggressive investors. So they have a certain function. They are great from perspective of parking money or for risk-averse investors. They're just an alternative investment option. So I don't think you should really look at the return and put money in here.
Okay.
So if somebody is really aggressive and wants to really keep money and is able to take risk on it, then obviously there are better options than these three.
These three options,
Yeah.
absolutely. Okay, what sort of market scenarios can I look at such funds? At what point of time, this is actually, okay, it's a better bet than taking more riskier bets right now. What sort of investors or what volatility, when it's too volatile, is it good to look at these funds, or when the market is stable, would it be better to enter these funds?
So I think arbitrage obviously it does really well in terms of volatility because it's able to capture that spread quite well, right? And it's a pretty much an evergreen category. You can put money any points of time. Of course, arbitrage rates have been coming off a bit, but that's a different topic. Income plus FOF is a great place if you feel interest rates are coming down. So if you go back and see the recent returns of many of these FOFs will be very, very good because interest rates have come down because of a lot of things that have been happening to the fixed income markets. And of course, equity savings funds, as I said, will give you some amount of directional equity.
Okay.
But again, ideal for some time in a volatile market where you're not sure where it's trending. But at the same time, you want to participate in some form of equity, but not take that full equity risk. I think equity savings does a very, very good job there.
Okay. And are these funds actually, or does it make sense if someone has a long-term kind of a goal? If they're investing either for some kids' education or for kids, or if someone is investing for retirement, then does it make sense to have any of this in my portfolio, or would it just be better to look at...
They're great from a withdrawal perspective.
Okay.
So let's say hypothetically you are saving up for your retirement.
So something
10
like
years.
for an SWP.
SWP, yeah. Because as I said, the commonality of all these three funds is that, especially arbitrage and income plus FOF, is that there is some level of stability and predictability.
Okay.
And that works very well in an SWP scenario, whether it's for your child's education or retirement or anything.
Okay. So
but are they accumulation investments? I don't think so.
Okay, yeah.
So maybe you should save your money once you get to a particular goal. And
Then maybe you can.
Then maybe you should think about this.
Okay, that's interesting to know. Okay, how sustainable do you think these returns are from arbitrage, income plus arbitrage funds, the spreads? Do you see them narrowing? How do they move normally? How should we be judging these sorts of funds?
See, arbitrage spreads largely have come off a bit. One is largely there's a lot of participation. Institutional participation is heavy.
Yeah.
In the Indian mutual fund space itself, that category has almost tripled in size in the recent past.
Yeah.
So it's just a lot of money there, plus obviously other institutions. The other thing, of course, is level of volatility makes a lot of difference. That tends to make the arbitrage go up and down. But one thing that I have noticed, Vinny, with arbitrage is that they pretty much synchronize with your short-term interest rates. So they're in and around those rates. I think the advantage of arbitrage is that it gives you the whole tax advantage because they're categorized as equity funds. So your post-tax returns are much, much more efficient as compared to other instruments. Income plus FOF, as I said, it does really well in a falling interest rate scenario.
So right now is the good time?
Yeah, now the bet is out whether interest rates are going to fall more or they stop.
Or not, yeah.
I think that's something that other smarter people will tell you. But yeah, that's the big call there. But if you are a believer that rates are going to go further down, and again, because it's categorized as an FOF, your post-tax is much better. Because if you keep money for 2 years in a fund of funds, your taxation is very, very advantageous to you.
Okay.
And as I said, equity savings is pure equity taxation. That's just that's an easy category if you're looking to really put your feet in the water, but you're not sure of whether the temperature is correct or no. So that's a place where you can jump in.
You know, how do these funds normally work in terms of hybrid categories specifically, right? How do they optimize this portfolio risk we talk about, the risk and return over there? Is there a specific way that one, as a return for investors, they could look at something, given that, you know, there's equity or debt exposure, both come into this factor as well. So how should you be looking at such a scenario in terms of risk
sort of?
No, one is first things first, and this is for any category, just not for this one. Please don't look at the last immediate returns.
Yeah.
They sometimes tend to confuse you because economic events have an habit of amplifying returns or subduing it.
Yeah.
And you don't know what time you're looking at. So that's number one. So first of all, you get your story together as to why are you investing in those particular instruments. As I said, these are largely these are more stable investments. So again, it depends on your time horizon. So obviously, if you have a lower time horizon, then maybe an income plus FOF, arbitrage FOF, or an arbitrage is a good place to think about. Or if you're really looking at maybe you want to put some money in equity, but you don't have a very long-term horizon, then obviously the equity savings makes a lot of sense to you. Yes.
Okay, sure. So, we've highlighted all the risks and returns and possibilities that actually come in with this as well. Low risk, moderate risk. So we've spoken about all of that. So on that note, we're actually going to sip into the short break that we have to take right now. But don't go anywhere. We'll continue this discussion forward with Raghav, and more updates we'll get in from him as well after the short break. Welcome back to MF Corner on CNBC-TV18. We still have with us Raghav, CEO at 361 Asset, and today we're discussing equity saving funds, arbitrage funds, income plus arbitrage funds. The difference between them, we spoke about that. We spoke about the risks that are there as well. But now let's understand what is it in terms of categories that we're watching out for from this, in terms of stability that comes in with this, and especially in terms of liquidity and redemption, what are we watching out for here? Raghav, that's my next point, right? In terms of liquidity, how liquid are these funds versus each other, equity saving, arbitrage and this? And in terms of redemption also, how should we be looking at it? Given that, market is so volatile, or when there's too much stress, at what point of time should you look at redeeming these funds?
So as I said, Vinny, the arbitrage funds have done quite well in market drawdowns, because that's the whole point in them. They are very stable. And they manage this whole market drawdown plus liquidity events very, very well. So there was absolutely no problem. Equity savings obviously had a bit of directional equity. So obviously when market had a bit of a drawdown, obviously they did get affected, but no issues on liquidity at all. Income plus arbitrage actually did really well, because there's no direction, there's no equity directional market there at all. So actually they are for a completely different set of investors. They were actually, in some sense, they are more for debt plus investors, not really equity investors. So all these three did, in a market drawdown, they tend to do very, very well. So as I said, they must be in some part of your portfolio. So it's actually, if you are a big equity investor, you should have some money parked in any of these three categories.
How much should it be?
No, that's very individual, Vinny. I'm not going to answer that question.
no 5%, 10%, any indication?
No, because everybody's different, right? I don't think you can put that 100 minus your age formula in any of in life, right? Yeah. So, my dad, for example, is 80 plus, and he has a reasonably large component of his money in equity, because he doesn't need the money, right? Yeah. So he can keep it away. Whereas someone who's a 30-year-old may have a lot of housing loan, may not be able to keep so much money in equity. But yeah, it's great to keep this for, let's say, emergency purposes, for money that you might need for very short term.
So it's liquid, right?
It's liquid. It's anti-directional to equity. Okay. So in the sense that if you're worried about equity markets and you're worried about volatility, I think this is the place to go to. So.
Okay. And are there any warning signs or something that I should watch out for as an investor when I'm looking at any of these funds specifically? That's like the red flag that comes in.
Yeah, I think the big one for me is that because a lot of these funds employ arbitrage strategies. Yeah. So are they consistent with their arbitrage strategies? Okay. And that's, so if they say they're going to invest X amount in arbitrage, are they in and around that number? I think if they're way off that number, then I think that's something that one needs to be worried about. The second thing, of course, both these categories, especially equity savings and to some extent income plus, obviously have a fair amount of fixed income in it. So one needs to be careful as to what sort of fixed income are they buying. So if they're buying risky fixed income, may not be the best thing from an investor outcome perspective, right? You could lose capital. But yeah, these are the two big things that I could think about, Vinny, over here in this
Okay. And how is the checklist for each of these funds different when I'm investing, right? Like you said, that don't look at just the short-term returns or go and just see my one-year return. That doesn't make sense. Yeah. Then what do I have to look for? Equity saving funds, maybe arbitrage, and income plus arbitrage now.
So income plus arbitrage, as I said, the big investment is actually happening in fixed income. So you just need to keep looking at the fixed income part of it. What are they doing with their money, right? And it's going to invest in a set of fixed income schemes. So if they are largely fundamentally great performing schemes, they've got a good track record, no problem. Equity savings, I think the key thing to watch out for is the amount of directional equity in the portfolio. Because as per the scheme regulation, you can go 15 to 45. So obviously if a fund has say 40% in directional equity, it's going to be more volatile, a bit more risky than some fund which has say 25%. So that's the other one that needs to think about. In arbitrage, it's pretty simple. You just need to make sure how the fund has done in terms of performance consistency. The consistency, of course, is important on all the three, but arbitrage is much more important. So you should just try and figure out how it's doing on a monthly rolling or a quarterly rolling basis. However the returns work for you. That's it.
Okay. There's one point that I want to understand. We spoke about taxations for all of this, right? Yeah. So I want to understand, does it in any way help in sort of tax saving sort of a thing? Does it become a good bet? If you're looking at those tax sensitive kind of investors, would it be making sense to look at
Yes, of course. So arbitrage is actually is ideal for someone with short-term parking and is looking to actually optimize.
Short-term is how short? How much are you talking about?
Ideally, even if you keep it for less than a year, your short-term capital gains tax is lower than what you would pay under normal circumstances. You keep it for more than a year, it straight away goes to 12.5%. Same thing happens in income plus arbitrage. That period instead of 1 year becomes 2 years. So obviously, if you're somebody who's very sensitive to post-tax returns in your investment, which all of us should be, in my opinion, but if you're more sensitive because you are in an income tax bracket which is very high and you're looking to optimize that, then obviously arbitrage and income plus arbitrage are great products to think about.
No, Raghav, what if someone already has fixed deposits, right? Like they are holding, you have something, that was the basic way of investing first, right? So when you have those fixed deposits, then how should I approach this sort? Like, because I'm already holding so much there, then how should I be looking at this?
No, so I think FDs are a very important part of your investment, right? And I think they've been given a bad name because of whatever is happening in capital markets. But I think people remember fixed deposits a lot when your capital markets or equity markets start getting risky, right? So I think first thing I like to say is like, please keep money in FDs. I mean, that's very critical. I know we are in an MF show, but I'm not going to make that statement today, right? Number two, in this one, obviously, it depends on what's your period of investment. So if you're somebody who can put money away for maybe 3, 4, 5 years, then I think equity savings is a great place. It's like I said, if you're between 6 months and above, or 1 year and above, I think arbitrage is a great place. Same thing with income plus, 2 years is a great place to look at it. So I think if you keep that thought in mind when you're investing, I think you're sorted.
How helpful is equity saving funds, especially in terms of diversifying my portfolio? If I'm looking at it with that sort of a way, then how should I be viewing?
So that's a great question, because nobody thinks of equity savings as a diversification tool, but actually it does diversify a lot, because you've got some money in directional equity, you've got some money obviously in arbitrage, and then you've got the rest of it sitting in debt. So actually, if you ask me, it's a very well diversified portfolio, but I would ladder it up in a very simple way. At the bottom of the ladder is arbitrage. The second step is obviously equity savings. The third step could be possibly multi-asset funds or balanced hybrid funds, as they call it, 50-50 funds, which are 50% debt, 50% equity. And the top of the ladder in terms of risk reward is possibly multi-asset, which does a lot of things, but obviously has slightly higher levels of risk. So if you can ladder out your investments the way I've said it, I think then you can plan it out that way. And hence, if you see, equity savings is the second step in the ladder. So it's actually a nice way to put money away, yes.
Okay. Raghav, how often or how should I be, reviewing this side of my portfolio as well, right? There is to manage your risk or to monitor it. Is it normally how you would say review it once a year? Or is it a different way to analyze a risk, given if I'm seeing a market correction or the swings that we see in market? How necessary is it to review these also as well?
See, I think every investor has to review his portfolio, right? I think that's fundamental rule number one, right? I think the challenge in today's world is that because everything is available pretty much at your phone, investors are over-reviewing their portfolio or not reviewing it at all, both of which are very bad for your financial health. For arbitrage, frankly, you can look at it once every 3 months is my suggestion. Because I think it's for shorter term papers. So you just need to make sure that your returns are commensurate with what you're thinking about them. I think equity savings funds once in a year is more than enough. My logic for income plus arbitrage would be pretty much the same there, nothing there.
Okay. Raghav, you have given us all the answers possible and how we should be looking at these funds as well.
No, thank you, Vinny. I think shows like this really help educate investors, and I think that's very important for us in the MF industry.
Absolutely. Thank you so much, Raghav, for joining in with us and helping us understand all these three kinds of fund and what they actually mean for us as investors and viewers. Thank you so much for tuning in to MF Corner on CNBC-TV18 as always. And don't go anywhere. Last hour of trade is still left. And to take you through that, you have Closing Bell up next.
market headlines. To understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Nikkei, it's up over 1%, and the Taiwan index too is holding in the green.
We need to take out 25,317 levels, which is the high of the week. 25,260 on the Nifty. It's up, but up small. 82,840, 850 on the Sensex.
More than half of the stocks expect earnings growth to be over 20% CAGR over the next 2 years.
The Nifty, after hitting highs of in excess of 25,400 in today's session, has cooled off.
Mega 25,000 crore rupee proposed share sale through a qualified institutional placement or QIP.
Good uptick that we're seeing in the frontline indices. The Sensex is also trading with gains of around 0.6%.
Well, that was the day so far. Hello and welcome to Closing Bell. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel, and my co-anchors will join in just a bit from now. But for the time being, we've got a party going on the Lal Street. Forget about 25,000. 25,500 is here. The Nifty Bank has gone ahead and made a fresh all-time high, clocking that to 57,200 odd mark. And the big boys have come to the party. So you have Reliance Industries, that's holding one end up like a rock. HDFC Bank, the other one that was a little bit subdued, but that in fact has come back into its own after a brief consolidation. And just take a look at that nice trending up chart is what you have on HDFC Bank. And pull up a couple of other names as well that are just coming into play. Eternal, that stock, remember, at around 225 rupees, we had made this point that there was two big global rejigs that were taking place. But there was a lot of demand coming in from the domestic mutual funds, and they were sitting on a lot of liquidity. So that nearly $1 billion got gobbled up. And after that, in fact, you've seen that the stock has not looked back currently at the high point of the day as well. Okay, also throw in there a couple of other names. You have Ultratech Cement that's now up close to 2%. ICICI Bank as well as higher. So short point being, today is a good trading session, though you'll wonder, my portfolio is not looking so good. The problem is that the number of stocks advancing as well as declining, they're not reflecting what's going on the headline index. So it's been a bit of a switch of roles today. Breadth of the market, pretty much okay. Headline index zooming away. Mitesh Thakkar joins us on the show. Mitesh, is this the moment? Is that now are we gunning for higher levels since we have taken this out decisively? I'll tell you what, Mitesh, the observation of the last few days was the bears were getting very, very confident. They were writing calls. A 25,300 call was getting written a lot. And once you saw the 25,400 mark getting decisively crossed, it appears, there have been quite a bit of the short calls that have got covered. Your take?
Yeah. So, Nigel, my understanding is that, getting past 25,200, 250 yesterday suggested that we might test 25,500. We've just done that. And there's no sign of weakness as yet. So, good chance that we might see an extension. Players who want to enter afresh would wait for an intraday decline, but otherwise, people who are holding it out should just trail their stop loss to about 25,360 odd levels, and 25,750, 800 is the next target area. So stay positive on the indices. Even the Bank Nifty, has managed to get past 56,800, so that's a positive sign, and Bank Nifty could head towards 57,500 as well.
Okay, got it. All right, that's a positive sign. Agreed, Mitesh. What about individual stock calls? What's on your radar?
I have a buy on National Aluminium with a stop at about 188 and a target of around 200. And MRF, the other one, MRF is given a good reversal. So buy here with a stop below 1,41,000 and target of around 1,43,500.
Got it. Yeah, it's a 1,40,000 stock. Wow. Thanks a lot, Mitesh, for joining in and filling us in with those details. But, it's the afternoon, so let's focus on a drink. That's United Spirits. It's in focus. Kotak Securities has written a bearish note on the stock. Teetotaler Mangalam joins us to tell us more about that note. Mangalam, they as well are not having a sip.
They are not having a sip because the tipple has gotten a little expensive as per them, and that's thanks to the Maharashtra government increasing the excise duty after so many years. And that's exactly the risk that they've put back on the table for all these stocks. So if you look at it, it's the first brokerage that has finally put pen to paper, done analysis on how prices are pre and post the excise duty imposition, and they've determined that it's a 30 to 45% increase in retail price for popular lower prestige and mid prestige segments. How much do they account for their overall sales? For Maharashtra, it's about 11% of sales value and 13% of volume. Overall, Maharashtra is an important state for United Spirits when it comes to revenue and EBITDA contribution. So Maharashtra accounts for nearly 16% of their sales, of which 11% comes in from these categories where the prices have risen by 30 to 45%. Importantly, for the upper premium and luxury segments, the prices have not been, increased by as much. In fact, it's between 0 to 8%, but there is a big volume dent that they expect. But beyond that, they believe that, this reintroduces unpredictability around policy, and that is where they've, gone ahead and cut their EPS estimates for the next 3 years by anywhere between 3 to 6%, and they've cut their target price as well from 1575 rupees to 1475 rupees. The important triggers to track from here on: Delhi is due for an excise policy. Will that be in favor or not is the big question. Then there are Bihar elections in November 2025. Remember, Bihar is a dry state right now. Post that, will there be a change in thought process out there? And thirdly, the formal implementation of the UK FTA is something that the industry is awaiting. So, there could be mild positive triggers right now, but unpredictability definitely back on the table.
Got it. All right, Mangalam, thanks a lot for that. Sudeep Bandyopadhyay, Group Chairman of IndiTrade Capital, joins us on the show. Hi, Sudeep. What's your view? Kotak not too optimistic. Mangalam says the peg got too stiff. What do you think? Will you be looking at this dip to get in, or you rather stay away?
Well, I'll rather wait, Nigel. I think, as Mangalam was listing out, I also believe there are many moving parts, and one doesn't know which way things will move in the near future. Look, valuation is also not really cheap. It is valued reasonably well, and at this stage, the margin of error is very limited. So I'll rather wait out.
Got it. All right. You'd rather wait out on that particular one. Let's focus on a couple of other stocks then. Sudeep, I wanted your view on Eternal. The stock, I was mentioning this earlier as well, and I think a month or so ago I pointed it out on the channel in the morning, that there was going to be a rejig in that one particular week, if I'm not mistaken, 3 weeks ago, and there was close to around $850 to $900 million of selling. But the point was that the domestic mutual funds, well, they were very, very active in the counter. They were sitting in a lot of liquidity as well. And all of that got absorbed. And in fact, by the end of that week, from 225, the stock ended at around 235 with that sort of selling. That told you there's a lot of interest in the stock. But at around 265, what do you think? We know the kind of usage is just going up, but valuations, profitability, what would you think?
Well, Nigel, a couple of things happened. One is, as you rightly said, the company had announced that they will focus on growing the business, particularly the quick commerce, which will require a lot of investment. And they were very clear that the profitability will take a hit in the near future. So that was an announcement which market, of course, understood, but there was some correction. And then, of course, came the fact that they talked about limiting the foreign shareholding to 49% to ensure that the business can grow in a manner they wished. Again, that was a negative, and market kind of assumed that the stock will be under pressure. But I think the fundamentals of the business and the strong demand which the business is witnessing and the leadership position which the company enjoys, I think gives them a unique position. And I strongly even then had mentioned that this is some business where winner takes it all. And they are clearly the winner, whether you look at Q-commerce or whether you look at food delivery. I think they are leaders and their parameters are improving in all these businesses. The second listed company, Swiggy, is a little behind, or why should I say a little far behind them in most of the parameters. So I think if you want to be in this space, I think Eternal is the company to be into.
Got it. Okay, all right. Sudeep, the other one that's woken up, and that's the giant, HDFC Bank and Reliance Industries. You're talking about more than 20% of the index that went through a phase of underperformance, but boy, oh boy, they have got their mojo back in style. What's your view on both these two names? Good for more?
Well, Reliance definitely is. I think we have been always positive on Reliance, and we have been maintaining our view for last 6-8 months that I think this is a sleeping giant. A lot of opportunities, particularly the value unlocking opportunities, definitely there, and it's a matter of time before it happens. Whether it's a retail or the telecom business, some value unlocking will happen. The other fact which I think is adding to this thinking is that the GRMs, I think this quarter we will see a positive surprise on the GRM front, and the business itself, the old business or O2C business, will see a lot of positivity coming back. While the telecom and the retail was giving positive vibes, the O2C, particularly in the petchem side, there were a lot of challenges, but I believe that things are improving there as well. And, the overall, the business numbers also will improve significantly.
All right, got that. Still positive on Reliance Industries, went through a period of underperformance. And if you just take a look at Reliance Industries as well as the Nifty, year to date, you'll see that Reliance Industries has found its form, and it's found its form in style. The last 6 months have been very, very good for investors in this particular name. But let's get straight to a CNBC-TV18 exclusive then. Sources tell CNBC-TV18 that the insurance regulator is unlikely to cap commissions. Yash joins us to fill us in with more details and tells us what does this mean and its impact on the insurance sector. Yash, take it away.
Well, Nigel, if you simply talk about commissions and expenses of management, commission is a part of expenses of management. There are two things under expenses of management: commission and operating expenses. Now, before FY23, the regulator had caps on individual business commissions like motor commissions, fire commissions, health commissions, so on and so forth. In FY23, the regulator said, let's do one thing, let's remove individual commissions and put a cap on expenses of management straight away, giving insurance companies more flexibility in terms of how much commission they want to pay to acquire any business, and balancing it, still staying under the limit of expenses of management. The fear, as far as the street is concerned, was that this comes under review in FY26, and the regulator might look at bringing that limit back onto commissions. What that would do is that it would restrict business, it would restrict commission payout to aggregators like Policybazaar as well. What we've been given to understand from our sources is that the regulator believes that policyholders have been benefited through limits on expenses of management, and hence, purely from that point of view, there is no need for that policy to change, which means for the limits to come back on commissions from expenses of management, which means the regulator believes that the limit on expenses of management should continue as they are today. What that does, of course, it gives more flexibility to insurance companies to pay how much commission they want to acquire individual businesses. At the same time, it benefits a company like Policybazaar as well, because the commission income is the main income for them. So this is essentially how it works, and exactly why it will be beneficial for insurance companies as well as for aggregators and other distributors.
Got it. Okay, all right. Yash, thanks a lot for joining in and giving us that quick take. Sudeep, any view on this one, PB Fintech?
I think, we like the stock. In fact, the business is solid, and core business is growing rapidly, and the potential, of course, is humongous. They are in the right spot at the right time. The only, the issue which still bothers me is that investment in the healthcare space, which probably they could have avoided, and I'm not sure the logic and the rationale behind that still. They are talking about, limiting their investment and a whole lot of other things. But in spite of that, the logic of that still kind of is not easily digestible. That's the only niggling worry. Otherwise, business is strong.
Got it. All right. Sudeep, I wanted your view on the cement stocks. And the one that I'm going to talk about is Dalmia Bharat. Prabhudas Leather, they have come out with a note on Dalmia Bharat. They've had an interaction with the management, and they maintain their accumulate rating with a target price of 2,273. They are valuing the company at around 11 times on a forward EBITDA, so 11 times EV upon EBITDA. Let's run you through the rationale. They expect Dalmia Bharat to actually be a big beneficiary of the higher prices in South as well as in East India in the first half of this fiscal. And they have broken it up into various aspects. So point number one, on demand, they say volume is expected to take a hit in the first quarter. That's because of the sluggish demand, especially in East amid the monsoon. While southern region, demand was a little bit better than East, but now it's getting affected because of the monsoon as well as flooding in various regions. That's point number one. Point number two is the good part with pricing. In East as well as in South India, pricing is higher by around 12 and 35 rupees a bag. This is in comparison with the average that we saw in Q4. So even after the recent price pullback that we have seen in the month of June, cement prices are still up by 10 to 15 rupees higher in comparison to Q4 FY25. Point number 3, what does this mean in terms of an EBITDA per ton? They are saying the improvement in near-term performance is likely to lead to likely to be led by higher pricing and flattish cost structure. This in turn would mean that the EBITDA per ton improves by around 200 to around 250 rupees on a sequential basis from the levels that we saw in Q4 FY25. So that's a big thumbs up out there. Pricing is going to play its role. Costs are more or less flattish. Big uptick in terms of EBITDA per ton. They're also saying in a longer term, the management is confident of achieving cost savings of around 150 to 200 rupees per ton. That's by FY27. And the few factors that they've laid out is improving their renewable energy mix and also reduction in logistic costs. So that's the longer term plan in terms of cost reduction. Finally, on capacity addition, they've already announced 6 million ton expansion at Belgaum as well as in Pune. The capex they've laid out is around 3,500 rupees, 3,500 crores. And this is expected to be completed by the end of FY27, which by that time, the total capacity will move up to around 55.5 million tons odd. So put all this together, Dalmia Bharat, one of the big gainers today. Sudeep, what do you make of this one? Dalmia Bharat went through a big price correction, but now in fact, it's getting its mojo back. And as PL Capital has mentioned, all those factors, favorable pricing, demand not so great, but input cost flattish. They like it. Your take?
Yeah, absolutely. I think overall cement we have been positive, and particularly the leading cement companies we are holding our positive view. And PL is absolutely right in terms of one particular factor, which is the cost. I think the cement companies have achieved commendable cost control, and the expectation of costs going up is very, very limited. So in a scenario where the demand is increasing, and believe me, it will keep increasing. Q1 is a monsoon season, so obviously demand is slightly sluggish in different pockets of the country in Q1, but going forward, demand will significantly move up. So the pricing power, which is already back, will be even more. And with that pricing power, costs being flat or even coming down going forward, I think the EBITDA margins will keep increasing and demand is increasing. So obviously, they're going to have good time. Yes, Dalmia Bharat still can move up about 10% from here. That's what we believe. And of course, our pick has been Ultratech Cement for quite some time. And we maintain our view that, if you want to be in this segment, be with the leader, which is Ultratech.
Got it. Okay, all right. You like Ultratech more than any other stock. By the way, keep an eye out on Vedanta. That finally seems to be waking up. So I think we should get Vedanta up for you on the screen. In the first week of July, I understand some of those procedural issues will be coming up for NCLT hearing and the likes. Big move is what you're seeing. It's been a bit of an underperformer in the last couple of weeks. But that one today, it's a pure play on the weaker dollar index, better commodity prices. You've got the special situation that's playing out there. And the promoter entity should be in better shape going by the dividends that they're paying out from Vedanta Limited. And that's why Vedanta Resources will be in far better shape as well. But let's focus on some flashes that were down on the screen for you. A deal seems to be impending in the paint space. AkzoNobel's on the block, we know that. But Ashwin Mohan from Money Control joins us to fill us in with more details that he's picking up. Ashwin, take it away.
Good afternoon. So this is a really big and colorful deal that has been in the works for the past few months. What I'm given to understand from my sources is that Parth Jindal led JSW Paints, which is of course a group company of the diversified conglomerate JSW Group. So JSW Paints and AkzoNobel NV, we're given to understand from our sources, are likely to shortly sign the final or definitive documents over the next few days. And this is for the proposed acquisition of the majority stake that is held by the Dutch multinational parent in AkzoNobel India, which is the listed entity. At the end of day's trade on June 25th, the majority stake of 74.76% held by the Dulux Paints maker in AkzoNobel India was valued at around 10,985 crore rupees, but reports have pegged the deal value at around 9,000 crore rupees. Now remember, Money Control was the first to in fact report back on May 15th that JSW Paints had emerged as the frontrunner in this hotly contested transaction. Clearly, it is now entering the final leg. There were other suitors as well, Advent along with Indigo Paints as well as Pidilite Industries, but JSW Paints has pipped them. What our sources are telling us is that both parties are planning to seal the deal very soon, maybe as early as this week or early next week. And post that, an official announcement can be expected. Keep one thing in mind, JSW Paints is a relatively new entrant in the space. It entered the paint sector in 2019. This acquisition is expected to bolster its presence in the decorative paint segment. And of course, it also stands to benefit from the popular Dulux brand. Also, this proposed acquisition comes at a very interesting time for the entire paint segment, where you have the market leader like Asian Paints, some of the established players like Berger Paints and Kansai Nerolac. They're all facing increased competition from the likes of Birla Opus and other players. So very interesting time for this deal to enter the final stage. Let's wait and watch for the action to unfold in the next few days. Back to you.
Got it. All right, Ashwin, thanks a lot for that. We'll have to keep an eye out on that one. JSW Paints likely to soon sign the final pact for AkzoNobel. Sudeep, before you go, tell us, will this paint a better picture? This has been a deal that's been, long awaited. Finally likely to see the light of day. What's your take?
Well, it's an interesting transaction. It's been, as you rightly said, pending for quite some time. So yes, it's good for JSW Paints because they are new in this business, and this acquisition will definitely give them an edge in the at least in the premium end of the market. But having said that, overall in the paint industry, we are very careful. I think the competition is too much, and at this stage, it's better to avoid the paint companies just because of the sheer intensity of the competition which we are witnessing in this segment. Yes, the oil prices coming down will definitely lead to some cost benefits in the near future because there is a lag between the time prices come down and it gets reflected in the P&L of the paint companies. But that benefit will definitely come. But in spite of that, I think the competition is so intense that it's little difficult to predict and enter any of the paint company stocks at this stage.
Okay, little tricky, and we're waiting by for that kind of competition that's been intensifying. That's what's led to a lot of them being under pressure. But thanks, Sudeep, for joining in, giving us your view on that particular name. By the way, the stock we just highlighted, Vedanta, that's taken off actually. Vedanta has moved to the high point of the day. I think Hindustan Copper as well. The metals pack itself has come back to life in the last few minutes, all of them moving to the high point of the day. For the time being, we'll slip into a short break. We'll be back. N. J. Kumar from Prime Securities is waiting by.
investing.
Welcome back. Well, Nigel was holding up the fort on closing bell. The full team is back. Good-looking screen. 250 points on the Nifty. 25,500 is where we are at. So actually, I mean, we're plateauing out a little bit as we speak. But, I mean, can't complain. For the week, by the way, we are running at about 1.5, 1.6% of the Nifty so far. So a little bit of hesitation early on after that ceasefire, but since then, for the last 2 days, pretty solid gains. N. Jaykumar is now with us. He's Group CEO and Managing Director at Prime Securities. Jakes, good afternoon. Great to have you with us here. Thanks very much for your time. You know, let me, a slightly convoluted question, if you will permit. You know, you got this Springboard initiative, right? And you are, I know for a fact that you are working with so many smaller companies, startups and the like across a range of industries. Could you use, your read-through across those businesses to look at, I mean, I'm sure that throws up ideas in the listed space as well, right? At the end of the day, the listed space is much more liquid, etc., maybe higher valuation. But anything you can kind of sort of, share, cross-linkages, any ideas you found, any segments which are very exciting in the private markets, maybe you found a play in the listed space? Go on.
So I'll tell you, for instance, the FMCG space, it's been a sector that we've pretty much ignored in the listed space. But if rural consumption is indeed coming back, some of the companies that we're raising money for are actually well dovetailed and networked into the rural demand segment. So while consumption itself, as I said, has been expensively valued in the secondary markets, it's possible, and we've not even had growth. So you have many of the multinationals now quoting at 40, 50 times like they've been, but growths are in low single digits. If you just move to the unlisted space, you'll find a lot of very good opportunities at 2 to 3 times top line, growing at 30 to 40%, and occupying a niche which one fine day will end up in them getting consolidated and being bought into by some of the big guys. Because in the 0 to 50 crore kind of range, there aren't too many product categories that are being nurtured by the existing, the bulge bracket FMCGs, if you will. So that's one space we kind of like, where in order to make up for the growth that they lack in the as listed companies, they're able to acquire small niches or small slivers of markets and are able to do so with high growth, which is hugely beneficial for them. They're also cash rich, many of the FMCG plays. So a combination of being cash rich, not having the ability or the inclination to nurture small companies, and then getting to a stage where, let's say, these companies are 50, 75 crores in top line, sometimes even could be 3 digits and above, they become very ideal candidates for the sort of agglomeration or consolidation that I talk about. So that's one thing that makes us want to go for FMCG spaces in the unlisted, but that's not a space that we actually look at in the listed. That's not a space we look for in the listed peers. So that's one paradox I can sort of straight off the bat talk about.
I mean, and here valuations are much more reasonable as compared to if you want to buy FMCG in the listed space, right? As you said.
So the way that happens is folks typically, or investors typically pay up for growth. And if you don't see growth in the secondary markets, whether it's, other than passive funds or index funds who actually need to deploy something in the FMCG space as a diversification, anybody seeking growth is not coming to the FMCG space today. They will do so in the unlisted space because that's where you get growth. Maybe you got to pay up a little more for growth. But if the company actually comes good, then that could potentially be a multi-bagger in the unlisted space, as long as the final fling, which is either a listing or a consolidation with a listed peer, can happen. Many of the names that are today listed in this space came from being unlisted, where people paid for growth. So that's something that I can talk about.
Okay. So perhaps when it comes to FMCG, unlisted better than
listed. Jakes, hi, great to have you on the show. Just, an overview overall on what you think of the market as well. We've just been discussing this internally. The markets have managed to climb all walls of worry, tariffs, bombs, nuclear, this, that, whatnot, marching higher. What's the sense? Do you think there's an element of maybe complacency, or is it market wisdom that there's no real disruption in terms of corporate earnings or inflation or anything, even on account of the tariffs so far?
Well, all I can say is that there's less and less credibility and less credence given, other than in the immediate 15 minutes, to truth social kind of announcements. So I think we've got used to pronouncements and policies being made on Twitter and the social media. But I think the markets are now learning to ignore that, are learning to move on, and are learning to take that volatility in their stride. And especially if you look at the broad directional call, the dollar index, as I speak, is firmly in heading downwards. It's broken its last support at 97. It's now into the 96 handle. The some of the commodities are hitting new 52-week and multi-year highs. Copper, for instance, is at 5.06. So you're talking about a movement away from the dollar, a trend that gets interrupted by wars and stuff like that. But the moment you sort of assume that, wartime phenomena, at best last for a few days because nobody really wants a war. And once that's out of the window, markets are heading. So the broad directional call is the Indian markets are heading higher. Every dip is being bought into. Every nervousness is being sort of bought into by funds. And, while we do see headline numbers of foreigners selling on the secondary markets, but they are big buyers in the primary, in the blocks, etc. So my own assessment is that money is coming into the Indian markets, whether it's FDI or it's FII, but you don't see it on as regular a basis as you should be seeing. The locals are flush with money. They continue to buy into. So it's really the HNIs who have taken a combination of Ukraine, tariffs, and the Middle East to heart and have actually lightened up a lot. And it is that segment of the market which actually makes, very aggressive noises when it comes to prices in stock markets. That large HNI segment is today sitting on cash and is what I would say logically concerned and logically bearish. Therefore, the markets aren't in a mood to oblige them.
All right. Hi, Jakes. Since you mentioned the dollar index, and I know you like some commodities, what do you like right now? Vedanta is something I think that you've been quite bullish on. The stock hasn't done much of late, but the parent is getting things in order. And you have a big special situation that's coming up. Has its time come, or is the street concerned about something or the other with regard to the name because of what history has taught them?
I don't like to talk about specific stocks, but one of the things about special situations is today the market cap of a large player like Vedanta will get fragmented into 4, 5, 6 different pieces. When that happens, it's possible that a number of institutional folks may actually find that it is dropped away from the radar of meaningfulness, if you will, and therefore many of the pieces will come up for sale. So while you say it's an important piece and it can generate value, but this is the kind of stock which HNI should savor, because the value of individual pieces will be significantly more than the composite whole today. The thesis is not wrong, except the buyers would be HNI and family offices, and not so much, or individual folks who want, let's say, people who want an exposure in copper, somebody wants an exposure, let's say, in metal, somebody wants an exposure in, maybe the infrastructure part of it, if you will. So it's not as though this is a straightforward slam dunk of a situation for institutions, but certainly for HNIs with high dividend, the parent getting its act together, etc. And it must be, taken with the disclaimer that I would or could possibly have an interest. But this is more a discussion, not so much in Vedanta as the space it is in is actually well linked to a dollar weakness. But the space it is also in is important from a perspective that people who like metals could come into this, and this hasn't performed. So from all those perspectives, it's great. But the demerger itself has some inherent issues of market caps post the individual pieces getting listed.
And though in the last 1 year, it's showing that the stock actually hasn't moved. They've given dividend of around 40 rupees. So you need to take that into account as well. 40 rupees is the cumulative dividend. And at the point that Jakes is making is currently the market cap's around 1,88,000 crores. They have a debt of close to 50,000 crores, which is 2.3 lakh crore. And the estimates throw up that on a consolidated basis, they'll do EBITDA of around 45 to around 48,000 crores, which means the stock is available a little south of around 5 times EV upon EBITDA, which is relatively cheaper. Thanks a lot, Jakes, for joining in. We've taken your disclosure on board as well on that name. We look forward to having a chat with you.
And one final comment, if I'm allowed to have.
Yes, please.
When I got into this, I think I heard Prashant talking about a good-looking screen. I was almost blushing when I said thank you, and I realized he wasn't talking about this.
No, that's
but Jakes, you're on screen. We're on half split screen. I can say it now.
This is fishing in troubled waters. I'm going to be in trouble.
I'm just going to tell the director to come in there. If anything, let's get Surbi on the screen.
It's a great looking screen, gentlemen. And on that optimistic note, thank you so much, Jakes.
Have a great weekend. Have a great weekend.
You too. Have a good weekend. Thank you so much for joining in. Let's quickly take a break on that note. Markets continue to have a fantastic session. Look at the Nifty gallop away, 25,500 plus. And now there's momentum. The last little spike is also coming through. We'll take a break, come back and get you more.
Welcome back. Well, it's that time of the day where we go to D Street Chatter. Nimesh joins us to tell us what's going on there. Nimesh, the expiry goes to the Bulls. They'll be feeling good. Ending the series on a high is always a great thing. What's your sense in terms of flows?
Absolutely, Nigel. You know, perfect play to the expiry today. Nifty is up more than 1%. Technically, too, we've been now closing above the very important resistance of 25,350. So clearly, it looks like there is a breakout now on the Nifty, and that can take the Nifty further higher. That's the sense I'm picking up. Flows won't matter much today, Nigel, clearly because of the expiry. So could be all over the place. But from a directional point of view, I think it's the OMCs which are again well bid by the large institutions. You would be an happy man because both some of your sectors are doing good today. Cement is buzzing, so is metals as well. So big moves on those sectors, so to speak. But again, looks like more of an expiry kind of a move. For cement, though, the street chatter or the market feedback is the next big trigger for cement could be the GST rationalizations. If that has to happen, that could be a big trigger for cement stocks. Again, from a direction point of view, I guess there are last couple of days left for the Ps and promoters to sell stake. Post that, I guess the focus will move back to the secondary market stocks. So maybe that also explains in the last couple of days the broader market stocks have started performing, and a lot of mid-cap and micro-cap stocks have started seeing big moves. So that's the kind of feedback. But clearly, the expiry seems to be for the bulls and above the breakout level. So looks like this momentum can continue.
Okay, well, Nimesh, thanks for that. In terms of specific stocks, what's the buzz?
Well, the first stock is Zomato, which is eternal. Again, it's been long pending, but looks like that block is finally coming in Zomato. Remember, as I've been saying, these are the few days left for the Ps or the promoters to sell. A small stake is left over for a strategic investor that can get sold out very soon. So that's the first name. Second stock is Siemens Energy. Well, the stock has recovered from the listing lows. Today will be an important day because it's getting exited from all the indices, the Nifty Next 50, the Nifty 100 as well. I understand there will be a passive selling of close to 20 lakh shares. But at the same time, there are some domestic mutual funds who are aggressive buyers. And one specific fund has been buying aggressively in the last couple of days in Siemens Energy. So that's the second stock. The third stock is KPIT Tech. Ever since the company announced a mid-quarter update, which is a bit weak, the stock has been under pressure. But for the last 2 days, I'm getting a sense of small buying has emerged from larger FIs in KPIT Tech. And the last is Varun Beverages. In a market where it's all buzzing in trade, a lot of mid-caps are also buzzing in trade. Varun is slightly under pressure today, I guess largely because of the large block offer which has been pending. So it's been indicated that there could be a large block offer, and maybe that explains a bit of softness in Varun Beverages today.
Okay, all right, Nimesh, thank you very much for that. Yeah, it's really actually, if you look at the market breadth today, yesterday I suppose it was completely almost one-sided. Small cap index was up 1.5%. Today, I would say broader markets were much more stronger yesterday. Even though on the Nifty the gains are much larger today. Look at the advanced decline, almost overlapping. 1375 stocks are higher and about 1300 stocks are lower as well. So that is the picture at this point. Mitesh is with us with what she'd want you to do with this flourish of a day that we have on our hands. Mitesh, near-term trading ideas?
So I have BTST on Nykaa. I think it's been a stock which has done well, and I've given calls on it a couple of times. And now we're breaking out of the 204.5, 205 pivot. So keep a stop at 204. Look for a target of 211, 212. And the other one is BTST on Paytm with a stop at about 908 for targets of 925.
Okay, all right, got that. Thank you, Mitesh, so much for all the calls and the trading advice today. We'll see you again tomorrow. With that, let's move on, putting the spotlight on some individual stocks. Now, Cummins has launched its battery energy storage systems, or BESS, to cater to the Indian market. Vamakshi is joining in with more details. This is a very hot space, Vamakshi. So what exactly is Cummins planning?
Well, absolutely, Surabhi. Cummins who has been actually a leading supplier of diesel as well as gas gensets in India, has now gone ahead and launched BESS, which is battery energy storage systems for the domestic market here. Now, just to give our viewers some context, BESS is a technology that actually stores electrical energy in batteries for later use. BESS can be charged from various sources like the grid, from renewable energy like solar as well as wind, and the the energy then can be discharged as far as the use is concerned. Now keep in mind that BESS is an emerging and reliable efficient tech for addressing energy transition needs in key industries such as data centers, commercial realty, manufacturing as well as mining. So thereby you can see how wide the scope of application for this particular technology is, and this bodes well for Cummins because it is a complementary addition to the portfolio. It helps in expanding their sustainable solution portfolio. So therefore it's a positive, and resultantly the stock is up in trade.
Okay. All right. Thanks a lot for that, Vamakshi. Well, let's hop across to the next source-based information we're getting. CNBC-TV18 has learned that SBI has appointed 6 investment banks for a proposed 25,000 crore rupee QIP. Ritu joins us to fill us in with more details. Ritu.
Well, Nigel, that's right. 6 merchant bankers have been appointed for SBI's mega 25,000 crore rupee proposed share sale through this QIP. And we understand these 6 bankers include HSBC, Citi, Kotak, Morgan Stanley, ICICI Securities and SBI Capital, your usual high street bankers. And this comes after the board had already approved this equity fundraise in a meeting last month. Keep in mind, while this board approval for the QIP is valid for 12 months, our sources in SBI indicate the timing of the QIP will very much depend on market conditions. Also keep in mind, this is not exactly growth capital that SBI is looking for. We understand the primary objective of this fundraise is really to augment the bank's capital base. Now, SBI, if you know, its core tier 1 capital is currently among the lowest when it comes to the public sector banking peers, and the idea very much is to cushion that base. Currently, their CET1 ratio is 10.81% and total capital adequacy is about 14.25%. And our sources indicate in the bank that the internal target is to take the CET1 ratio to 12% and the total adequacy to 15% by March of 27, which is where this fundraise is going to help. Of course, we also know SBI is going to get that near 9,000 crores from the sale of its stake in Yes Bank. And then there could be the proposed NSE IPO, which if and when it happens, will also help SBI with capital. Now, if this 25,000 crore QIP goes through, it will be the first share sale by SBI in nearly 8 years and the largest QIP that we've seen in recent times.
Okay, so getting ready to hit the market with that big issue. Thanks for the details, Ritu. We'll keep all of that in mind. For timing, let's go across and say hi to Ambarish Baliga, who's joining us to take us to the final leg of what's been a fantastic day for the market. Ambarish, as we welcome you in. I mean, it's such a strong move, right? 300 points up on the Nifty. The bulls are really charging ahead. So let's start with your stock pick, actually. Now that the market is almost getting back to all-time highs,
right.
What's the stock idea for the day?
Good afternoon, Surabhi. My pick today is JK Lakshmi Cement. Comparatively a smaller player, but a prominent player in cement markets of North, West and East India. Consolidated capacity is about 16.5 million tons. They have 7 cement plants, 4 AAC block plants and 21 RMC plants. And they have many value-added services and products which actually contribute to about 9% of the top line. Cost optimization is what they've been doing for a while and expected to save about 60 rupees per ton in FY26, about 80 rupees per ton in FY27. And in the next 5 years, they should be nearly doubling the capacity to about 30 million tons plus and getting into the Northeast market in a big way. So that's again the other positive. So expected EPS for FY27 is approximately about 45. And with this, my target price is about 1,035.
Amrish, what if they go ahead and do some inorganic growth?
I mean, if they do that, that's again quite positive because end of the day, whoever is adding capacity, becoming a larger player, I think should be looked at because one, the cement demand will continue to move up, looking at the way the infra projects have taken off, the way the real estate is going. And at the same time, I don't see the capacity building actually, keeping pace. So after seeing the volume growth in the last couple of years, we've not really seen the margin moving up. So I think that's what we'll see over the next 4 to 6 quarters for most of the cement companies. We'll see the margins going up. And that's what will be a kicker for us investors because we've not seen really major gains in cement space, but that's what we'll see now going ahead.
All right. Amrish, there were a couple of other positives that came out today from the broader markets. I'm not sure whether you track Lloyd's Metals. It was on expected lines that they were expected to get the permission to mine more. Last year, they sold 10 million tons of iron ore. Now, this year, they were optimistic that they'll get higher, permission to mine more. And that's come about. So this year it will be 25 million tons. But it's not a surprise because the street was anticipating that. They've given a guidance on around 23 million tons.
Absolutely.
Any view on this name or the smaller player, which is Lloyds Engineering Works? That will do some part of the work for Lloyds Metals. I think their order book is around 1,300 crores. Out of that, 45% is from Lloyds Metals itself. Any view on either of these two names?
No, Lloyd Engineering I really don't follow too much, but yes, I mean, looking at the order book, which is again mostly in-house, I mean, I would normally not look at companies like those. But Lloyd Metals, I think at these levels, with most of the news which was clearly expected, has happened now. So I don't see too much of an upside from here. It's already, I think, closer to a 52-week high. And because of this news, possibly we could see either 100, 150 rupees more. So I would really look to buy at this point of time.
Look to buy, right? Lloyd Metal.
Yeah, I would.
All right. So you believe bulk of the good news is in the price. Got that. You know, what supports them is the volume growth and the cost of mining. But as you said, the stock, I think just around 3-4 years ago was a 250 rupee stock, which is currently at around 1,550. So Ambarish's call is he would stay away from this name because most of it is in the price. Well, time to slip into a short break. As we do that, here's some good news for our viewers. India's business news leader is now just a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, financial world updates, all of this at your fingertips. Download the CNBC-TV18 app now from the Apple Store or from the Google Play Store, or simply scan that QR code that's up for you on the screen.
Welcome back. Well, galloping along 300 points higher. That's what we have on the market this afternoon. Mid-cap index a little behind the large cap screen, but the large caps are really on fire today. That's the kind of session that we have had. Amrish is still with us, and by the way, a lot of financial stocks are doing really well this afternoon. Banks and non-banks. Shriram Finance, Jio Finance, Bajaj Finance, HDFC Bank, HDFC Life, Axis Bank. It's a full green screen when it comes to financials today. Amrish, give us a pick in this pack.
In this pack, there are a couple of picks. After a long time, again, HDFC Bank, again, it will benefit from this sale of equity in HDB. And at the same time, stocks like ICICI Bank in the PSU space, SBI, BOB, PNB, which again hasn't really performed too well in the recent past. I think that's another pick as far as I'm concerned. But nothing much in NBFC, but mostly into banks.
Amrish, any view on Tube Investments? It's up close to 5% after a while. It's come on the radar.
Yeah, but I really can't comment on this group since my brother is an independent director with that group.
Okay, all right. Taken that on board. What about a couple of other names? UPL, the street is fretting something on this name. And that's why earlier this morning as well, the stock was down, I think, 3% in the first 30 minutes itself. There were some on the street that were bullish. At around this 600-700 rupees. They were saying how much of the bad news is in the price. Even after various restructuring and all sorts of things, repaying debt, the street is not willing to give it a value. What's your take?
I think the debt burden, which I think is a major negative. And at the same time, every time when the earnings are being declared, there's an expectation that the worst is behind and things should improve going ahead. But again, we have, hardly got any positive surprises from this group. So again, I don't see this stock going much beyond 700. I think that's where it gets stuck. So as traders, I think one could look at buying at closer to about 600, 610, and looking at an upside of about 670, 680. But for an investor, I think like an investor could really get tired. Waiting to see this stock perform.
Look at something like a Pakka Packaging. 14% higher. That's P spelled PAKKA. On the NSE, we can pull it up. I remember SBI Mutual Fund picked up about an 8% stake sometime back. It was the talk of the town back then, but really a big fall. 360 levels back in December of 2024. It fell to about $150. And from there, it's making a bit of a comeback. I don't think we've still found PAKKA, if we have it, on BSE or NSE. Anyway, I don't think we'll add that to the list of stocks we can show. Nuvama is up 5%, 7908. That's doing well after a while, I think. And Hindustan Copper is another name, 5%. Lots of action actually, but it's, I would say, in the intensity and volume of the broader market action, it doesn't match to what we saw in terms of trade and what we had yesterday. MobiKwik, FirstCry, etc. Of course, we've been discussing earlier on as well. On the downside, lots of names, but Infibeam is the big one. But again, it's a small stock now. But third largest volume-led loss on the NSE now, 17% cut. Any thoughts on Walkhard? This again has been one of those rocket moves, Amrish. I know you typically don't like to look at these kind of names. We've already done very well. You try and find stuff which is done poorly and is ripe for a bit of a turn. But any thoughts here?
No, I really don't track Walkhard very closely, so it's difficult for me to say anything about it.
Do you track a company called Panacea Biotech, Amrish?
No, even that, unfortunately, I don't track.
I see. Got that. No problem. I don't know if Nigel has already asked you about defense. Anything on your radar? Or again, too hot to handle?
No, it's the valuations are a bit too high. And I would say that possibly execution could be an issue going ahead. Because sort of orders which they have got, I don't think their capacity can really take care of the order flows which you have seen. And the market, unfortunately, has only discounted the order flows. They are still not discounted the execution risk. I mean, we have seen that execution risk as far as HL is concerned, and when that came to the fore about the Tejas delivery, the stock had corrected again. From there, it's moved up because it's more of sentiments which are playing on the defense. I mean, if you're talking of the next 5-8 years, yes, I mean you need to be positive on the defense stocks, but then at a price. So at these levels, I'm finding them quite expensive from an investment perspective. But for a trader, clearly, I think it's in their favor. The momentum is on with so much of geopolitical issues which we are seeing. I mean, there would be interest continuing in defense, but I would possibly stay a bit cautious as an investor.
Okay, all right. Amrish, thank you very much for all the perspective today. We'll quickly recap what's been a fantastic day for the bulls. Look at the market go 25,549. The bulls punching through the trading range, really slamming through it over the last 2 sessions. So the Nifty winners today, like we were just discussing, lots of the financial stocks have done really well. Shriram Finance, Jio Finance, HDFC Bank, HDFC Life, Axis Bank. So financials are running along. Global facing stocks, particularly metals, very, very strong today. Tata Steel, Hindalco, the gains are almost 3% on these stocks. Then you have names like Bharti Airtel, 2.5% higher, Reliance, 2% higher. So all the big boys standing up and being counted. L&T, about 1.5% up. ITC, just go on. It's a long list of winners on the screen. On the flip side, actually not too much complaint on the Nifty at all. Dr. Reddy's, because of that City note, which is a little bearish on the stock, down 1.5%. And relatively speaking, IT was a little quiet. Tech Mahindra, Wipro and TCS, all of those stocks have a smidge of red on them. But it's not a day to count the red. It's all about the green this afternoon.
Then let's give you some green. Orbit Exports, that stock was up close on 20%. It's been a while since we looked at this one. Brainbees Solutions up 17%. Jai Balaji up close to around 14%. Remember, these are names we don't talk about on a day-to-day basis, but there were massive volumes on these names. Aztec Life Sciences, well, that one was up more than 10%. Centim Electronics up another 10% in today's trading session. Lloyd's Engineering Work up close to around 9%. Lloyd's Metal has the positive announcement today, but Lloyd's Engineering Works did very, very well. So that stock as well up and about. All in all, a rocking trading session for the bulls. They end the June series on a high, go with gains of around 300 points, and the Nifty Bank got into form late in the trading session, but that as well goes home with gains of around 600 points. We'll wrap up on this edition of Closing Bell. Stay with us. Markets Forward comes up next.
Fire, fire. We all want fire. These streets sees huge gains amidst positive global cues. The Nifty rises above 25,500 to end at a near 9-month high. Nearly 40 Nifty stocks close higher, with financials and metals being top gainers and media, realty and IT being the top laggards.
State Bank of India has appointed 6 investment bankers to manage a planned 25,000 crore QIP that will help augment its capital base for growth. The move comes on the back of RBI's big liquidity push for credit.
There's a block deal rush with big trades seen in PB Fintech, Coforge, Delivery and One MobiKwik aggregating to over 1,700 crore rupees. The flurry comes ahead of the start of the Q1 earnings season. Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key highlights of the trading day that was, and of course, and prepare you with all the key data points about the day that's coming up. I'm Surabhi Upadhyay, and with me on the show is Ekta Batra. And Ekta, what a session we've had today, right? The bulls came back in full marching force. Yesterday, I think they made their presence felt, but today they stamped their authority on the street.
Hi, Surabhi. Yes, absolutely. This is what it takes when, the geopolitical risk really recedes globally. But nonetheless, we saw the Nifty rising above 25,500. It was nearly a 9-month high for the markets today. Heavyweights such as Reliance as well as HDFC Bank were really the biggest Nifty contributors in today's trading session. And to put it into perspective, it was a large gap rally that we saw because the advance decline ratio was largely even keel. So it was not much contribution from the broader markets, but nearly 40 stocks closed higher today. Financials and metals really being the top gainers today.
Absolutely. I mean, a strong day, whichever way you look at it. And it seems that finally, the Nifty managed to shrug off all the uncertainty and all of the indecision that was a hallmark of the first half of the week. The second half is turning out to be very, very good. And if there's one niggling complaint that some people may have, it's the fact that the mid-cap index wasn't galloping along as much as the Nifty. I mean, relatively speaking, the mid-cap index was up about 0.5%, but the advance decline ratio was positive. And today's day was all about heavy-duty, large-cap buying. And we'll talk about that as we go forward. So let's quickly tell you what we've lined up on the show for you today. We'll start off with, of course, the key movers and shakers. And Vivek will give us a blow-by-blow account of all the green that we saw on the screen. Of course, we'll also talk about some of the key events to watch. We'll talk about some of the key stocks that were in play as well. But let's kick it off then with the day's trading action. Vivek, over to you.
Well, thank you so much for that. Like you mentioned, today a day that was led by the large caps, and the large caps are the one that did very well. Now, apart from the names that you mentioned, one section of the market that did quite well today was actually the NBFC names. All of the NBFC names, remember, there's a large IPO and there's a valuation rub-off effect that a lot of these players are enjoying. So look at names like Bajaj Fin, Shriram Fin, Aavas. All of these names doing very well in the session, all of them gaining over 2% each. One stock that we didn't discuss too much was First Fry or Brainbeat Solution, up 17%, the top gainer as far as the NSE 500 was concerned, and one of the stocks that had significantly higher volumes today. The other set of stocks that did very well was the cement pack. Remember, they've been under pressure, but today the entire pack moved higher, led by the large cap names. Even a name like Dalmia Bharat, largest mid cap company, up almost 5%. Also have a look at some of the other names that did very well. Have a look at Cummins. Positive news flow coming in there. A new launch as far as the clean energy market is concerned. That particular stock higher by over 1.5%. On the other hand, very few stocks that did poorly in the session today, but largely profit booking was witnessed across the entire IT pack. Names like OFSS, TechM, LTI Mindtree, all of these stocks cooled off a little bit from the recent highs. One stock that had a significant rally, Endurance Technologies, today saw quite a bit of profit booking, almost 5% lower, and the entire realty pack that ran up in anticipation of the rate cut, post the rate cut, but today the entire pack did see some profit booking. Names like Soba, Prestige Brigade among the top laggards today.
Okay, Vivek, thanks very much for that. So that's a snapshot of all of the stocks that were in focus. We have our guests with us this evening, Ambrish Baliga, independent market expert, and Somil Mehta from Mirae Asset Sher Khan. Thanks, gentlemen, for joining in on the show. Well, Ambrish, let's start with you. It turned out to be a session where we've recaptured 25,500. What is your sense in terms of the momentum going forward? Do you think this will sustain?
See, technically, 25,200 was a major resistance, what we have seen for the last couple of weeks, if not months. And today, I think it has decisively broken out of that. And because of which we'll see the momentum continuing. Because, again, the FOMO thing would come into the markets because there are a lot of people, especially on the HNI side, who had sold off in a big way during Operation Sindoor and post that during the geopolitical issues, which we saw, recently the Iran-Israel issue. So, these people are sitting on cash, hoping that the markets will come down, which never happened. So, I think that FOMO effect will come into play, which I think could actually take the markets higher from these levels. In fact, I'll not be surprised if we see levels of closer to about 26,000 over the next couple of days, if not a week or two.
Okay. All right. Got that. Ambrish, today we saw pretty much an across-the-board kind of a move. It was everywhere, barring IT. Large caps, everything else was up and about. So in this phase of the market, when we're barely like 2-3% away from all-time highs, in terms of placing fresh money, do you have a sectoral preference or is it going to be entirely bottom-up?
No, at this point of time, I will not really go in for too much of fresh investment because whatever I had to invest, I had invested much earlier, especially, when we were, in fact, sitting on 35-40% cash and we were expecting the markets to come closer to about 22,000 levels. That happened. We got completely invested. And during the geopolitical issues which we faced, we got into cash to the extent of about 10%, which I'll continue holding. I'll not really buy anything fresh at this point of time for investment. But from a trading perspective, yes, I think it makes sense to ride this rally, maybe closer to about 26,000 levels or closer to the earlier, all-time highs which we saw. I think at those levels, we could see some amount of profit booking coming. So from a trading perspective, at those levels, I would book some profits.
All right. So a little cautious from an investment standpoint. But speaking of trading, let's actually get to Saumil Mehta from Mirae Asset Sharekhan. Saumil, it's turbocharged market all over again. So just tell us from what you see on the charts, the technicals, the positioning. What's the advice?
Good afternoon, everyone. Advice would be buy on declines. Absolutely buy at this levels as well. Targeting at least the all-time highs, maybe even above that very soon. But it's a clear breakout. The range which we have seen in the last 1.5 months, it has been broken out and taken support at 20 daily moving average every time it dips down. So that's a very good sign. High top, high bottom formations on the higher degree time frame. We are on the buy side on the momentum indicator. So great setup. Buy on decline should be the strategy. Nifty targets would be at least the all-time highs, that is 26,200, 26,300 levels.
Okay, all right. So that's a technical call on the markets. However, let's move forward now. There's a block deal rush with big trades seen in PB Fintech, Coforge Delivery and One MobiKwik, aggregating to over 1,700 crores. The flurry comes ahead of the start of the Q1 earnings season. Hormuz is here to tell us more. Hormuz, the momentum seems to be back.
Oh, yes. And how? The last 2 weeks, it's not just today's session, right? Today we did see significant amount of block deals, but over the last 2 weeks, we've already seen block deals with over 20,000 crore rupees. There's a rush from the promoters and institutional investors to cash in on what has been a very significant recovery in the markets from the lows that we saw in April. But take a look at some of these names, right? Vishal Megamart saw block deals worth over 10,000 crores. There were block deals in Dixon Technologies, there were block deals in Hindustan Zinc, Asian Paints. All of them saw majority of institutional investors or promoters cashing in as well. There are stocks like Ola Electric, Sai Life, Quick Heal, MobiKwik, Delivery. Interestingly, a lot of these names have seen block deals take place after their shareholder lock-in period ended, either last week or a couple of weeks earlier. And as, of course, A major factor behind this rush of block deals returning is the recovery that we have seen in the markets. In today, we saw 4 names, as you just highlighted. Other than the fact that there are elevated valuations, there is strong demand, more importantly. Even Vishal Mega Mart, even after a 10,000 crore block deal, the stock has not moved an inch. So you see the kind of demand also that is there for the supply that's coming in. And of course, because of the closure of the trading window from the 1st of July, so just a couple of more days left, expect some more flurry to happen before this trading window shuts.
Okay, all right, Harma's got it. So that explains all the hectic block action that we've had. Amrish, given all the blocks that Harmaz was describing, and so many deals, right, last couple of weeks, is there any one that kind of stands out for you? I don't know if you have a view, for instance, on PB Fintech, but any transactions or any stocks in those transactions that you found interesting?
Look, the stock which you talked about just now, PB Fintech, I think this is one space where I think there is still a decent amount of upside. And I surely will not look at any sort of a founder sale or a promoter sale across, a number of companies which you have seen in the past, couple of weeks. I would not see that as a negative. 10, 15 years back, yes, a promoter selling was taken negatively by the markets, but not anymore. Because clearly, they also need to take some money out. They also need to enjoy their wealth. And this is one of the ways of doing that, because unlike in the past when we have seen promoters siphoning out funds, I think that's come down to a large extent. So the only way they can encash their investment is to sell a bit of their investments. And the best part is it is all getting absorbed very well. Most of the buying is done by the funds, and it's not there in the market as such through retail. And as far as PB Fintech is concerned, looking at the low insurance penetration in India still, I think the upside is extremely good for insurance overall, and especially PB Fintech, because they are the platform. So any sort of a correction, I would look to buy into PB Fintech.
Okay, all right. So that's on PB Fintech. State Bank of India, that's the big story, has appointed 6 investment bankers to manage a planned 25,000 crore QIP that will help augment its capital base for growth. The move comes on the back of RBI's big liquidity push for credit. Ritu's here with more details on that. Ritu.
Well, that's right, Ekta. It's a mega 25,000 crore rupee proposed QIP, and therefore a lot of interest in this. And now 6 merchant bankers have been appointed by SBI for this QIP. Those include, we understand, high street bankers, your HSBC, Citi, Kotak, Morgan Stanley, ICICI Securities and SBI Capital Markets. And this, of course, comes after the SBI board had already approved this equity fundraising in a meeting last month. Now, while the board approval for the QIP is valid for 12 months, our sources in SBI indicate the timing of the QIP will really very much depend on the market conditions. Now, this is not exactly growth capital that SBI is looking for. We understand the primary objective of this fundraise is to augment the bank's capital base. Now, SBI's core equity capital, if you look at it, is among the lowest among its public sector banking peers, and the idea is to cushion that. Currently, their CET1 ratio is at 10.81% and the total capital adequacy is at 14.25%. And our sources indicate that the bank's internal target is to get the CET1 ratio to 12% and the total adequacy to 15% by March of 27, which is where the fundraise is going to help. Of course, we also have SBI getting nearly 9,000 crores from its stake sale in Yes Bank. And then there is the proposed NSE IPO, which if and when it happens will also help SBI with capital. Now, this 25,000 crore QIP, if it goes through, not only will it be one of the largest, QIP that we've seen in recent times, it will also be the first share sale by SBI in nearly 8 years.
Okay, it's a big deal indeed. And a lot of fundraising coming in from the big bank. Thank you for that, Ritu. That's State Bank of India, 797 on the stock right now. Actually, before we discuss fundamentals, let me go to Somil. Somil, on technicals, the whole market's moving higher. You spoke about momentum. Financials anyway are doing very well. How is SBI placed and what would be the next levels you will track?
I think SBI has been negative today, but I think it's a very good setup at this point of time. A big triangle pattern has been forming just above the 200 daily exponential moving average. The momentum indicator has just given a buy signal, a fresh buy signal. The momentum indicators on the higher degree time frame are already on the buy side. So I think this big triangle will break on the upside. I would like to preempt that risk reward ratio is amazing. 779 would be the stop loss, which is the 200 daily moving average. And on the upside for positional trade, I think the next target would be at least 860.
Okay, all right. Well, Ambrish, what would your view be on State Bank of India?
Well, I'm positive on State Bank of India, and this is a very small fundraise which they're doing. I think just about 3% of the equity. Post this over the next month and a half, I'll not be surprised if we see levels of about 880, 900.
Okay, all right. Well, let's now focus on another stock. Texmaco shares witnessed an uptick following the company's announcement of a 535 crore order win. Vinny is here to tell us more.
Hi. So yes, on the back of this order, when we saw the stock buzzing in trade, it was a 62.24 million or 535 crore international order which Texmaco received, and this was from Hindalco SA, which is a Cameroon-based company. Now, obviously, the order is for supplying 560 open-top wagons and providing 20-year maintenance for this as well. The deal also includes a potential expansion that they're going to go for, and that would be of around 1,040 more wagons as well. So a big order win on that front. 535 crores, that was keeping the stock abuzz today.
Okay, all right. Texmaco Rail having a good session, 3% on the higher side. Let's take quick final thoughts with our guests as well. Ambrish, today mid caps were relatively quieter compared to the large caps. But you've put your caution on the table already that you will not be rushing in to buy in the market. But on the mid-cap side, what would be, say, one or two stocks that could be on your radar? Defense, now those stocks are cooling down because the geopolitical headlines are receding, for instance. Absolutely. So would you look at that space?
Depends. I'll wait for some more correction before really buying into those. Whereas some of my earlier picks, like for example, Gland Pharma is one which I'll buy because in fact I have a target of about 2350, 2400 for that stock. Something like J Kumar Infra, where I still have an upside of about 15-18% from here. ABB, I think the sort of earnings which we have seen from this company, upside is about 7.5, 8,000 for this.
Okay, well, let's go on to a CNBC TV18 exclusive now. As per sources, the Insurance Regulator and Development Authority has discovered lapses in health claims of around 8 insurance companies it inspected. Yash is here to take us through the findings and what happens next. Yash, over to you.
So as you correctly pointed out, the insurance regulator, that is the IRDAI, conducted inspections in the first lot of about 8 insurance companies. 4 of these were standalone health insurance companies, and the balance 4 were multi-line insurance companies, having, of course, their health portfolio. What we've been given to understand from our sources is that lapses or irregularities were found with all these 8 insurance companies. But one important caveat here, what we've been given to understand from our sources, is that the degree of lapses, of course, was different for different insurers. For some, as I'm told, this was at a very ignorable level, but for others, it was serious as per the insurance regulator and the sources there. Which are these 8 companies which were inspected? These included Niva Bupa, Star Health, Care Health and Manipal Cigna. Also, in terms of multi-line insurance companies, these included Tata AIG, ICICI Lombard, as well as HDFC Ergo. What we've been given to understand is that the regulator, looking at the violations which have come or irregularities which have come from the first 8 companies, has decided to expand its scope for inspection, going to all general and standalone health insurance companies. And once the investigation ends, the regulator could possibly look at either putting a penalty or even asking insurance companies to refund money to their policyholders where there were irregular claim settlements along with the interest attached to it.
Okay, all right, got it, Yash. Thanks very much for that. Well, on that note, we do have to take a very quick break. We'll thank both our guests for joining in, Somil as well as Ambrish, for being with us this afternoon. Well, as we take this break, let's leave you with some commentary that we picked up from Vikash Kumar Jain of CLSA. He believes that earnings downgrades are likely to continue and that the Indian market would perhaps be range-bound in the best case.
The problem is where expectations are today. Of the NSE 500 stocks where there is enough coverage, more than half of the stocks expect earnings growth to be over 20% CAGR over the next 2 years. More than half, at a time when nominal GDP growth may struggle to be even 10%. So that, to me, is possibly quite optimistic expectations. So from a bottom-up perspective, my worry is that earnings cut might very well continue. So what we are seeing is not really any big, strong news flow to drive a massive rally in the market. So we might be in a range-bound market like we've been for the last 12 months or so.
Welcome back. You're still tuned into Markets Forward. Now let's go across to some key corporate voices that we had through the day. The management of Sona BLW spoke to CNBC TV18 about the former chairman Sanjay Kapoor's vision for the company, saying Kapoor had chalked 25 years plan for the company. Adds that hopefully the new chairman will have a same mindset akin to Kapoor. Goes on to add that the company grew 10x in the last decade and is quite optimistic about the company's future growth as well. The company has plans to add more product verticals. That's not all. The company is also keeping a close watch on the rare earth situation, as that the rare earth magnet crisis is real and will have an impact in the short term. However, indirect impact of rare earth crisis will be difficult to estimate at this point.
Next up on our radar is Keystone Realtors. The management says demand remains extremely strong. They add that the mid-market and aspirational segment are the largest growing for them. The focus is on premium and that remains a pretty high growth area for Keystone. The management maintains its guidance for launches at over 7,000 crore rupees for FY26. It is optimistic of even crossing this target.
All right, and next up is Senco. The jewelry retailers saw marginal stress in terms of footfalls and traction in the month of July. Further, management expects 20% value growth in Q1 of FY26. As this value growth continues, even as volume softens, further guides for a slight boost in the margin on the back of lower gold hedge.
Okay, and with that, it is time for us to sign off. But before we go, of course, we have to get you a wrap of all the key events to watch out for tomorrow. It's over to Upasna for that.
Well, let us look at the economic cues first. All India Index of Industrial Production will be out tomorrow. Now, moving to European Summit concludes tomorrow, which started today, so we'll be watching out for that. And even economic sentiment data will be out tomorrow. Coming to UK now, the Q1 GDP data will be out along with the current account data. US core PCE price index data on month-on-month basis will be out along with the consumer sentiment data. Now let us look at the key stocks in focus on the back of corporate action. Infibeam Avenues marks as the record day tomorrow for the right issue of its shares. HDFC Bank has also fixed 27th of June as the record date for its final dividend. And lastly, coming to the important board meeting, Hindustan Copper to consider fundraising up to 500 crore via NCDs or bonds on a private placement basis. This board meeting will be held tomorrow. And lastly, coming to the IPOs, HDB Financial Services and Sambhav Steel, both these IPO closes for subscription tomorrow. So all in all, looks like quite an eventful day.
Okay. All right. On that note, it's a wrap on this edition of Markets Forward. We'll be back with more news and updates on the other side. Stay tuned.
Hello and welcome to Business 360. I'm Shriram Finance. The headlines that we're tracking for you this evening. Bulls maintain the winning momentum on the Lal Street. The Nifty reclaims 25,500. The Sensex gains over 1,000 points. Nifty Bank ends at a record closing high. The ceasefire between Israel and Iran holds for the third day in a row. Top U.S. officials cite new intelligence to back President Trump's claims that Iran's nuclear facilities have been destroyed. India refuses to sign the joint declaration at the Shanghai Cooperation Organization meeting after it failed to mention the Pahalgam attack but included the Jafar Express hijacking in Pakistan. Defense Minister Rajnath Singh slams double standards, this as the first visit to China by a cabinet minister since the Galwan clashes in 2020. The 12,500 crore rupee IPO of HDB Financial is fully subscribed on the second day. High net worth individuals and existing shareholders lead the demand. SBI appoints 6 book-running managers for a 25,000 crore rupee fundraise. Sources say the bank does not need growth capital but wants to augment its capital base. This will be the first share sale since 2017 if SBI decides to proceed. 8 health insurance companies under the lens over claim rejections, delayed settlements and unnecessary deductions. Sources say insurers are likely to be asked to pay a penalty and return money to policyholders with interest. JSW Paints is all set to sign a deal to acquire AkzoNobel's India assets either this week or the next. CNBC-TV18 had reported last month the 10,000 crore rupee deal is likely to be inked by the end of June. Global energy giant Shell refutes reports of any talks with rival BP over a potential $82 billion deal. Wall Street Journal reports that talks at an early stage, even as Shell dismisses the report as market speculation. The late Sanjay Kapoor always wanted Sona Comstar to be prepared for the next 25 years, says the company's MD Vivek Vikram Singh promises to continue on the growth path after the 53-year-old Kapoor passed away 2 weeks ago. Aviation Ministry says extraction of data from the black box of the crashed Air India Boeing aircraft is underway. The data will be analysed at the Aircraft Accident Investigations Bureau's lab in Delhi. The plane crash killed 275 people. Well, let's begin with the day's market action and a strong close propelled by positive global cues. The Nifty reclaiming 25,000, closing at a 9-month high. And that was the picture there, 1.2% higher, 300-point up move. The Sensex closing 1,000 points higher. Nearly 40 Nifty stocks today closed higher, with financials and metals topping the list. The Nifty Bank also 1% higher. The mid-cap index closing about 0.5% higher or so. That's the market action for you with a big global story. President Trump has hinted that he could choose U.S. Federal Reserve Chair Jerome Powell's successor soon. Speaking at the NATO summit at The Hague, President Trump continued his criticism of Powell and said that he has 3 or 4 people in mind for the job. Powell's term is set to end next year in May.
You were criticizing the Federal Reserve Chair before coming to this summit.
Yeah, I think he's terrible.
I was wondering if you've begun interviewing different candidates for the Fed pick.
Yeah, I know within 3 or 4 people who are going to pick. I mean, he goes out pretty soon, fortunately, because I think he's terrible. We have no inflation. We have a tremendous economy. Hundreds of billions of dollars of tariff money is pouring in. Factories are being built because they don't want to pay the tariffs, so they're building them all over the country.
Well, that's President Trump continuing to rail against Jerome Powell. Now, the fragile ceasefire between Israel and Iran has continued to hold for a 3rd day. President Trump has said that American and Iranian officials will talk next week. Speaking at the NATO summit, President Trump said he will not restart negotiations with Iran as the U.S. had destroyed its nuclear program. This comes as CIA Director John Ratcliffe said that intelligence indicates that Iran's nuclear program was severely damaged by U.S. strike. This after an initial intelligence report was leaked yesterday claiming the nuclear facilities were not destroyed. Today, more top White House officials backed President Trump's claims. Meanwhile, the heads of the European Union's 27 member nations are meeting in Brussels to discuss the tensions in the Middle East. The leaders of the bloc are looking to revive diplomatic negotiations with Iran over its nuclear program. After a push from President Trump, NATO leaders have agreed to increase their defense budget to 5% of GDP. Prashant is standing by with more on the significance and impact of this landmark decision. Prashant, President Trump taking credit for this, but in effect, what does this now mean as far as this NATO bloc is concerned? What does it mean for defense spending and defense companies?
Oh, absolutely. It is a historic shift in European security policy. At the just concluded NATO summit in The Hague, the alliance's European members have agreed to dramatically boost defense spending over the next decade or so. A move which was hailed as a quantum leap for collective security by NATO's Secretary General Mark Rutte. Remember, President Trump has been threatening to pull out of the NATO alliance unless NATO's European member countries themselves stepped up spending on their own defense substantially. Looks like the threats have worked. So NATO's 30 European members have made a big commitment to ramp up their defense spending through to 2035. What, of course, is also in the background is the looming threat of Russia, as many European leaders have said. That country's invasion of Ukraine, as we all know, 3 years back, has meant that EU countries, which have long depended on the US, are now turning inward. In the official communication, NATO leaders pledged, and I quote, allies commit to invest 5% of GDP annually on core defense requirements as well. as defense and security-related spending by 2035, end of quote. This is more than double the previous target and marks the most significant hike in over a decade. The new commitment is split into two essential categories. At least 3.5% of GDP will go towards core defense, troops, weapons, military operations. Up to 1.5% of GDP will be allocated for broader security needs, including cyber defense, critical infrastructure protection, and energy security. Notably, remember, Spain withheld from this commitment, citing economic constraints. Well, guess what? US President Donald Trump, who has long pressured allies to spend more, responded with a warning about potential higher tariffs on Spanish goods. But overall, Trump struck a positive note on Europe, saying, and I quote, "We are here to help Europe protect their countries," end of quote. Some numbers now. Back in 2021, Europe was spending about 1.5% of GDP on defense. By the end of 2024, that figure had risen to about just under 2%, translating to roughly about 450 billion euros. Analysts at Bank of America estimate that if the new 3.5% core defense target is met, annual spending could soar to between 850 to 900 billion euros. It'll represent hundreds of billions of dollars and euros in new military investment. The big question is, how much of the 5% number is rhetoric and how much of it will really happen? Remember, President Trump will demit office in 2029. Can we really know what the world will look like after 2029? I'm not so sure. So yes, while this is a big commitment, we will have to track how much of it really comes through in terms of spending and orders. Back to you.
Yes, Prashant. Nevertheless, a big development there. Thanks very much for joining us. Now, India has refused to sign a joint statement at the Shanghai Cooperation Organization meeting as it claims it diluted the country's position on cross-border terrorism. This after the document failed to mention the Pahalgam terror attack, but it included the Jafar Express attack in Pakistan. The meeting ended without a joint communique due to Defence Minister Rajnath Singh's refusal to endorse the statement. Addressing the SCO meeting, Rajnath Singh reiterated India's firm stance against terror and said that peace and prosperity cannot coexist with terror. In a veiled reference to Pakistan, the Defence Minister said there should be no place for double standards at a multilateral forum.
It is imperative that those who sponsor, nurture and utilize terrorism for their narrow and selfish ends must bear the consequences. Some countries use cross-border terrorism as an instrument of policy and provide shelter to terrorists. There should be no place for such double standards. Yes, you should not hesitate to criticize.
Well, that is Defence Minister Rajnath Singh speaking in China. Parikshit Luthra with us. Parikshit, the Defence Minister refusing to sign the communique on the back of the fact that the Pahalgam attacks were not mentioned there. Now, where does this leave, the SCO engagement, but more importantly, the India-China engagement as well?
You know, even previously, Shireen, India has not signed statements related to the SCO declaration because we did not approve of Chinese language on the CPEC or the Belt and Road Initiative. So India's stand was very well known. Now, when it comes to the issue of terrorism, we saw how China made references to terror attacks in Balochistan, but did not want to make any reference to what has happened in Pahalgam. So what we saw, and this is what sources accompanying Rajnath Singh said, that there was a dilution of India's stand, and therefore we could not endorse this statement. So there is no draft that has been finally approved by the SCO Defence Ministers meeting, but this is itself very, very significant. This is the first time that Rajnath Singh, the Defence Minister of India, is travelling to China for a meeting since the Galwan attack took place in the year 2020. A lot of discussions are taking place between India and China on how to manage this relationship better. But Rajnath Singh there making it very clear that if India is ever attacked again through terrorism, we will hit back. And the safe havens of terror are no longer safe. And the action was directly aimed at Pakistan. We've been grappling with the rare earth magnet issue. China has lifted curbs for other countries, but not for India. Clearly, there is discomfort, anger with some of the curbs that India has imposed on Chinese companies, actions against Chinese CEOs. There have been enforcement directorate investigations as well against certain Chinese phone majors. So all of that has irked China. This would be a complex relationship which we are trying to manage, but there are difficulties which still remain. And that's why you're seeing a lot of high-level meetings like
Ajit Doval going to China for the SCO meeting. Before that, a meeting between Sun Weidong of Chinese Foreign Ministry and Vikram Misri in Delhi.
All right, Parikshit, many thanks for joining us. Well, this is the big story. The Axiom 4 spacecraft carrying Indian astronaut Shubhanshu Shukla and 3 others has successfully docked at the International Space Station. You are looking at live visuals that are coming in from NASA as the spacecraft docks at the ISS. This makes Group Captain Shubhanshu Shukla the first Indian at the International Space Station. A big feat there with the Axiom 4 docking at the International Space Station. Now, State Bank of India has appointed 6 investment bankers to manage a planned 25,000 crore rupee QIP. The QIP will be the lender's first equity fundraising since 2017. Ritu here with more on this mega fundraise. Who are the bankers, Ritu? What's the timeline?
That's right. State Bank of India has appointed 6 merchant banks for its mega 25,000 crore rupee propose share sale through a qualified institutional placement or QIP. We've been given to understand that SBI has appointed HSBC, Citi, Kotak, Morgan Stanley, ICICI Securities and SBI Capital Markets as the book-running lead managers after, of course, its board had already approved this equity fundraise in their meeting last month. Now, while the board approval for the QIP is valid for 12 months, our sources in State Bank of India indicate that the timing of the QIP will very much depend on market conditions. Now, this is not exactly growth capital that SBI is seeking. We've been given to understand that the primary objective of this fundraise is to augment the bank's capital base. Now, remember, SBI's core equity or CET1 is among the lowest among its public sector banking peers, and the idea really is to cushion that base. As of now, SBI CET1 ratio stands at 10.81% and its total capital adequacy at 14.25%. And our sources indicate that the bank's internal target is to take the CET1 ratio to 12% and the total capital adequacy to 15% by March 27, which is where this fundraise is going to help. Of course, SBI will also get that 8,889 crores from the sale of its stake in Yes Bank. And then there is the proposed NSE IPO, which if and when it happens, will also help SBI garner more capital. Now, if this 25,000 crore rupee QIP goes through, it will be the first share sale by SBI in nearly 8 years and one of the largest such sale through a QIP that we'll see.
Well, that's the mega fundraise plan for SBI. Ritu, many thanks. The Dalal Street has seen a flurry of block deals today with promoters looking to offload holdings worth over 1,700 crore rupees across 4 different company shares of Delivery, PB Fintech, Coforge and recently listed MobiKwik Systems changed hands today. In fact, the markets have seen block deals of over 21,000 crore rupees in the last few weeks, with the promoters of Hindustan Zinc offloading stake among many others. Walmart's global CEO Doug McMillon met with Prime Minister Modi during his 2-day visit to India this week. During the meeting, McMillon reiterated Walmart's commitment to source $10 billion annually from India by 2027. He added that the company was actively working with local suppliers to reach the milestone. Around 8 health insurers, including Niva Bupa, Star Health and Tata AIG, are under the regulator's scanner for allegedly violating norms related to the claim settlement process. Sources say these insurers may be asked to pay a penalty or return money to policyholders with interest. Yash is standing by with the details. Yash, what are the violations?
So as you correctly pointed out, the insurance regulator, that is the IRDAI, conducted inspections in the first lot of about 8 insurance companies. 4 of these were standalone health insurance companies and the balance 4 were multi-line insurance companies having, of course, their health portfolio. What we've been given to understand from our sources is that lapses or irregularities were found with all these 8 insurance companies. But one important caveat here, what we've been given to understand from our sources, is that the degree of lapses, of course, was different for different insurers. For some, as I'm told, this was at a very ignorable level, but for others, it was serious as per the insurance regulator and the sources there. Which are these 8 companies which were inspected? These included Niva Bupa, Star Health, Care Health and Manipal Cigna. Also, in terms of multi-line insurance companies, these included Tata AIG, ICICI Lombard, as well as HDFC Ergo. What we've been given to understand is that the regulator, looking at the violations which have come or irregularities which have come from the first 8 companies, has decided to expand its scope for inspection going to all general and standalone health insurance companies. And once the investigation ends, the regulator could possibly look at either putting a penalty or even asking insurance companies to refund money to their policyholders where there were irregular claim settlements along with the interest attached to it.
Many thanks for joining us, Yash. Staying with insurance, the regulator is likely to continue with limits on management expenses beyond this financial year. Several insurance companies raised concerns over the limits, but the regulator is likely to extend them beyond FY26. Sources add the IRDAI is unlikely to cap commissions for individual business segments. We will head into a break, but up next, JSW Paints is all set to sign a deal to acquire AkzoNobel's India assets this week. That and more when we return. JSW Paints is all set to sign a deal to acquire AkzoNobel's India assets this week. CNBC-TV18 had reported last month that the 10,000 crore rupee deal is likely to be inked by the end of June. Rachna is here with more. Rachna.
Well, JSW Paints and AkzoNobel are close to signing on the dotted line. Sources tell me that Parth Jindal-led JSW Paints may soon pick up nearly 75% in Dulux maker AkzoNobel India for over 10,000 crore rupees. As you may remember, CNBC-TV18 had first reported on the 26th of May that this deal was close to being finalized and will be signed around this time. What we also learned is that this deal would value AkzoNobel India between 12,500 and 13,000 crore rupees. The deal has been a while coming. Akzo's Dutch parent, AkzoNobel NV, had initiated a strategic review of its South Asian decorative paints business in October 2024 and has since been carving out its powder coatings and R&D arms into separate entities while planning to sell the paints business. So once done, AkzoNobel India's Dutch parent will be exiting the Indian market completely. Interestingly, when we reported on this deal in May, AkzoNobel's India market cap was at around 16,000 crore rupees. Today, that market cap has fallen to 14,500 crore rupees. And so this deal is still at a discount to the valuation assigned to the company by the street. I also want to draw your attention to the timing of this deal. There's a time when legacy leaders like Asian Paints, Berger, Kansai Nerolac are already facing heat from a new wave of challengers. These are Birla Opus, Astral, JK Cement and Pidilite's Haisha Paints. And so adding AkzoNobel's portfolio capacity and distribution chain is expected to be a transformational move for JSW Paints, which has been in the business for just 5 years now. Experts also tell me that once the synergies kick in, the deal could redraw the contours of India's 70,000 crore rupee paints business. For JSW Paints, Parth Jindal, the closing of this deal has been a while coming too. At Davos earlier this year, he told CNBC-TV18 that he would give anything to make this deal happen. Now CNBC-TV18 has reached out to both the companies and is awaiting an official confirmation on this story. So we will update you as and when there are fresh developments. Back to you.
All right, Rachna, many thanks for joining us. Yes, Parth Jindal did say that in an interview to me in Davos, and it looks like the deal is in the final lap. Sona Comstar MD Vivek Vikram Singh has said that the late Sanjay Kapoor wanted the company to be prepared for the next 25 years. Speaking to CNBC-TV18, Singh said Kapoor and him had devised a vision for the next 10 years, which included more focus on Eastern markets, autonomous vehicles and humanoid tech. He also promised to continue on the growth path after the 53-year-old Kapoor passed away 2 weeks ago.
Our new plan for the next 10 years, and it will be in our annual report, is this, that we actually ignored the East completely while we were looking West, which means we ignored actually India, we ignored China, Japan, Korea. So now the new strategy will be look West and East. We have to add many more new product verticals because the biggest delta actually came not from EV or West, it actually came from adding new products. So whether it be eVTOLs, humanoids, AV, autonomous vehicle, software, the increasing software content. So that in a nutshell is what we wrote down for our next 10 years.
Well, the company is poised for growth and plans are in place to take it forward. That's the management of Sona Comstar there after the unfortunate demise of Sanjay Kapoor. The Aviation Ministry says extraction of data from the black box of the crashed Air India Boeing aircraft is underway. The analysis of the data from the cockpit voice recorder and flight data recorder is currently ongoing as part of the accident investigation. This is being done in Delhi. The Ministry of Civil Aviation says these efforts aim to reconstruct the sequence of events that led to the incident. 275 people died in the plane crash on the 12th of June. Well, with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC-TV18. Stay tuned. We're back in a moment with more.
रिटर्न ऑन कैपिटल कि अगर आप 100 रुपए धंधे में लगाते हो एंड इफ यू कांट जनरेट 15-16 रुपीज आउट ऑफ बिजनेस, तो उस बिजनेस का मतलब क्या है? फिर तो आप जाके अगर 7-8% ही करना है तो आप एफडी में पैसा रख दो. वन ऑफ द कंपनीज which is now known in the market is a company called Solar Industries. Today, the market cap is 1,50,000 crore. When we identify, it was a 1,000 crore market cap. Narratives will work for a while.
Right.
But finally, top line is vanity, bottom line is sanity, and cash in bank is reality. It's the promoter. He's the friend, he's the enemy.
Make or break.
Make or break. वही बनाता है, वही बिगाड़ता है.
Okay.
There are pockets of bubbles. I am completely acknowledging that. But it should not be painted with the same brush that everything is expensive.
I remember meeting Rhythm Desai at the Morgan Stanley conference, and he actually went on to say that Indian stocks are cheap.
Yeah, I mean, you have to search your pockets.
Yeah,
and I think
yeah.
ये मेहनत करने का time है. For you have to go at the ground level, search for companies, search for good promoters.
Hello and welcome to Market Cafe. We are in conversation with Pankaj Tibrewal, someone who is known as one of the most celebrated mid-cap and small-cap pickers, fund managers of the country. Over 14 years of experience just with Kotak Mutual Fund, and if you put it all together, we're talking well over 2 decades of experience. And in the earlier part of this conversation, you heard us discuss, of course, the current market order, how this is a changing market. But now it's time to get a little deeper into the mid-cap stock selection process. So Pankaj, we've had a good conversation so far, but I have more questions for you. Now let me turn this around. How to use these filters carefully to avoid getting into a stock that could tomorrow become a penny stock?
Yes.
So again, give us some examples where you realize that the story is going off track and it's time, now there's a red flag, it's time to check out. And which were those filters, or what told you that, okay, now my antennas are up?
So I think cash flow conversion is a very, very important part. So I said 70% cash flow conversion should happen. It's a basic thumb rule. I think wherever we see lower cash conversion is a important red flag over a period of time. So EPS growth is improving, but top line is improving, but cash flow is not. Operating cash flow, then there's a problem. Okay. The second important part to note, Surbhi, is that in one of the forensic which we have, it's very important to note profit minus dividend should add to your shareholders fund, net worth, जो भी आप बात कर लो, book value, shareholders. In many companies which are listed, we see that EPS growth is happening, but book value growth is zero. Why? Because the write-offs they need to take from P&L, they are taking from balance sheet. Okay. Third, auditor's remuneration. So we see that in many places, auditor remuneration growth is much higher than the revenue growth. Why is that happening? So, if you go by a proper forensic, I think it's a very, very important piece that you will avoid big mistakes.
Sure.
And one important thing we have learned from a theory of inversion over a period is that people look at multi-baggers. We went into the history of last 20, 25, 30 years and said, what are the reasons which led to companies becoming penny stocks of value destruction? So leverage was one, cash flows being weak, siphoning of cash, taking it to offshore entities was another, capex untimeliness was another, capital cycle wrong was another. One interesting thing which applies to Indian markets which we saw, that most of the companies which destroyed wealth never had lady family member as a part of the board.
Companies that destroyed wealth never had lady family members on the board. How interesting is that? And what's the correlation?
It just came out as a point that in India, we all are very protective about the lady of the house. Mother, wife, daughter, sister, whoever it is. And if promoter is doing any hanky-panky, he himself knows first. So he is of the Indian psychology is like, if any trouble comes, I can bear that trouble, but none of my other family members should have that problem. So the moment he sees some problem coming in, he separates at least the lady family member of his. So there could be genuine reasons also, like in a chemical factory. Fires are a common nature. Board of directors are liable for it. So you understand that. But whenever we see a lady family member being part of the board, we get excited that it's a hygiene check.
Oh, okay.
So it's
interesting.
So it's a small, kind of an anecdote we have discovered. When
Women add to the trust factor.
It adds to a lot of trust factor.
That's good to
especially men in India, they don't want trouble to happen to the lady family member out there. So these are small hygiene checks which we do, and we have created a template that galtiyan kam ho. I think if you can avoid big mistakes in this market, I think market will be rewarding to you. But if you make big mistakes, then markets will not be charitable. Market is investors are okay, आप 2-3% return कम दोगे, कोई नहीं बोलने वाला. But the moment you are associated with something which destroys wealth, I think market is unforgiving on that side. So we have to avoid big mistakes. I think that is one my key learning. Ki have a process, and that process will only help you navigate cycles across the board. Otherwise you will fall into that trap and make big mistakes.
Of going for something that's sparkling.
गलतियां होंगी, छोटी गलतियां हो तब तक ठीक है, लेकिन बड़ी गलतियां जहां पर कैपिटल लॉस होना वो नहीं होनी चाहिए.
That really hurts then. Okay, so tell us through your investing career, which have been the 1 or 2 or 3 stock calls that are the closest to your heart for whatever reason. I mean, I'm not saying only because they might have been the biggest wealth creators. It could be something else, could be a new industry, but the 3 calls that were closest to your heart in 2 decades.
So one is
solar, obviously,
for example, and that one of the things. The second one was Dixon.
Okay.
And I still remember in Dixon when the IPO came, there was a lot of apprehension that it's a electronic assembler, wafer thin margins.
Correct.
But what people missed out, that their balance sheet was super strong. And they had a negative working capital they were operating in, which is very important in this business, that they are not risking balance sheet because wafer thin margin. And they built on size and scale. From IPO, they have not raised any capital. And see the size they have created and became India's largest electronic EMS player. And we were betting on very early. The promoter and the person who is managing, Mr. Atul Lal, fantastic people. So again, the bet on those guys that they understand business and they want to move ahead into the value chain. And that is the time when India came up with the indigenous electronic manufacturing, PLI and all those things. And look at the size and scale today.
And they're still reinventing themselves from laptops, then now they're talking semiconductors,
everything.
all of
so
that.
So once you get a scale and size, I think what I have realized that size gets created automatically. So I think that's another company which is close to my heart. The another one is a company on chemical side called SRF and Alkyl. So these two, and they could be part of my portfolio. I'm just giving a disclaimer right now. But the point I'm trying to say is that these companies have shown size and scales over a period of time. And look at the way SRF moved into chemicals, specialty, fluoro, and the way from there the size got created. And the another great entrepreneur whom I admire is Mr. Velayan. Look at the way he has turned around things across the Murugappa Group companies. So I think India is full of opportunities, entrepreneurs. And whenever you go down, I feel so excited and kicked. Ki boss, kitne entrepreneurs hai India mein?
You just have to bet on the
right ones who can scale size and scale. So whenever people say कि opportunity नहीं है, I somehow feel कि मैं कोई गलत कर रहा हूँ क्या? But over a period of time, I think you have to pick the right businesses, right promoters, and I think most of the job is done. So all these examples are just examples, nothing to buy and sell.
No,
I am against
absolutely,
it,
this
but
is
just
your journey.
And बहुत सारे ऐसे सारे companies आए और गलतियाँ भी हुई हैं. ऐसा नहीं है कि गलतियाँ नहीं हुई हैं, but कोई भी गलतियाँ ने capital zero नहीं किया. So we were early on to identify those mistakes and move out. Either there was red flags on governance, either the red flags on cash flow or balance sheet, and then we were, early enough to act on that. So we may have done a 10-20%, 15-20%, 25% loss. We moved out, but then we were kind enough to accept that.
Give us one example of such a mistake, because it's important to learn from and mistake is not a mistake if you realize it quickly enough and take the corrective steps.
So I'll give you a small example. We were invested in one EPC company. into road infrastructure.
Okay.
The company was doing well, everything was okay. But quarter after quarter, the operating cash flow was negative.
Okay.
Company was giving all kind of explanation, but something was fishy. So what we did, we sent one of our analysts to the sites. Across 5-6 sites he went into where the project work was going on. And during conversation, it came across that the salaries got delayed for more than a month.
Oh.
That was a red alarm. Ki cash flows are so tight that the company is not able to pay salaries.
Salaries on time.
And salaries is the key important basic ingredient you have to pay. So that analyst came and said there is some delay in salary. I said no question asked. And we were fortunate enough to get an exit because somebody else was buying a block because EPS growth was looking very strong for the next 2 years.
So you decided to exit even though there was some growth visibility.
2 years the company kept on growing.
Okay.
But cash flows never came. Debt came in, started to increase.
Okay.
And today, I still remember it was, price was 240 or 250 rupees. Today it's a penny stock with, I don't know, 3, 4, 5 rupees. I haven't seen the price also. But I think taking that call early on where cash flows gave you that indication that something is not going right. And I think that was the key from a balance sheet and cash flow perspective. So on the hindsight, you look like saved. But
That's
I think
amazing,
those basic filters always help you. That's why I think process is underrated.
So
process,
promoter, cash flow,
balance sheet, cash flows, and then growth is also important, obviously.
Of course.
Otherwise, it's a value stock. So growth and cash flows go hand in hand over a period of longer periods of time. And I think companies which have created value and wealth, they have managed with growth along with cash flow and balance sheet.
Now that we've got the whole framework and the whole classroom and we've taken our notes down, let's apply it to the real world, the here and now. So tell us what excites you in the mid and small cap world today. I know in the past in our conversations you mentioned, I mean, chemicals is a sector, some parts of pharma, you've mentioned, I think, auto ancillaries as well. But just expand on that, what is exciting you in this mid universe?
So I think it's as you said, bottom-up market. There are various opportunities which I see, which is changing in the overall landscape, which is changing. And many companies whom we are meeting today, I think it's real that the kind of inquiries over the last 2 months have gone disproportionately higher. So I'll give you a small example. We met one consumer unlisted company. It's a household brand. For 3 years, they were trying in the US markets. Product was approved, but they were not competitive enough with China. Chinese were, at a very, very low price. Suddenly, post this tariff thing, all the 3 large buyers in US came to them and said that we want to book your capacity for next 3 years, right? He said, we are surprised, but we want to do work at our conditions. We said that we'll work with advance. The guy came in and gave advance, one of the guys. So I'm just saying that the landscape is changing and there will be many opportunities across auto ancillaries, for example. Many companies are pivoting themselves from pure auto to non-auto, which is defense, aerospace, semiconductors, because their precision engineering skills are very high. And world needs those kind of companies from a non-auto perspective. So many companies' texture will change. Chemicals is important where CDMO, the entire contract manufacturing, production of various chemicals which are sourced from China, that will become a very large scheme to go with. Then you have the pharma CDMO players. I think incrementally big pharma and other big agro guys are coming to these companies and saying that, can you do a 3-year, 5-year, 10-year contract with us? So incrementally, I see there is a large opportunity. Electronics, another one. We haven't even scratched the surface right now.
But that's where you said valuations could
Valuations are expensive, but backward integration, the companies who can do that, expand the scope, I think they will be the winners over a period of time. Then you have the financials. It's a slow growth year this year, but I think over the next 2-3 years, what RBI has done is created abundant ecosystem for them to grow now. So
and what in financials? Because it's a very large universe, lenders, NBFCs, non-lenders.
Initially, I will be focusing on NBFCs this year and private sector lenders for the next year, because growth will be front-ended for NBFCs this year. And then you have various other bottom-up ideas which are there in the market today. So I believe that yes, there are pockets of overvaluation, one has to avoid it, but alongside, I think there are many opportunities. Consumer discretionary. I think if my belief is this could be the best Diwali we have seen in many years.
For consumer discretionary.
For this discretionary for this, because see,
so jewelers,
retailing, fast fashion, footwear, consumer durables, because you have cut interest rates, you have provided money through tax rate cuts in the hands of consumer. So second half of this fiscal, I think you
There's
could
some cash to spend now.
Finally. And look at last cycles, the consumer transmission used to take time when the interest rate cut used to happen. Now more than 45% of your loans outstanding on the consumer side is linked to external benchmark,
so
which
that's
is
instant.
So वो सारा immediately हो जाता है. So you will have that money in the hands over a period of time. So I think over next 1 or 2 years, I think consumption revival is looking for real. May not be through staples, because staples is a saturated category in many places, but I think through many discretionary categories, I think that sector on a bottom-up basis is also looking quite okay. But I think you need to pick your, from a bottom-up basis.
That's where you start applying the filters. Pick the right companies, the right management.
So top-down, आपको पता है, and then try and apply those filters. And capital goods in some areas where in T&D space, for example, transmission and distribution, I think there's a huge amount of spend happening globally and locally. That's an inflection point which I see. So there are many opportunities based on valuation, based on other filters. You have to just go and pick the right winners.
Wow, that's great. So now I'm going to ask you the final question, which I said I'll come back to, and that is this whole valuation beast. Many a times in our market, when you find a company that's giving you growth, management seems clean, and balance sheet looks okay, it comes at a cost. that PE will be 70 times, and you might say, "Ki, ये तो बहुत expensive है, I won't buy." Then it will be 80 times, and it will go to 90 times, and you just wonder. So I'm sure investors, even retail investors, feel this conundrum.
Yes.
ये महंगा है कि नहीं महंगा है? ये महंगा है तो, you know, like how we Indians sometimes we say कि quality चाहिए तो पैसा खर्च करना पड़ता है. You know that when we go shopping, that's sometimes you think of that. So how should we think about valuation and what price is okay to pay for a good company?
See, it's a big conundrum right now because companies which are growing are at crazy multiples. Companies which are good but not growing, nobody cares for them right now.
Yeah.
And over a period of time, what we have understood is growth is the horse, valuation is the cart. So till the growth drives, valuation follows. And we have seen in many companies, they grew at 25-30%, valuation became crazy. And the moment growth slows down, de-rating happens.
Correct.
So I think in Indian markets, people buy and come to Indian markets to invest is because of growth. Right?
Yeah.
And we saw last year, when the growth slowdown happened,
Yeah.
Foreigners sold off crazily.
Yeah.
And you saw a market correction.
Yeah.
So my sense is growth should not be ignored. And that's one thing. And rather than looking at pure PE, which normally every investors look at, I think what to look at is PEG, PEG. That if a company is growing at 25-30%, I'm okay paying a 40-45 time multiple, which means a PEG of 1.6, 1.7, right? The problem arises when you pay PEG of more than 3 times.
That's when it's...
That's where over a 3 or 4 year period, you don't make money.
Yeah.
So the sweet spot is between 1 to 2 PEG. And I think rather than looking at pure P in its absolute terms, start tracking PEG, which will, for per unit of growth, what is the price I am going to pay and how sustainable that growth rate is over a longer periods of time. And that's a subjective assessment one needs to do. And I have made huge mistakes, Surabhi, over the past, where I thought absolute term में बहुत महंगा हो गया, बेच दो. And the company kept on growing and became 10x and 15x from there also. So error of commission is one thing which we spoke about. But error of omission in the life of a fund manager is also a very, very important thing. Because somebody else as a competition is owning it, they have ridden the entire thing, you underperform. Either the indices or the relative pace. So I think omission and commission have to be taken separately. And one learning has been till the company is in a growth pace and you are on it, don't sell it till you get a sign of growth slowdown.
Okay, so go for growth, but then be cautious, apply the right filters, look at management quality, look at cash flows, and then
And just
make a
one more
decision.
thing, you know, everybody is looking to time the market. When markets came to 22,000, people said, "Ab to 20,000 aane do, Nifty, then we'll buy." But one thing which people are missing, Surabhi, is that 6 months back, our 10-year bond yield was 7.25. Today it's 6.25. So a 13% re-rating in PE has just happened in the last 6 months because of the bond yield coming down, right? And if you were waiting at 20,000 Nifty, automatically that number is now 22.5, 23,000 on the base case. So markets in our view will be in a range bound for some time. Pick up your right companies which will show you earnings growth. Don't overpay for valuation on that side. Otherwise, if growth slows down, you will be caught in a bad thing. So it's not an easy market. It will be a tough market for next 12 to 18 months with geopolitics, interest rates in US being high. So all kinds of headwinds globally are there. And you have to pick up the right winners who can adjust to these headwinds and navigate their way to growth.
Okay. What a fabulous, fabulous conversation, Pankaj. This truly feels like a masterclass. When I started the conversation, I thought it's going to be light and easy, but I'm so glad we did this because I think in a complicated environment, volatile markets, and shifting patterns of investing, I think it's really important to know what the brass tacks are. Especially if investors, I mean, if you're going to put it through a small cap fund or a mid cap fund, that's fine. Leave it to experts like Pankaj. But if you're doing it yourself, then I think what you've given us are some fantastic golden thumb rules, and I think that'll help investors and go a long, long way.
Thank you.
Thank you so much.
Thank you.
Really appreciate you joining us
Thank
today
you.
and spending the time.
Thank
This was a great conversation.
Thank you. Thank you.
All right, viewers. Well, with that, it's a wrap on this edition of Market Cafe. Thank you so much. We'll see you again soon with another conversation.
Hello and welcome. You're watching News Center and I'm Parikshit Luthra. In a boost for Make in India, defense tech startup Rafi M Fiber has raised $100 million to expand aircraft design and manufacturing. The funding round was led by General Catalyst. This is the largest equity raise in Indian aerospace manufacturing to date. The Noida-based company has raised a total of $145 million so far. The startup was conceptualized in 2016 and has delivered the world's first operational drone swarm. It has also developed India's first indigenous state-of-the-art military-grade autopilot. To discuss what this fundraise means for Rafi, as well as India's self-reliance in defense sector, is the company's CEO and co-founder Vivek Mishra. Also joining us is Neeraj Arora, Managing Director at General Catalyst. Gentlemen, thank you very much for joining us. Let me go across to you, Vivek, first. Could you tell us how this $100 million of funding is now going to be used by Rafi to expand its operations? You were already into drones, UAVs and aircraft technologies, but how will you now prepare for the future?
So from the early days as well, the vision of ours has been to develop the indigenous research and manufacturing capabilities, to develop the systems which are required by India, by the Indian forces, considering that the requirements is quite different from across the world. So if you go towards the western side, you would see deserts. If you go towards the northern side, you would acknowledge there are high altitudes with extremely low temperatures. And in east side, you have high altitude with extreme rainy environments. So from day one, the vision has been to go to the grassroots level, develop the technology, develop the research capabilities and manufacturing capabilities to aid the research. This round of funding will it's the same thing that we have been doing over the last decade. We would strengthen our research capabilities, both in terms of the infrastructure and the manpower, and similarly strengthening our manufacturing capability to produce advanced aircraft that is required for the country.
All right. Neeraj, how does investing in companies like Rafi fit in with your global plans? We're also seeing this as a moment of inflection for India's indigenous manufacturing in the defense sector. We're also trying to build capabilities in combat drone manufacturing, UAVs, satellite imagery, and much more, getting ready for future warfare. So does that make you excited about companies like Rafi?
Parikshit, first of all, thank you for having me on the show. At General Catalyst, I think we deeply believe in global resilience as a core thesis for us, and we are extending this to India now, right? With this investment, we believe that modernizing the key critical sectors like defense is really important. And with the geopolitics changing, as you know, it makes it really imperative that India gets more resilient with this defense sector and aerospace sector. And this investment goes to the heart of our thesis in global resilience, with Rafi being the key player driving the defense sector in India, working very closely with the armed forces of India.
Right. Neeraj, if I were to ask you, when you were considering an investment in Rafi, what were some of the things that you were keeping in mind for future, how this fits into General Catalyst's global plans, long-term vision?
I think for us, investing in India is very, very much about what India needs, right? So I think since we've been talking about India's, Atmanirbhar movement as well as Make in India movement, I think this goes towards further strengthening that movement, right? So I think for us, investing in India is about looking at all the sectors in India that are not only about have a lot of growth potential, but also very key to make India more resilient, right? And defense, as you know, is really important to make sure that India continues to become a global player, not only for what we need in India, but also in the export markets over the years.
Right. Vivek, if I were to come to you right now, we've been speaking to officials in the government. One of the focus areas is to have combat drone technology in India. Now, we believe you are one of the suppliers of drone technology to the Indian Armed Forces. What is the company's state of readiness when it comes to combat drone technology?
We have been working towards a large area of applications, and we do not focus on a specific application, but we focus towards building the systems that are required by the armed forces and the other security agencies of the country. So in the process, we have developed the science, we have developed the subsystems which are required to manufacture, design and manufacture aircrafts, be it unmanned aircrafts, and the systems which would greatly benefit not only for the current scenarios, but also in the coming future. We are constantly hardening the systems. We are constantly improving the intelligence, improving the autonomy, and improving the human-machine interaction part of the systems that we develop.
Right. Vivek, if I were to also ask you, from reports that we read, that you have already supplied technologies to the armed forces, what is the kind of supplies that you have already made? And are you expecting more orders in the months to come?
So there are few different areas where we have supplied the UAVs over last 7 to 8 years. Primary would be in the logistics, ISR capabilities, and in the coming months, we are expecting to supply more towards the current needs and the future needs of the country. Our vision has always been to work towards the need of the customers that we are working for. And this is where we are heading towards.
Right. Neeraj, if I were to ask you, what would make India a more attractive investment destination? One, we're of course looking at a lot of trade deals. 3 of them are under negotiation. But if there were certain reforms that would help investors like yours move in faster or make more investments or make India the choice of investment destination, what would that be?
I think we have already seen a lot of innovation going in key critical sectors like defense, aerospace, manufacturing. So I think continue to reform these sectors, allow more private funding to come in, sort of like build a framework for a private partnership, which is already happening in defense and aerospace, and continue to further work with the government to enable investors like us to participate and really help bring some of the key capabilities from the rest of the world where we've been investing for a very long time into India is really key. In this example, for Refi, we have been investors, long-term investors in Anduril in the US and Helsing in Europe, and they are building the new modern defense primes in the US and Europe. And we hope that with this investment in India with Refi, we are able to help build the modern defense and aerospace prime for India as well. So I think continue to work with the government. We already have set up a GC Institute that works very, very closely with the ecosystem, with the government, with the policymakers to really understand what the technology is doing in key critical sectors and how it is changing the landscape. Will further help in bringing more investment in India.
Right. Now, Vivek, as far as Refi is concerned, you are a complete aircraft and aviation solutions provider. Drones, UAVs, that's one part of it. If I were to ask you about your portfolio of products or offerings that you're working for the next 5 to 10 years, what would those be?
See, the idea here is to work with the user, to work with the forces in the country, to come up with the solutions that would help them in day-to-day activities and also in terms of emergencies. So all our products are tuned towards that. And how we are able to do this is by working on the subsystem level and on the grassroots level related to research and quick turnaround times. So the idea again is to work very closely with the users and be ready for now and next 5 or 10 years.
All right. Neeraj, very quickly, if we were to ask you about some other areas apart from aviation and UAVs and defense, which you would be most interested in, where we could see investment action from General Catalyst in the months to come?
As I said, I think there's a huge focus on identifying sectors which provide resilience to India, right? So defense and aerospace is one of them, manufacturing, industrials, and healthcare. I think we have made a big investment last month. So I think if you look at all of these areas, one, they are really important to build resilience in India. That's important, right? But what is also happening is technology and AI especially is really changing how these industries are evolving, right? So we also want to look at how we can build indigenous AI for India in the future. So I think if you look at the broader landscape, we look at all the key industries that are important for India, as well as how AI is going to change those industries. So our investments will go into making sure that India is resilient in all of these sectors.
All right, Neeraj Arora and Vivek Vikram Singh, thank you very much for joining us and telling us about the investment, $100 million investment in RAFI, what this means for RAFI's efforts to do better and build better technology in UAVs and the aircraft manufacturing sector. We're taking a break here on News Center, but up next we speak to Sona Comstar MD Vivek Vikram Singh about the road ahead for the company after Chairman Sanjay Kapoor passed away tragically 2 weeks ago.
What is your leadership language?
Maybe this sounds controversial, but the classic hierarchical organization is no longer going to be relevant.
How you came back to India in 2015, the height of the Maggie crisis.
My father later on told me, when I called him up, I said, Dad, should I take up this? So he said, son, nobody puts an idiot into a crisis. Most corporations, Shireen, and you know it better than I do because you see many more people, they seldom fail because of lousy strategies. They fail because of lousy leadership.
What is one of the most underrated management principles?
I think the word happy has vanished from our dictionary.
What have been the biggest lessons from a marketing point of view that you would like to leave?
Kodak did not fail because it was a lousy brand. We did a small experiment to have Maggie counters in weddings. A Maggie stall attracted far more attention than the other traditional food fare.
In a wedding?
In a wedding.
How difficult and how different is the Gen Z customer?
They don't come in with a reverence for any brand.
Why do you say so?
The Indian industry is still in shock following the death of Sona Comstar chairman Sanjay Kapoor at the age of 53. Kapoor died due to a heart attack while playing polo at the Guards Polo Ground in the UK on the 13th of June. He had been chairman since 2019 and was responsible for expanding the company's footprint across India, US, Mexico, China and Serbia. The company, which is a leading manufacturer of electric vehicle components and gets 36% of its revenues from electric vehicles, recently made a foray into making sensors and software through acquisition of Novelic. Just weeks before his death, Sona Comstar had also acquired the railway business from Escorts Kubota. Former Blackstone executive Mark Overley, who was earlier on the board of Sona Comstar, has now been appointed as chairman, and Priya Sachdev Kapoor has been appointed as an additional non-executive director of the company. What next now for Sona Comstar? The legacy that Sanjay Kapoor leaves behind and the company's path to future growth. To discuss all of this, we're now joined by Vivek Vikram Singh, Managing Director of Sona Comstar. Vivek, thank you very much for joining us during this very, very tragic period. It's still not sinking in, even with us. You've said it in multiple occasions over the last few weeks that he was your best friend. And I know it is a very difficult time for you, Vivek. Could you give us a sense of what perhaps was his last conversation with you when it came to taking the company forward?
Yeah, I mean, that's still in works. Last conversation was around something we were trying to do inorganically, and he was very pro, because he's always very pro. He was always very pro technology. So that was our last conversation. I used him as a sounding board and to see where the board would lean if I would propose it. So we had done some work. So that was the last conversation. But the last real conversation was actually about, I was on holiday in Japan, and he was telling me which all restaurants I should go to, he knew what my kids like to eat. So he was saying, you should take them here, you should do this. Frankly, that was the last conversation. Again, I think we had far more personal conversations than we ever did work conversations. It was that kind of relationship. Work-wise, like I said, his view was always plan for the next 25 years, plan for the next 25 years. He wasn't very into the short term of it. I mean, if you realize he's been a shareholder for so long, for him, the longer term interest mattered far more than what typically your capital market investors ask, right? Capital market investors and you guys in the business press ask us questions mostly pertaining to 3 months to a year. His questions were more about 10 to 25. So that was the difference. Hopefully our new chairman, Jeff, who I've worked with for a long time, he too has that same mindset. So hopefully we can have a good working relationship.
You were a diversified company. You got into the railways business very recently, perhaps just about a few weeks before his death. 36 or 37% of your revenues come from electric vehicle components only. How did he want to diversify, enter new markets? Did he have a 10-year vision that he shared with you?
We used to make these 10-year plans of what is the next 10 year. So if you look at our journey in the last 10 years I've been in this company, 6 years I've run it, 4 years when Sanjay was MD, I was his CFO, then COO, head of strategy, did many roles at that time. 10 years we grew by looking west, adding new product verticals and getting into electric vehicles. These were the three things we did, and this is responsible for 90% of the growth delta. We've grown 10 times, 350 crore to over 3,500. The same strategy cannot work for the next decade because the world's shifting. Geopolitics is shifting, trends are shifting. So our new plan for the next 10 years, and it will be in our annual report, is this, that we actually ignored the East completely while we were looking west, which means we ignored actually India. We ignored China, Japan, Korea. So now the new strategy will be look west and east, we have to add many more new product verticals, because the biggest delta actually came not from EV or West, it actually came from adding new products. We were a single product company 10 years ago, now we have dozens. We have to multiply that manyfold again in the next 10 years. And third, apart from EV, we have to get into the other trends that are coming in the wider mobility area. So whether it be eVTOLs, humanoids, AV, autonomous vehicle, software, the increasing software content. So that in a nutshell is what we wrote down for our next 10 years. And it's just sad that he won't be able to read it, but it will be in our annual report this year.
Right. Thank you for sharing that. I would also like to ask you about who now takes over from Sanjay Kapoor. All the day-to-day management of the company is being handled by you, Vivek, and immediately after his demise, that is what the board had also said, that you will continue leading the company and handling all the day-to-day management. But as the role of chairman, Mark Overley now takes over. Compared to the kind of role Sanjay played, and Sanjay was very active in terms of industry bodies, representing Sona Comstar before the government, before the industry. What role will Mark Overley play now?
Jeff's role as a chairman of the board. So the chairman of the board has responsibilities, as you well know. But when it's a non-executive role in a 9-member board, it is limited to guiding the board towards better decisions. The biggest job is to basically ensure management team continuity, whether we are doing succession planning, risk management, have oversight. That oversight role, I think Jeff is more than qualified to do. He's been on a board long enough to know all the ins and outs. That bit, I am not even concerned an iota. Running of the day-to-day, I'm not concerned an iota. Yes, I will have to take on some of his industry representation and government things that I may not be able to be as good as him, because I'm not that personality. I'm not that extroverted. I'm not that outgoing. But there is no alternative.
Speaking about the role of Priya Sachdev Kapoor, she has been appointed as an additional director in the company. Could you tell us what will be her role in terms of day-to-day operations, in terms of contribution to the board and the company?
So, as you know, she's been appointed as a non-executive additional director. So, non-executive director, like all the other 7 now, we have 7 other directors apart from the 2 executive directors. It's similar. They are there to provide oversight. They are there to look at whether the company is on its right path. See, management has a lot of control on how things are done. But we too need our conviction tested by a board. We serve at the pleasure of the board. The board is supposed to represent the will of all the shareholders.
My final questions would be about the roadmap and some of the crisis points that the government, the industry is facing right now. One, on the issue of the rare earth crisis. How badly is that impacting you right now?
So look, the rare earth crisis is real. It's present. It's been there since 8th April. 8th April is when the export controls came into effect. And till China actually releases this crisis, I don't know what the resolution is in the short term. In the medium term, government is planning certain measures. We are trying our best to support and advise the government in their initiative to do that. There is about 7 to 8% of our revenue that comes from traction motors. A portion of that will be impacted directly. Now, what will be the indirect impact, Parikshit, is the hardest to understand, because let's say we supply a part which has no rare earth magnets to a company in India, to a passenger vehicle car maker in India. And that company needs a magnet for some other part because of which there is a production loss. That could be an indirect impact, but there is no way for us to estimate that impact as of today. As we roll forward, we see it. But Parikshit, again, in our industry, you've covered us long enough as an industry to know that every 6 months there is a new crisis.
Right. So no production cuts? Are you looking at production cuts as a result of this crisis?
For a traction motor business, of course, there are production cuts. But for other things, the indirect bit, like I said, we have zero estimates right now.
All right. Thank you so much for joining us, Vivek. Appreciate the fact that you took time out to explain the strategy of the company going forward, how the management structure has changed, what the role of every individual is going to be. This was a very helpful conversation. Many thanks for being with us.
Thank you, Parikshit.
Management guru Peter Drucker said the greatest danger in times of turbulence is not the turbulence itself, but to act with yesterday's logic. My guest today is someone who's been around for over 4 decades across corporate India in different roles. For the last 3 decades, he's been at Nestle, and for the last 10, he's been the chairman and managing director of Nestle India, shaping its transformational story. Joining us now to talk about the fires, the storms, the lessons and learnings of longevity and leadership is Suresh Narayanan, the chairman and managing director of Nestle India. What is your leadership language?
Maybe this sounds controversial, but the classic hierarchical organization is no longer going to be relevant.
How you came back to India in 2015, the height of the Maggie crisis.
My father later on told me, when I called him up, I said, "Dad, should I take up this?" So he said, "Son, nobody puts an idiot into a crisis." Most corporations, Shireen, and you know it better than I do because you see many more people, they seldom fail because of lousy strategies. They fail because of lousy leadership.
What is one of the most underrated management principles?
I think the word happy has vanished from our dictionary.
What have been the biggest lessons from a marketing point of view that you would like to leave?
Kodak did not fail because it was a lousy brand. We did a small experiment to have Maggie counters in weddings. A Maggie stall attracted far more attention than the other traditional food fare.
In a wedding?
In a wedding.
How difficult and how different is the Gen Z customer?
They don't come in with a reverence for any brand.
Why do you say so? Do you typically do the lunch round or you don't do the lunch round?
I don't do the lunch round because the lunch round gets a little embarrassing, no?
But what made you want to do these rounds of the office, which you do twice a day? It's almost like a doctor visiting his patients.
Yeah. No, it's I think it's just the desire to connect with the people, because there's no other way. No, I can't keep calling them and disturbing them.
Huh. But
So
it's
the-
a very young organization. What's the average age? 28?
29.
So how much of intel do you pick up on these walks?
A reasonable bit.
What kind?
Good lunch.
What kind of intel have you picked up?
Intel is again on brands, on sometimes even holidays and
Office
people.
romances.
Oh, that also comes.
Have you predicted any weddings in this office?
This office, one or two.
One or two.
I saw it coming,
I want to start with how you came back to India in 2015. The height of the Maggi crisis, it was a make or break moment for Nestle India. When that call came to you, what was it that went through your mind?
Thank you, Shireen. Thank you for inviting me. And yes, ironically, that the night the call came to me, it was late evening. I was actually at dinner at a friend's place. My wife and I were at dinner. And there were 2 missed calls that I had received. So I requested my friend, I said, can I use your study to return the call? So I called back, and my then boss, Wanling Martello, who was the head of Asia, Oceania and Africa, she said, Suresh, I have a bit of news for you. So I said, what news is it? She said, the board would like to send you back to India. So I sort of taken aback. I said, why India? She said, look, we have a spot of trouble there, and the board feels that, and the CEO feels that you'd be the best person to handle it. And my first reaction was a bit confused. I said, can I call you back? Some such slightly bizarre remark, but she said, this is the request of you. So I remember leaving the room, and my friend looking at me and saying, you're looking ashen-faced. Has something happened? I said, I can't tell you what's happened, but yeah, a big change is happening, and that's how it started. And then I got a call soon after from the CEO of the company then, Mr. Paul Bulke, telling me that, look, we would want you back in India, and we believe you are the right man to navigate us from this difficult circumstance. And as my father later on told me, when I called him up, I said, Dad, should I take up this role? He said, what are you thinking about? So I said, look, I mean, this can be a pretty tough move for me. So he said, son, nobody puts an idiot into a crisis. So your company must be thinking well of you. And he said, there is a call of duty. He said, what are you questioning? They've told you, that means that's an order, and you follow the order. And that's how I came. And he said, look, what will be the worst that will happen? If you fail, you can come to Chennai, and we can sit in the veranda and drink filter coffee and read the Hindu newspaper or the Hindu Business Line, because those are the 2 popular newspapers there. But if you succeed, maybe you have a story to tell. And here I am telling the story to you.
Here you are telling that story. But, I want to delve a little deeper into how you managed the crisis that the company was going through in that very critical phase during 2015. There was a lot of pressure. There was a lot of negative headlines. You and I spoke. That was the first conversation that you did. And I have to say that I walked in assuming that there would be a long list of things that I would be told that are off the table, that you cannot have that conversation, you cannot ask those questions. And I was pleasantly surprised that you said, ask me what you want. And I think that was the start of building or rebuilding trust, if I could call it that. I think Rumi said that that what hurts instructs. What has been the biggest takeaway? What has been the biggest lesson from the many storms and fires that you've had to deal with?
Look, I think, Shireen, one of the things I've always believed in my, as a personal principle, is that I have nothing to hide and the company has nothing to hide. We were in this crisis, but we were transparent in terms of what we were doing as an organization. And I wanted to tell the world that here is a company that is transparent, that will tell you what it does and what it does not. And I think, trust is built only when purpose and values meet transparency. And the reason why we managed to come out of that storm is because we were doing no wrong. We didn't know how to explain that well enough, and that's what we really started to do. As far as I'm concerned, I played a role actually less of being a business manager, because at that time the business had tanked. Maggie was roughly 30-40% of our business that had gone up in smoke. Every other part of the business also was shaking and creaking because Nestle name was involved. We had about 8,000-9,000 employees, all of whom were tenured employees. So people were worried about their jobs, they were worried about their families. So I was more an elder brother to some, almost like a father to some, right? Like a friend to some. And I think managing the internal dynamics and the internal morale was as big a challenge as managing the external world. But I said to myself, I'm able to say what I'm able to say because I have a firm backbone of this company where quality and safety are never ever compromised. You may not like my advertising, Shireen, it's possible. You may not like the color of my pack. But what you cannot challenge me on is the quality and safety of my products. I mean, it's a bit like challenging Sachin or Virat Kohli on their cricketing prowess. I mean, you can find other things in their lives that you may not like, but on the core prowess of the company, which is quality and safety. And I remember my interview with you, and I was really nervous because that was the first public interview I've given in my life. I've given one before in Egypt, but that was lip-synced into Arabic. So I really don't know what I said, right? But this is the first one. And I think, for me, truth, trust and transparency go together. And a leader who's able to convey that, I think is a leader who ultimately, he may get bashed up in the bargain, but still will come out morally on top.
In the context of the world that we live in today, where in many ways you could say that the world is going through a leadership crisis. It's going through volatility, but it's perhaps also going through a leadership crisis. What do you believe is the job of a leader today? What do you believe is the job of a CEO today?
I think today the role of the CEO has changed quite dramatically. The first task of a CEO is to be able to measure, sense and respond to an ever-changing environment. I think receptivity and adaptability are the single most important characteristics of leaders, not functional expertise. I'm not the greatest marketer. I'm not the greatest sales manager. I'm not the greatest finance person. But I need to be able to know behind the fogs of war what lies, behind the smoke screen of the future, what opportunities are there. So sensing the environment is a big part of what the leadership role is today. Secondly, and this is something that many companies believe is unfashionable, but I believe is center, is of building a culture of the organization. My job is to ensure that I orchestrate an environment where people are happy to come and work in, participate in, and give their best. Most corporations, Shireen, and you know it better than I do because you see many more people, they seldom fail because of lousy strategies. They fail because of lousy leadership. And where does that lousy leadership not meet past master? Is in ethics, is in governance, is in hubris, is in arrogance, is in self-centeredness, is in the incapacity to manage yourself. These are the things that affect leaders from doing what they should be doing, which is to create an environment and a culture where merit, where work, where practices are truly celebrated. And the third element is, I think, building future leaders. Today we are in an age where we are looking at AI replacing all our jobs. That seems to be the buzzword. I would respectfully submit that it's not AI substituting jobs. It is a question of building leaders for the future, because even if you have AI, you're still going to need leaders. How much of time and effort and energy are organizations and nations spending on building leaders? This is where the leadership challenge comes in. And also, yes, this thing that what gets measured gets done. I think there is more to a leadership job than just looking at what is getting measured is getting done. Culture is never measured. People and attitudes are never measured. Leadership quality, both at the intake and when they mature, is never measured. So you need to have a far more holistic platform of evaluating corporations. Today you look at organic growth and profit improvement and return on invested capital, earnings per share and market capitalization and how it has evolved. I think tomorrow you have to start looking at saying, what is the leadership depth of this company? What happens if 2 layers of this organization were to either leave the company or were to drop dead? What are you going to do about it? And I think these consequences of management, of leadership of the future needs to be brought to the table.
So how do you measure that then? Because, as you said, it's easier to measure ROCE, ROI, EBITDA, margins, and so on and so forth. How do you measure what you just spoke of, the ability to create leaders, the ability to adapt to change, the ability to be agile? I mean, a lot of this is actually not tangible stuff.
Yes.
How do you measure culture?
See, I think the best way is in 2 kind of situations. One is in a situation of constant volatility and in steady state. In steady state, it's more easy to measure because the results are well defined and the environment survey and the climate survey in the organization will always be reasonably positive. It's in difficult times. What is your leadership bench strength? How capable are they of anticipating risks and being able to mitigate them?
To a 22-year-old who's starting his or her career today, what would you tell them? There's so much information coming at you. It's a paradigm shift in the way that we live our lives. There's this emphasis on work-life balance, as you and I know it, is very different from the way that this generation sees it. To a 22-year-old who's starting in the workforce today, what would you tell them?
Look, I think it's a very exciting time, and yet it's a fearful time as well. Exciting because of the sheer number of opportunities that young people have. When I was 22, getting a job in Hindustan Lever was about the best thing that could happen to you. Either you become a civil servant or you join one of these big companies.
And eventually become a CEO.
Yeah, exactly. And my ambition then was, in Hindustan Lever, was to retire after 30 years and get a ditty box, which used to be the company's, it used to be a safari suitcase full of the products of the company. And then you used to get a check and then a garland and a little farewell party.
That was really your ambition.
That was, I said that'd be nice, after 30 years to get something like that, because I'd seen my dad do that in the government. They also gave him a farewell, so I said that's the ultimate thing. So today the young people have much more opportunities, but what I would urge them is to focus on 3 important elements of their lives. One is purpose. They need to have a purpose in their lives. What is it that they want to achieve in their lives? They need to stick to their values, and they need to learn to be happy. I think the word happy has vanished from our dictionary. Ambition, success, material comforts, right? IPOs, valuations, these are the things that seem to be buzzing. The word happiness has gone out of our dictionary. Work in a place where your values are coterminous with the values of the organization. Because being happy at work makes you a productive employee. It makes you get up in the morning. I still get up in the morning. I feel excited to come to work. I feel happy seeing the young people. I walk around the office. I chat with them. I discuss with them. I do my little meetings. Now I'm in my as they say, the twilight of my corporate career. But yet I have that sense of enthusiasm, and I think that enthusiasm is what makes the world go round.
You spoke about happiness, and you said that it's a word that is not very often used anymore. You've always maintained that you value happiness over success, and that's very different in the environment and in the world that we live in. That's a very different value system to have. Explain that to me. Valuing happiness over success, because people assume that success leads to happiness.
I thought I'll rather have a career where I come across modest success professionally, but that I'm happy being who I am with my family, because for me the family is extremely important. My wife and daughter are centerpiece of that. And I believe that a holistic life, and I saw my parents as well, having a holistic life, being happy with what they had and being content, not being complacent, but being content. And I think today in the world, we seek so much that we don't actually need. My wife and I had gone to Bhutan some years ago, and we were up in Paro. And there were some people ahead of us who were carrying their backpacks. And one of the youngsters, a European guy, telling his girlfriend probably, saying, all that we need in life is in this backpack.
But easier said than done, because when you've lived this life for 30, 40 years, when you become your job title, when you're identified as what you do and who you are at work, to walk away from that and rebuild, or to also parallelly keep building other aspects of your life so that you're much more than your job title, it's not an easy thing to do. How have you done it?
Look, I think, I've always had, I've never been entrapped in the trappings of my job. This company is not mine, right? I'm an employee of this company. I have achieved whatever success, happiness, recognition is because of this company. I owe a lot to this company, but I know that as a leader, I have to yield to new leadership with time. My good friend and former board member of Nestle India, Rupa Kurwa, wrote a very nice piece recently. She said, your identity should not be your job. I think she's absolutely right. I am Suresh. You come and talk to me because you value talking to Suresh, or you find it worth your while.
Let me ask you to declutter. What is one of the most overrated management principles? What is one of the most underrated management principles that you think we must focus more on?
Overrated is this adage of what gets measured gets done. I think there's more to it than that. What is the most underrated is empathy and humility. We see both empathy and humility as being inherent weaknesses. If I'm empathetic, if I'm compassionate, if I'm kind, if I'm emotional, I'm seen as a weak leader. I need to be muscular and in your face and punching you all the time and making a nuisance of myself. But that's perfectly fine. Humility. I mean, humility gives two things in life. One, it keeps you on the ground. You realize that what comes must go. As they say in Hindi, khali haat aaye ho, khali haat jaoge. That's the fact of life. All of us have to go through that. And the second thing, it makes you more accessible. You are able, people in the organization or wherever you work, come and actually talk to you because they see you as being an accessible person.
if I were to ask you what the most appropriate organizational structure of the future will be to create companies, to create organizations that are agile, adaptable, that can deal with the kind of volatility and chaos that we live with today, which is now the new normal almost. What do you believe is the most appropriate organizational
I think
structure?
one of the things is, and maybe this sounds controversial, but the classic hierarchical organization is no longer going to be relevant.
Is it dead? Will it be dead?
It will be dead.
Why do you say so?
I think because the challenges around us are multifarious, the volatility around us are non-texturized, and we don't even understand half of what is happening around us. So there will be small agile teams that will have to work and network around each other, with maybe one guy who's kind of the spiritual head, as it were, but not the guy who's actually doing the job. So in a crisis, there would be a digital arm to it, and there will be an operations arm to it, and there will be a channel arm to it, a brand arm to it, a people arm to it, different arms to it. All of them almost like planets going around the sun, right? Each doing what it is meant to do, but with no one person who's hierarchically to be reported to. I think the world is changing too fast for it to be made into a standard operating procedure. We were used to standard operating procedures because the world around us had not changed so dramatically. Today, when something happens in France, it hits you in India, it hits you in China, it hits you wherever. I think the degree to which a hierarchical organization is able to respond is much slower because it has to go through a pipeline. Somebody in the system has to say, yeah, this is happening, I recognize it, I acknowledge it, I need to act on it. And by the time you acted on it, crisis number 10 has followed. And you're still figuring out crisis number 1. My task is to ensure, like the orchestra conductor, I don't make a sound, and yet it produces beautiful music. That's the role of a leader. The leader who's all about himself, that everything has to come to me and I will decide and I will do it, I think is going to be a leader of the past.
We've gone through this period of capitalism, stakeholder capitalism, shareholder capitalism. What do you believe is the role and responsibility of a corporation today? Many believe that, look, as long as you're doing your business fairly, as long as you're paying your taxes fairly, that is, you're providing employment, that is the job and the role of a corporation. What do you believe is the role of a corporation?
No, I think the corporation is well beyond this. Well beyond the Milton Friedman model of keeping the shareholders happy. I agree that shareholders have to be kept happy. So you can't have third-rate corporate performance and first-rate CSR and say that, look, I'm doing a great job. But I think a corporation is more than this. A corporation has 3 roles. It has a role of business performance and delivering whatever it's expected to do. Number 2 is community performance. A corporation that does not touch the community is like a human being without a heart. You're here to serve society. And the third is to be the harbingers for good practices and for good initiatives in society. And I think that's something. So whether it is cleaning the environment or whether it is ethical governance or any of those things, some of the things now which sound like luxuries actually should be essentials. I mean, why should a company not be soundly governed? Why should its books of account not be clean? Why should people be not putting their hands in the till? Why do we allow that to happen? And I think this is where the confusion between performance and ethical performance. I perform, I give you high dividends, I give you a lot of shares, I give you a lot of returns. I can get away with murder. I don't have to do anything for society. It's fine. My shareholders are happy. I don't set standards on anything because who cares? That's not important. So I think these things are important. These things were important. There was a time when we used to feel remorse and shame when we read about any of these things in the papers.
We've talked a lot about what's been happening inside the company and how you've shaped the culture within the company. I want to focus on the customer. What has been the biggest lesson that the customer has taught you?
The customer has taught me the most important lesson: never to take him or her for granted. But at the same time, if your brand is strong and if your brand is loved, you will be given a second chance.
As was the case with Maggie.
As the case with Maggie. Maggie was the most, I was really surprised, Shireen, when the whole Maggie fiasco happened. The number of people who wrote in and who communicated with the company on the love for the brand, on the moments of happiness, of joy, of sheer pleasure with the brand that they had. At the same time, you can't take them for granted, because I think the competitive intensity is very high, and I think this is, I would say, in consumer product terms, this is probably the most exciting market in the world today. This is the most exciting market in the world, and nobody, no grace marks for legacy. You're competing with smaller, nimble, agile, more focused players. And I think that re-energizes the organization itself. The examples that I use in talking to my people, it's seldom the big names. It's some smaller names saying, look at those guys, look at the way they are doing things. Should we not be like them? Or should we be like the big elephant that walks into the room?
If you're saying there are no grace marks for legacy, as you look at the future today, how do you ensure that a legacy company like yours, with a checkered history, operates like a startup, has a startup mentality, has a startup mindset?
Yes, I think one thing is for our brands to be constantly on purpose, constantly on point as far as the proposition is concerned. If the sands are shifting, for you to realize that the sands are shifting and to make the change happen, and to have less of an arrogance of continuity, of saying because this worked 20 years ago or because it's worked in one part of the world, it will work in another part of the world. I think more often than not, organizations suffer from an inertia and also a certain arrogance of continuity, saying it's worked, it will continue to work. Today's Gen Z consumers are irreverent. They couldn't care less for your brand if it doesn't offer them the value and the proposition that they seek. Who loses out in the bargain? It's the company that loses out.
So how difficult and how different is the Gen Z customer? And what are you doing to cater to the Gen Z customer? What are you undoing about the way Nestle operates to cater to the new Gen Z customer?
The Gen Z consumer, as a customer, as I see it, is got three things which are different. One is they don't come in with a reverence for any brand. Even a Maggie is for them an old brand because it's 40 years old in this country, so that's twice their age anyway. So they won't be. So I think the irreverence to brands, the centrality of what a brand stands for is important to them. What it does for their own nutrition, what it does for their body, what it does for society. This is becoming extremely important. And the third thing is the variety and the differentiation that this offers over other offerings on the market. And because everything is today searched on the internet or on Instagram or on AI or in Perplexity or any of those things, I think it's an open slate out there of differences that are available and differentiations that are available. So no brand can take its position for granted.
I'll ask you this specifically in the context of this move of less sugar, away from sugar, We're now seeing regulations world over clamping down on the use of sugar. You've had a difficult time in India, especially as far as the infant food side of the business is concerned. Do you believe that that's an area where you believe you perhaps have not seen the sands or not acted fast enough to deal with the shifting sands?
I think what it has taught us is that even if we were prepared for it, but the event happened before what we anticipated, we are opening up all the avenues in our nutrition cycle to see which are the brands and what kind of attention do they need. So this is an active exercise that is on in the company. You'll see more new offerings coming in, more renovated offerings coming in as a result of this journey. So we take this journey very seriously, and we believe that there is something that Nestle has to offer, because the food science, the technology of nutrition is something that Nestle is blessed with. And therefore, we see, in fact, greater opportunities now that quality of consumption is becoming centerpiece. There was a time when only price points mattered. 2 rupees or 4 rupees or 5 rupees. Today, quality matters. And that's good for us, because the quality of consumption is going to determine the journey for our company.
So how different is the Nestle of today going to look from the Nestle, say, in the next 5 to 10 years in terms of being able to deliver on some of these expectations that consumers now have? You talked about product renovation. You talked about making the product more relevant to the needs and the changing behaviors of consumption. How different will the Nestle of today look?
It will be quite dramatically different, Shriram, because a lot of the expectations of the consumers, be it is not just on the nutrition profile of products. It's on variety of products. It is on sustainability of products. It is on the modes of communication of products, the channels that, quick commerce didn't exist 2 years ago. Today, about 8% of my business comes from e-commerce, and almost 5 to 6% of that 8% comes from quick commerce.
Has it taken you by surprise?
It has taken me by surprise. I always believed that quick commerce will be a lot more slow burn as compared to what it turned out to be. But today it is a very robust platform, not just for me, but for many other brands, to be able to do quick testing to see whether they are viable, sustainable concepts, right? Use of analytics and technologies in channel and point of sale, together with nutritional competence and channel savviness, in a consumer environment that is becoming increasingly more digital, is going to be the hallmark of a new Nestle, which will be different from the Nestle that I had the privilege of leading.
As you look at this changing landscape, and you talked about the fact that you believe India is today the most exciting market, what will change the game? Everyone's talking about this big consumption boom that we're expected to have. It's been a slow last few years. The hope is that we're going to start to see things pick up. What will be the game changer?
I think the game changer is going to be two things. The game changer is going to be the speed of innovation that we are able to offer to consumers in the market, and also an acuity of the price-value relationships that we define. And the third one is premiumization. This is the one market where premiumization is exceptionally strong, right? We introduced our Nespresso boutique a few months back. I can tell you, Shireen, the response has been spectacular. I didn't have that expectation because I knew that people were carrying machines and pods and stuff from wherever they were traveling. But we get very steady visitors, a lot of inquiries, a lot of interest as premium coffee. So the premiumness is coming into consumption in this country. The level of sophistication is high. The level of aspiration is high, and also in small town India. You know, we see it in weddings. You know, we did a small experiment to have Maggie counters in weddings because anecdotally, one of our directors said that at her daughter's wedding, a Maggie stall attracted far more attention than the other traditional food fare.
In a wedding?
In a wedding. In a wedding. So she said people were not going towards the traditional food. After wedding parties are Maggie parties. That's how it is. That
sounds like a great campaign.
this has become a line of business now. So at weddings, in some cities, we tell the bride and the groom to customize from a menu of recipes, which is the one that they would like to be served at their wedding. So it is kind of branded with their name and their guests. And people have told me this, that even at more traditional weddings, some of them, the elders are getting a little miffed because they prepare all the authentic food, you know, whether Bengali or Marwadi or South Indian or whatever, and the kids are flocking towards the Maggi outlet. So that's the new India. I mean, the irreverence comes from that, saying, I couldn't care less for your traditional stuff. I'm going to go for what I like.
So given the fact that you've seen a dramatic change in the way that people are consuming, are there categories that you believe you should be that you're not in today?
Yes, I think there are some of the categories that we have got into. For example, pet care. I think it's been a very exciting journey. The joint venture that Nestle Health Science has with Dr. Reddy's, I'm very excited about, because the healthcare space, Shireen, is absolutely exploding. And the question there is authentic, relevant propositions, rather than just vitamins and minerals being made available and supplements being available. So that's an exciting space. There is enough room for growth in the coffee space. Coffee, we are market leaders by far. There is a lot of headroom there. In the foods business, the whole ready-to-eat area is open for us. So there is opportunities there. In nutrition, premium nutrition is an opportunity. So I see opportunities, big and small, across. Breakfast cereals is a relatively small business, but again, we've got some exciting plans there. So really the whole food space is going to be very, very interesting in this country as we move forward.
You know, you've had a significant expansion pipeline over the last few years. You've set up new factories, including an all-women's factory that you've set up in Sanand as well. What has been the most gratifying, but also the most challenging aspect of greenfield expansion in India?
As a company which has been around for 100 years, I think the challenges are much less. The ease with which we have set up factories in Sanand, or what we're looking at in Odisha, has been pretty smooth. One of the challenges that we have is convincing more women to come into manufacturing. There is a societal reluctance in some situations where women don't want to come into manufacturing because it's seen as a tough job and not meant for a woman. Behind a desk in an office is seen to be a better job. So there we have challenges.
Why did you make this bet on ensuring that you create a factory that's an all-women's factory in Sanand? What made you do it?
I think two things, Shri. One is that I think a company has to look at not just the short term but the long term. And with 50% of the population being as women, I think we are depriving ourselves. It's an economic need. It is not any emotional succor that I'm providing to women. The economic need is to ensure that young women who qualify themselves are able to get jobs in manufacturing. Somebody has to take that initiative. Others have taken the initiative. It's not that I'm the only one. But also it's an inspiration for other companies to press home the point that women in manufacturing is a viable, robust proposition that can continue for the future and not just a curiosa that somebody is doing to get headlines in newspapers.
You know, as you leave the Nestle that you've helped shape over the last 10 years and hand over to your successor, what is the one piece of advice that you will leave him with? And if I could ask you, what has been the one piece of advice that you've got that has been the most transformational through your corporate career?
Look,
and in life?
The piece of advice that I got in my life and actually came to me from my grandmother, my maternal grandmother, and this was reiterated during the Maggie crisis. And she always said that if you take care of people, everything else gets taken care of. And I read it as, if I take care of people, the business takes care of itself. And I've tried to follow that. Imperfectly at best, Shireen, but I tried my best. The piece of advice I would, which I've already given my successor, is keep the culture of the company intact, because this is what has made this company successful. Tweak it wherever you think it needs to be tweaked, but don't change the fabric of it, because the fabric of respect, of dignity, of hard work, of trust, and of compassion has worked in difficult times and in good times. Keep it that way, because you'll see magic happening coming out of it.
Well, speaking about magic, let me ask you the magic that marketers create. Products are built in the factory, but brands are built in the mind. What have been the biggest lessons from a marketing point of view that you would like to leave young marketers with?
Understand the purpose of a brand and what role it plays in the life of your consumer. If it doesn't play a role in the life of your consumer, it should not exist, even if you think it makes a lot of money for you. Number two is the proposition. The proposition has to be strong and robust in terms of what it does for the consumer and what kind of benefit it offers the consumer, both price and value and a composite of that. And the third is the navigation over a period of time. Brands, like human personalities, have a core, but there is parts of it which is changing. And this is where the anticipation of that change needs to happen. Classic example, Kodak did not fail because it was a lousy brand. It failed because it did not change with the technology of digital that was coming its way. So constantly there has to be an innovation that the brand brings in doing what it does. And the fourth is, don't make cosmetic changes for the sake of making changes. I think one of the tasks in marketing departments in many companies is that young brand managers come and they want to do a little bit of that, add a dot there, add a accent somewhere, do a little bit of color change, and hope and pray that things shoot up. Don't make changes, because consumers will never forgive you. Maggie is the way Maggie is written. If I suddenly made that into magenta and into orange and into purple, right, it's going to be very different. So I think consistency is also important. So proposition, purpose, its positioning, consistency, and innovations is what will drive the core of the brand.
If I could end by asking you, what is the one numerical milestone and one non-numerical milestone that you would highlight for us that encapsulates your journey so far?
Numerical milestone, I may sound immodest, Shireen, but technically for the records, during my 10 years, the organic growth has been double-digit CAGR. The profit growth has been double-digit CAGR. The market capitalization is triple-digit improvement. And the return on invested capital is the highest, I'm told, amongst listed companies on the stock exchange. So that's the numeric part of what has been achieved. The non-numeric part is of leaving behind a company that is strong, with very mature and stable leadership, with a culture that resonates with most of the people who work in this company, with attrition levels being at amongst the lowest that we have seen, and a company that looks forward to the future with a lot of hope and aspiration. So I leave a satisfied man and a happy man that here is a bunch of people who will make me happy to observe the Nestle truck as it goes past my window and say I was happy to have worked there.
So, what is your leadership language? Three attributes that define your leadership language.
Trust, transparency, and focus.
Suresh Narayanan, always a pleasure. Thank you so much for joining us here on the Leadership Language. We wish you the very best of luck.
Thank you.
With the next course of your journey, and I hope it's equally exciting. But thank you so much. We appreciate you joining us here on the program today.
Thank you, Shireen. Thank you very much for this opportunity. It has been a real pleasure. Thank you for being the one there, the one anchor to host me when the whole crisis started. And you're still there to host me as I walk away from it all.
But some things don't change.
Yes, some things
Thank you so much. Hello and welcome to the 12th edition of Voices from the Valley. I'm Shireen Bhanwal. The Valley really embodies the spirit of capitalism, which is about creative destruction. As you've seen through the course of our journey here over the past week, we're not just focusing on big tech. We're also focusing on smaller companies that are doing some pretty cutting-edge innovation. To talk to us about his startup story, joining us now is Arun Karthi Subramaniam, the CEO of a company called Articulate, born inside Intel. It's hoping to capture the generative AI space, but to tell us how it intends to do that, joining us now is the man himself. Arun, it's great to have you here, joining us here on Voices from the Valley. Before I talk to you about Articulate, let's talk a little bit about your backstory and how you made it to the Valley to start with, from Chennai here to San Francisco.
Absolutely, Shireen. First of all, thank you so much for having me here. Thanks for taking the time. It's fantastic to be talking to you. So, my story is actually in some ways pretty traditional and some ways pretty non-traditional. So traditional in the sense that I went to engineering school in India, I came here for my graduate studies, always loved everything that flies, and I'm an aerospace engineer by training, went all the way through to my PhD in aerospace engineering. And then spent more than a decade building jet engines and gas turbines and rocket systems for various things that fly. And most of my work was on both designing systems and doing large-scale data stuff. And then we ended up building digital twin frameworks for large systems that went into production, they're still in production today. That translated to doing large-scale data work for aviation, for power, for oil and gas, which then got me to Amazon, where they were building up their high-performance computing systems. Yeah. And we ended up building some of the largest models, or helping people build some of the largest models out there, which got me to Intel, because Intel at the time was building out their overall cloud infrastructure, overall AI story. So they needed somebody who could come and help them build their AI business on top of silicon. And so that's really what got me to Intel. And really the allure was to build data centers anywhere we could, and actually run workloads that were not possible anywhere else in the world. And I knew, coming from my experience in Amazon, that that's the workload that the world is going to need. Now, this is early 2021, late 2021, 22, before ChatGPT is launched, any of that, right? So the tech community kind of sort of knew, but the rest of the world certainly hadn't woken up to it. No. And the real applications hadn't come out yet, right? So that was the time I was at Intel. We built out the infrastructure required to build these models. We went out, got a customer to actually say, look, give us your data, we will build a model for you that will be useful back to you. Now, this is all public information that happened to be Boston Consulting Group. They gave us their data, we built a model on their data sets, deployed them back into their environment. They built an application that was super useful for them. And that sparked the idea of saying, look, the application itself and the full software stack is equally valuable. And by the way, we deployed the first ever application back to them in November 2022. ChatGPT was launched end of November 2022. So it's a month before ChatGPT launched that we actually launched inside their environment. And once ChatGPT was launched, it was kind of a slam dunk for everybody to say, I want that. But
nobody was looking at AI with any scorn at all.
Not at all. Not at all at that point in time, right? So it was really around the excitement of something completely new. It was almost a Christmas surprise, if you may. Because the first time we pitched it internally saying, look, this has to be a software business, we were kind of told, look, we're a hardware business. You need to actually focus on that, and software is great, but then it needs to enable hardware. But then the year rolls around. The next year, we already had contracts that we could actually go enable software sales from inside Intel. So it was already a viable business that is starting on. We were able to go get funding from outside to say, look, this is a viable business, we can actually go start it. And we ended up getting to a point where it was launched as an independent company. So it was born inside Intel, but it's launched as an independent company January 1st of 2024. Where Intel is an investor. They're a great strategic partner, and then later on they also became customers. But we are an independent venture, so we have to actually prove that we can actually exist as an independent company.
So, so born inside Intel and now your own independent venture, pun intended, explain to me how you came up with the name Articulate.
Yes. So, like, looking for a name for a company is both personal and also a hard thing to do, partly because we're looking for something that has meaning, something that can actually express what you're trying to do. And also something that's catchy, like, because there's so many companies out there. I was trying to look for something that says that we are finding meaning from data,
Yeah.
okay, and meaning from especially messy information. Articulating is like very much fits that. But if you look at the word articulate in English, it has 8 characters between A and E. So it's totally 10 characters, but 8 between A and E.
Yeah.
So, and a little bit of geekiness where you have A8E. So there are a lot of systems that are named that way, like A16Z or say K8S. Those are all like that many characters in between. So I started writing A8E. Then I realized, well, A and 8, if you say articulate with an 8 at the end, it kind of rolls off your tongue as articulate.
Yeah.
And it also has a technical meaning with an A8. It works well together.
It worked well, and this is serendipity. We have a pool table right behind you with an 8 ball.
Who would have thought? Exactly.
Who would have thought that that was going to happen?
And later on, I find out that 8 is a lucky number in China, and A8 is something that actually relates well with a lot of people. But it's really came out of the geekiness of trying to get 8 in between the two.
But now let's talk about the market opportunity and what you're going after and why you believe you have a right to win in a market where, a lot of people are trying to go after the same set of problems.
The problems we are tackling even from day one are problems that I would say are core to any large enterprise. Okay. What I mean by that is you go into a manufacturing company.
Yeah.
The company manufactures stuff. Does it need legal? Does it need finance? Does it need HR? Absolutely. But those are all enabling functions. They're not the core for why the company exists.
Yeah.
So we walk into a manufacturing company, we work with them for manufacturing first. Unless we enable their manufacturing operations significantly to be better, we won't touch a legal use case or a finance use case.
Sure.
However, it's not to say we never do finance use cases.
Yeah.
We can work with a financial services company on helping them do better investment. But that's the core of their operations.
Exactly. Yeah.
Exactly. And the reason why we focused on that is, first and foremost, that's the most high-value use cases. That's number one. The second one is that's also the most stickiest. So once you show value in something like that, it's very hard for you to be replaced. So our model mesh is the core of our IP, is a system that decides what to call when, what to use when, and based on the responses, decide should I continue using it or not.
Okay.
Right? And so it was a reasoning system to begin with. And we did that out of necessity. I wouldn't claim that we were so smart that we knew that's what was needed. We did it because that was what was required to solve a problem.
Yeah.
It was almost necessity was the mother of invention. That's what happened. And we solved problem after problem in manufacturing, in aerospace, in automotive, in semiconductors that required a level of specificity that you cannot do with just a few models together, and you cannot also presuppose what the solution is. That's really what ended up being our core of our differentiation. In a different way, people ask the same question you asked us, right? So what's your moat? I have two answers to that, right? So the first one is a bit tongue-in-cheek, which is if Satya, after spending $15 billion, says, I don't have a moat, nobody else can quite pretend they have a moat, okay? However, I think about moats as resilience, which is how quickly can you respond and how resilient are you to changes and attacks. I'll give you a specific example, right? So we use open source models as general models. We don't build any general purpose models just because I just explained there's no differentiation. If I spend money on that, I might only be as good as somebody else. I'm not getting it for 3 days. So it's not something I would want to do. However, I can start from there and go forward as long as it's contractually valid for me to do that. So we use it today, for example, a lot of our base models are Llama-based models. One of the models that we released was for energy. So it was with our partnership with EPRI and NVIDIA that we launched for the energy production and transmission world. And that model was built on Llama 3.1. That was the best model at the time. Now, that model was 3 times better than Llama 3.1 because it's a domain-specific model. General purpose model has never seen that kind of data set, so obviously it's better, no problem. We know how to train a model, so it's better. Now Llama 4 comes out, and we knew about that like in advance. We are great partners of Meta. They said, hey, can you test this? Right? And we test it. It's 70% better than Llama 4 because this model is trained on tasks that the Llama 4 was never trained on. It's never seen the data set. It got better on general purpose tasks. It got better on reasoning. However, it didn't get better on the specific tasks we went after. That's what I call resilience. It's not quite a moat yet, but because my 3x went to 70%, However, I don't have to immediately rebuild. I'll rebuild when it's convenient for me. And it's not just this one model. In addition to the energy model, I have an aerospace model. Then I have a table understanding model. And models for us is a means to an end.
Yeah.
It's not the core of what we do.
Yeah.
They're there because
Yeah.
they give us advantage,
Yeah.
but that's not the only thing we do.
Since you're passionate about aerospace, that's the origin story for you as well. If you had an aerospace client today and you just showcased your technology at the Paris Air Show, what is it that you could do perhaps for a client in the aerospace?
In aerospace world, as you mentioned, it's a great day for us today because Paris Air Show, we actually launched our entire aerospace profile of portfolio of products, which go from design, manufacturing, analysis, and operations. So it's the full gamut of everything from, like, say, birth to the overall life cycle management of a product. What I mean by that is it needs to understand the domain, specificity, but it also needs to understand sequencing. What I like, meaning you start off with, say, understanding what the design is, and then it goes into manufacturing. But the manufacturing needs to understand supply chain. And the supply chain needs to understand finance and cost, and it also needs to understand what is the level in the world that it can actually be manufactured into. All of these processing steps need to come together. And it's no one model, it's no one system. And by the way, just to make that story happen, you need like 15 different vendors to talk to each other. All of them have their own data systems. All of them have their own misformats and mismanagement all over the place. We are actually an engine that can talk to all of them, right? And it's in a way, think of us as the glue that actually connects different buckets that never talk to each other. It might be one person talking to your sourcing team. Now imagine your design team has the full information of everything that is sourced. Or your manufacturing team knows how it's going to be in operation. That connection is really what we are enabling.
Given where you are today, and it's only been a year since you actually kind of birthed out of Intel and launched to the world, what are you seeing in terms of customer and client traction?
Yeah, so I would say the business traction is better than anything we could have possibly hoped, not just for us, but for the entire industry. Part of that is everybody has moved on from doing POCs to actually doing real things. So the expectation is very high, but they want to do real things. And not only want to do real things, they're also investing in making sure that they can up-level themselves. I would say companies fall in 3 large buckets today. All of those buckets are still investing. Right? So that's a very big difference from any other technical sale that you can make. But the 3 buckets are, the first one are people who already tried, spent a lot of money, know that these are the things that they can do, here are the gaps, they need somebody to come help them. That's one bucket. The second bucket is they're still in the process of trying things out, and they think they can do everything, but they have not yet hit a wall. They're like, you know, like, I think I can get it done. Like, my vendor is saying they'll help me, my cloud provider is saying they'll help me, I'll do it myself. Maybe some of the use cases they will. Some of the use cases are so complex that they'll realize that they need somebody else to come help them. That's the second bucket. The third bucket is, I know I need to do something in AI. I haven't really done anything. I'll just wait and see like what the rest of the folks are doing, where they're failing, and I'll catch up. I'll catch up very quickly. My message to the second and third buckets is, work on problems that you can solve, no problem, but then work on problems that are most critical for you. You're going to need help at some point. Getting help is actually going to get you accelerated. That's the main thing. The second thing is the third bucket. Waiting here is unlike waiting in any other time in industry. The reason for that is, think of being in 1994 or 1996, and you not only know about the internet, but you also know about the financial implications of how to actually make it financially viable and profitable for you. It was very, very few people in 1996 that could have predicted what happened. Today, people can actually see it. They can measure financial value, and they're investing because of that. Last year, I wouldn't have said that, because last year was more about people saying, my board is telling me to do AI, I just have to do something. Now it's a lot more intentional, a lot more meaningful. You're going to see your competitors break away like they never broke away, because they're being very intentional about where they're investing in AI. They're not just randomly saying, just throw AI everywhere. Use it in places that you can't get to an outcome before. You can actually get to an outcome before today. and do it intentionally where you can measure outcomes.
understand from you what you make of what's happening in India today. You, in fact, had the opportunity to work with MeitY to design the policy that the government is taking forward as far as semiconductors is concerned. 10,000 GPUs, whether that's enough or not, is not really the relevant question. But should we be chasing a sovereign model?
The focus, the drive, the relentless investment from the government, I would say, is very commendable, both from directly from Ashwini Vaishnav ji as well as from people like Rajiv Chandrasekhar and the current minister. they're being very consistent in the investment message. No inconsistency there. The inconsistency really is in two camps, right? So without naming names, there is one camp that consistently says, oh, this large models is not for us. We can't build large models, therefore let's not focus on that. Let's focus on building applications. My view is polar opposite of that. Because
so you're saying go after the large models.
Yes, because of two reasons, right? So, and they keep using the example of ISRO in a completely incorrect way. Because the example they use is, well, ISRO could launch a Mars mission at 1/100th the cost of what NASA could do. True. However, ISRO still launched to Mars. They didn't want to go to the treetop. The expectation that we will just build applications and we don't need to worry about large models is aiming for the treetops. You can't really have one versus the other. And I'll give you some specific examples without naming the models again. And I'm a big proponent of open source models. But there's some open source models that are not from India, not from the West. They're from China, right? And this is not anything by design. It's just the data they've been...
You don't have to name them. I think
everyone knows what it is. Well, there's a couple of models, so they know exactly which one this is. But we had these models have an Indian open data set, and then you're asking a question, and the question was, what are the local authorities in Kashmir doing for agriculture and improving agriculture in Kashmir? So the model started answering the question. No problem, it's in English. The question was in English, the answer is in English. The documents are in English and Hindi. That's all the language that is. And then it says the local authorities and switches to Mandarin. And as far as the model is concerned, the local authority in Kashmir is China. And it went on in great detail of what they're doing in that part of Kashmir, right? Now, being an Indian government or being an Indian or being anybody who cares about specificity and meaning, do you really want a model that is not trained with the data sets that you approve, is not trained with the same kinds of value systems that you care about, educate your next generation? That's what will end up happening. So the question of does a country like India need a sovereign model, in my opinion, is a pointless question. You really, really need multiple models that are not necessarily sovereign. The reason I say that is they need to be heritage models. And the reason I like the word heritage more than sovereign is sovereignty, in my opinion, and this is highly biased, so take it for what it's worth, is not necessarily an Indian concept.
No.
Okay? Like, you know, the whole notion of Atithi Devo Bhava or Akhanda Bharat or anything like that. It's really, everything is for the world and the world is for everybody. It's really working together and coexisting.
But Arun, you know, given where you are from your vantage point now, what do you see as the next big thing as far as Articulate is concerned? I mean, what's the ambition? You're talking about the moon and Mars and not the treetops. So what's the moonshot moment going to be?
For us, the moonshot moment really is, I mean, we've like stated this publicly as well. So it's really not the 100 million moment. For us, it's the $1 billion moment for us, really. The reason I say that, and I say that with all humility, which is I am fully aware that the chances of becoming the next big $1 billion plus company is very, very small. However, the ability to do so, the market's existence or the availability to do so, and the time frame in which that is possible is very much in reach. So our mission is to get to us being a $1 billion business, not a $1 billion valuation company. I'm trying to make a big distinction.
And it is an important distinction to make.
Yeah, because anybody today is a $1 billion
valuation. Yes.
So I'm talking about a legitimate $1 billion business in the next 4 to 5 years is really what we're going after. And doing that not from a consumer point of view, but doing that in an industrial point of view, in a B2B sense. And I'm also fully aware, as I say this, that only maybe less than 7 or 8 companies in the world have achieved that. But if you're not hoping for that, then why are you in the startup business to begin with? Right?
And that's where I started. This is the hub, the heart of creative destruction.
Absolutely, and that's really what we're going for. And if you look at you can sit there and say that, but what gives you the
audacity?
Audacity or the slightest sense of confidence to do it? Just to give you some numbers, last year we beat our targets by about 3 times, both on the contract side and on the revenue side. This last quarter, just the first quarter, we pretty much tripled it. Whatever we did all of last year, just in the first quarter. 12 more days to go this quarter, so I will cross my fingers.
So when do you hope to close the quarter?
So we will probably double whatever we ended up in the last quarter, right? And just in this quarter alone.
Give me a ballpark number.
So I'm not in the business of giving numbers before we actually close, but what I can tell you is in the high 8 figures, right? And just to give you a sense, right? We are a company 18 months in. And we're a software company. We don't sell hardware. We don't sell cloud services. None of that. Getting to these kinds of numbers without necessarily just having a consumer business in itself is pretty high. But the other reason we are able to do that is because the market is ready, right? The market is really looking for solutions that can get them value. As much as I would like to claim that we are so smart, it's really around being at the right place at the right time. But most importantly, hustling to get things done where other people would not touch it. Right, so an example I'll give you is we are in an air-gapped environment, no internet connection, inside a semiconductor manufacturer deployed for a year. And they publicly talk about it. I don't know of any other Gen AI company that actually deploys things like that. And most of them won't because it's a very hard problem to solve, and it's also a messy problem to solve. We're not afraid of mess.
Well, I guess profit is in the messy, hard problems that you attempt to solve, and may you find many more messy problems to go after. But it's been an absolute pleasure, Arun. Thank you very much for sharing your billion-dollar dream with us here on Voices from the Valley. We appreciate your time and your insights, and we look forward to hearing more about you and the Articulate story. But thanks very much for your time today.
Absolutely. Thank you so much, Shireen. Thanks a lot for taking the time, and thanks for the opportunity.
Our pleasure entirely. Well, with that, it is time for us to wrap up this edition of Voices from the Valley. If you enjoyed this conversation, then do visit us on our pages on social media, on our YouTube channel. From all of us here on the team for now, thanks very much for watching. We'll see you shortly. Welcome to Voices from the Valley. I'm Shireen Bhan. We're here at Menlo Ventures. It's got a 47-year-old history investing in startups, 165 M&A transactions that it's been a part of. Some of the hottest bets that it's making today are in companies like Anthropic. Joining me now to talk about the road ahead for Menlo Ventures and his view on all things AI is a man who has now become a tech influencer. Also, of course, is a products guy and an investor. Didi Das, thanks very much for joining us on Voices from the Valley. It's great to have you here.
It's a pleasure
on
to
the
be
program.
here, Shireen. Thank you for having me.
Before I talk to you about Menlo, let's get a little bit of your backstory. Cornell, Google, Glean, and now Menlo. How did this come about?
Well, Shireen, you know, I grew up in Calcutta, and when I was in India, what I really wanted to do always was, you know, just to come and be an engineer somewhere in the valley. You know, you'd grow up, you'd look up to companies like a Google that sort of was the bastion of the internet for the longest time.
Right.
And the reason I feel like when I was growing up, I learned so much about the world. And that was really the dream. So when I came to Cornell, I studied computer science. I eventually worked at Google, and I was working on search, and that was sort of the dream for me. With time, though, I realized that the potential and what the Valley really offers is far more than working at a big company, and I knew I wanted to do startups.
Yeah.
And that's sort of when I made the transition and I realized, well, I wanted to start something.
Yeah.
But I ran into Arvind. I met Arvind very fortuitously, and then we spoke, and then I joined Glean on the founding team. And that was
your best decision, I believe.
I believe it was a fairly good decision. I mean, Glean worked out pretty well so far. It's a $7 billion company. We saw it grow from, maybe 5 people when I was there to now it's almost a 1,000-person company over many, many places.
Yeah.
But really at Glean is what really solidified, oh my God, like this is how companies are built.
Yeah.
And after Glean is when I realized, you know what, like there's not enough people on the investing side who are
who know how to start a company.
How to build a company, who understand all the work that's involved. And I was I didn't really want to ever go into venture capital. That was never something I wanted. But after doing engineering, product, a lot of hiring, sales, marketing at Glean, I sort of started to understand how businesses are formed. May have made sense to go and start a company of my own, but I realized it would be so much more interesting if I could help a bunch of different companies figure this out on their own. And that's how I sort of moved on to the venture capital side, which is, traditionally an industry where it's full of people from business school who are doing finances, know how to read an Excel spreadsheet. That was never how early stage venture worked, though. You don't have many numbers to go off of. And what you really need is someone who understands technology, how to hire, how to get a company off the ground. And I thought, maybe I'd be pretty decent at that. And that's how I came here. And it's been about a year and a half, and I've been really enjoying it. I feel like it is really, really fun to work with companies who are just getting things off the ground.
A VC with a founder's mindset, is that how you would describe yourself?
I guess so. Like a lot of what founders look for, it's a very intimidating journey. You're doing this thing often for a first-time founder alone, maybe with one other person, and it's very isolating. It's a 24/7 job.
Yeah.
You don't know who to look for help, and really all you have is your investor. And if your investor understands that journey and really empathizes with it and knows how to do it, I think that's a pretty good sell, and we can work better together to get that company off the ground. So I would describe it that way.
Let's talk a little bit about Anthropic and the bet that you're making there. $65 billion valuation at this point in time with the latest fundraise. What excites you about what's going on at Anthropic?
Well, there's so many things to name about what goes on at Anthropic. If you look at, we look around the world and almost a lot of people want to be software engineers. Computer science may be the most popular major in, dare I say, the world, if not America. And that's happened maybe in the last 15 years. In many ways, there was this career people would aspire to be in banking or in consulting, and for sort of the cookie cutter way to do it maybe in the 90s. Over time, that sort of shifted to computer science, and there's been so much talent that goes in. What really excites me the most about Anthropic is we're finally seeing a world where that really highly skilled job, you can have a machine do a lot of parts of that. And that's a tectonic shift in like how we even see the future of technology evolving. I, the other day, went on my computer and we were analyzing some data for this company. This was like a 100 MB Excel file. It takes 2 minutes just to even open on your Excel on your computer. And I want to run this analysis. I open up this Anthropic product called Claude Code, and I just say, hey, you know what? I just want you to run a cohort retention analysis on a dollar basis, transaction basis, and a customer basis. That's a task that would normally take, an MBA associate, maybe a week worth of time to do all of this stuff together. It took the computer 2 minutes. It printed out these beautiful, beautiful graphs that I could see. And if that's not magical, I don't know what is. I mean, when we grow up, I was like, this is what you sort of dream of. Like, what do you mean I don't have to write the code and think about it? I can just do what I want to do. So I think that's what's so exciting.
But it's magical and scary at the same time. I mean, even the team at Anthropic is warning us about a white-collar bloodbath. So in this context, then, is computer science really going to be the sexy thing that people want to do? Or are MBA associates going to be a thing in the future? I mean, what are we talking about?
I know it's really scary, and there are parts of, I think, every technological shift that can be a bit scary. I do think that it's really hard to predict the future, obviously, with things like this, and you honestly risk sounding very foolish by even trying to make any predictions. I don't even know what's going to happen 4 weeks from now, right? All of the guesses on how models change, how the intelligence increases over time, we don't know. That being said, if I were to look at history, usually what happens in history is when there is a monumental shift, humans find a way to adapt and do something else. And yes, is it a risk? Are white-collar jobs in danger? Maybe. But one can also make the argument that even if you didn't need 100 people to do the job, you can get the same job done with 10 people, and maybe those 90 people can go do other new things, and it's net more productive to society. And I know one of the things that everyone always talks about, and it's TBD whether this actually happens, is when are we going to see generative AI actually contribute to productivity and GDP? And I think it's coming. I mean, it goes without saying, even today, change takes time. But when I speak to companies, today companies are able to do with less than 10 people more than they've ever been able to do before. We are talking about billion-dollar companies that exist today with hefty amounts of revenue, less than 10 people in an office. And it's kind of surprising to see. You would not expect that in the yesteryears. Even 5 years ago, a billion-dollar company, you usually say has 250 people, maybe 500. So just that productivity increase, I'm very optimistic about that future.
Let's talk a little bit about what's happening in India, especially as far as the AI space is concerned. And I think, there's sort of been this debate on whether we're doing enough deep tech and we should be prioritizing deep tech. And I think that it's a process of, of the evolution of the startup ecosystem, and perhaps we're getting to that point of some degree of maturation where we will start to see that happen. But what do you make of, the AI efforts, the Sarvams and Krutrims and so on and so forth? I mean, you're pretty vocal as an influencer. So what do you make of what's going on there?
Well, look, one thing I'll say is, even on the history of companies that have been formed in India, the tech companies that have been formed in India, often their right to win is a grasp of the knowledge of the people and the customers that they deal with. For example, if you look at a Zomato, a Zomato would have crushed any other international competitor in India because they were able to execute better on the ground in India. They innovated on the ground on how you can do these things, how you can recruit people, how we can make this business work. India is an example, somewhat unlike China, which is a fairly closed-off marketplace, where we've chosen that we want to compete on a technological level. That's a hard choice to make. Right? Protectionism versus free markets has always been a debate throughout history, and we have chosen a free market path. For all of the companies in the past, that free market path worked out reasonably well. We got the best of companies that were in America and in the rest of the world and their products. And then in our products, we figured out how to make it work on an India scale. With AI, that's a little bit different because it's a pure technology where it's unclear whether your understanding of the local area has any difference in terms of product. It's a pure software play. And when you talk about pure plays, it's very difficult to compete with the people here and the companies here. And the reason is you need capital investment. You need talent. You also, some people make the argument of, hey, what if we made models that were very good for Indian languages? Sure. Why would you have more data than someone like Google? Google's sitting on all of YouTube. Google has infinite access to resources to collect data in every single language. And the last point...
So you're saying that's not an advantage either?
Maybe for the short term. Maybe you do partnerships that solidify, that make your product accessible to a lot of people. But at a pure technological level, I find it really hard to even squint my eyes and see a world where in Hindi or Tamil or Bengali or whatever language you choose, that they don't have more data, they don't have better models, and they don't have cheaper prices.
They may choose not to prioritize it, though.
that is always temporary, in my opinion. For a company like Google, who is, sort of in their DNA is to build products for the world, internationalization or localization, as they call it.
Just a matter of time.
It's just a matter of time. They are prioritizing it at some level, and it will probably come. So the question is, how defensible would be the work that you do today?
And we've got the government coming in and backing, foundational models and saying that we'll have our India model in the next 6 months and so on and so forth. How do you see this playing itself out? The government kind of also, in a way, collaborating, partnering, whatever you'd like to call it. How do you see this impacting business outcomes going forward?
Well, the downside of protectionism usually is you are protectionist when you sort of don't believe there's a current right to win, and you temporarily make some sacrifices to promote local technology in the hope that they will eventually catch up to global technology. Yeah. And that's sort of I think the premise of supporting sovereign models. I mean, there's security and there's some other stuff too. Given that premise, you still have to believe that these will eventually catch up in terms of power to frontier models. I just don't know if that's the case. It could be the case, but look at the amount of spend these companies have had to do to create the models that they do. I mean, you look under the hood, even say, look at the public rumors on how much OpenAI spends and how much Anthropic spends. We're talking several billions of dollars a year without necessarily seeing profit for a while. And the other question you have to ask is, who will front that cost in India? Is it worth fronting that cost in India? And then you come back to even somewhat adjacent topics, which is that the best use of money in India? It's nice to say you want to compete on a global scale in AI, but to me, it often feels like that shouldn't even be the priority. We wouldn't have said in 1998, hey, let's create a Google of India. It wouldn't have worked, right? And so similarly here, I don't know if an Indian foundation model is competitive or would work as a business. There are local problems to be solved. There are many cases where Indian companies have a huge leg up over companies that are global, and I think you should exploit those opportunities. Why focus on something which is extremely hard to compete with on a global scale? Almost no other country in the world can compete with America on this scale. What gives India the right to compete? I think it's still unclear.
So what excites you about the India startup story today, outside of course, what's happening on AI, where there are questions and doubts at this point in time on how it's eventually going to work. But overall, the India story and the India startup story, how's that looking to you?
I'm so excited about it for primarily the reason is talent. A lot more of a bigger percentage of the world over time of software developers come from India. And add to that what I said earlier about access to skills and being able to learn with these AI and LLM tools, the potential is unbridled. And in terms of just talent that can come up in India and do things. That's so broad, and for the foreseeable future, India will be a source of a lot of the global talent pool. And if we can figure out how to retain more and more of that talent, and undoubtedly we will retain a lot of them, then I think there's a lot of opportunity in India. I mean, if you look at just from a cost perspective, hiring an engineer, even an average engineer in the Bay Area, and I'm not one to say that Bay Area engineers are better than Indian engineers. I don't think so. They might look better on paper. But an average engineer, a senior engineer here might cost you $350,000 a year. That's not how much an average engineer in India costs. So what does that do for the ecosystem? That just means India will become a hotbed for both global startups and companies, but also an opportunity for innovation unlike any other. And there will come a time, and this is the story I love the most, there's early signs of this, where India is actually capable of building companies for the world. And you see a couple of these consumer companies, right? I like to always look at Pocket FM, probably the biggest one. But you see Indian companies create these consumer experiences that even Americans and the world will consume. And that will continue to happen. And I'm very, very bullish on that.
2025 and 2026, do you believe that we're likely to see consolidation by way of M&A in the startup ecosystem? Some of the names that you spoke of, the IPO markets picking up again, after, at least in the US, after kind of being cold. India, of course, has been a completely different story. But both consolidation as well as IPOs, you believe we're likely to see things heating up?
Absolutely. I mean, this has been a fantastic year for even Menlo. From that perspective, we've been very fortunate to have Chime go IPO this year, which was a huge IPO after a long time in the entire valley. And then we had some big M&A acquisitions that happened as well, where one of our companies that we funded, Neon, got acquired by Databricks for near $1 billion. So yes, I would say that M&A markets are heating up. I wouldn't say IPO markets are necessarily heating up. They're opening up again. But most venture capitalists will tell you that there is a stark difference between public and private market valuations. And crossing that chasm, if you will, has become hard because you're so overvalued when you're private compared to the value you can get publicly. That's number one. And then number two is, I think, an increasingly large number of companies want to stay private, which is somewhat the reason that you couldn't. The reason you wanted to go public before is for access to liquidity and capital. Today, you have that liquidity. You can just sell in the private market. There's so many private buyers. There's so much capital that the only incentive to go public is that you want to go public and you want to be listed, and it's some sort of achievement that you have. But who wants to report all their stuff to the SEC? Who wants to abide by all this regulation? It's very, very cumbersome to have predictable revenue and be a public company. So an increasingly large number of companies are just choosing to stay private. And that's something that we also have to contend with. The secondary markets are another way of getting liquidity for investors and people at the company. Secondary markets, M&A is picking up, IPOs opening up, but still I would say wait and watch mode.
Valuations, especially on the AI front, I mean, are we anywhere close to the peak, or are we still going to see crazier valuations?
The valuations are crazy. I don't think they're necessarily always justified. A lot of people, will say, hey, look at venture capitalists, they're giving people these crazy valuations. And, in my defense, the one thing I will say is, the valuations are really set by the market. And the interesting thing about a private market is there's no downward pressure. There's no equivalent of shorting a stock. In a public market, there's a reason because people can sell it and people can short it. And so there's no incentive for you to artificially blow something up. But in private markets, there's only upward pressure. So when there's access to capital to win good deals, you just pay crazy prices. And we're seeing all of these crazy prices.
So you admit you are paying crazy prices?
No, we are paying crazy prices. I don't think it's like that hard to admit. I mean, just objectively by the numbers, those prices do not make a ton of sense in many situations. You are often, it's not all companies, we often tend to focus and over-focus on the very, very crazy ones. But even the normal ones, I would say, are much higher priced than before, which increases the bar for returns. And that is just the market we live in, because there's access to a lot of capital. Last thing I'll say though is venture cycles. The reason this is possible in venture versus say like hedge funds who trade public markets is because the time that it takes for you to realize that you haven't done a good job is 7 to 10 years. It's a typical cycle for a fund. So 2021 was a time of reckoning. And a lot of the funds of the 2021 and 2020 vintage are affected as a result. They're not doing particularly well. But this will take 10 years to sort of play out. And maybe if you squint and go to like 2030, people think there will be a time of reckoning for a lot of the funds who have an overflow of capital to be like, we haven't actually done a good job for our LPs. We haven't actually returned money that we were telling them we would return. And then a lot of those funds will cease to exist, perhaps. And that's where you get the reversion to the mean over time. But I don't see it happening in the recent future. Right now, the valuations are still quite out there. I mean, you're looking at, maybe the most iconic example of that is Thinking Machines, Mira Murati's company from OpenAI. I mean, they started with a seed round of nearly $10 billion, and I don't know how to reckon with that. Like, you don't have a product or make any money. $10 billion is a pretty lofty price for something like that.
Yeah. So what do you believe the bet is on then?
I wish I knew. I wish I knew. I mean, we're not investors in Thinking Machines, but for the companies who are, their claim, actually, I do know. I'm friends with some of the people who work with companies like that. Their claim is the outcomes are so large that we can drown out competition with capital. Capital allows us to recruit better. It allows us to have leverage on how we distribute our product, and any other company that tries to compete with us won't compete. Maybe we won't see like a 3x, 4x, 5x return, but hey, even if we see a 2x return on that, that could be pretty lucrative given the amount of capital that's going into this, and maybe it could be at a shorter time period, more notably. So could we keep our like internal IRR pretty reasonable even by paying a really high price up front? Maybe. And the fact is, there's precedent for this. I would say that even if you look at companies like Anthropic, where we did back them, there is precedent for these humongous valuations turning into something even more incredible. We backed Anthropic at first the Series C and then led their Series D. And that seemed like an egregious price to pay at the time when they made no money, they made no revenue. It was unclear how they would even make revenue. Whether would they be consumer? Would they be enterprise? Would they have the frontier models or not? All of that was very unclear. And we made such an insane bet, and you fast forward now and you kind of look like geniuses. Like the company is doing so well, it's valued at 60-something billion dollars. So there is precedent for that.
Didi Das, the entrepreneur, Didi Das, the investor. Where do you find that you're most comfortable today?
I mean, I think I would always be more comfortable in an entrepreneurial setting. I think that is the source of anything that I've been able to do or otherwise as an investor. So that's always going to be my choice. Now, entrepreneurs are the lifeblood of the valley.
Well, there's plenty of that energy here in the Valley, and we hope we continue to see you fund a lot of that energy, at least in this avatar at this point in time. But thanks so much for joining us.
Thank you so
on
much,
Voices from the Valley. Appreciate you joining us here on the program. That's Didi Das. If you enjoyed that conversation, visit us on CNBC-TV18.com, on CNBC-TV18 Prime and Access. Log on to our social media pages. We'll see you again next week. Till then, from all of us here on the team, for now, thanks very much for watching.
Let's talk money.
Hello and welcome to another edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, India's retail investors are all set to get a brand new asset class to invest in. This new product will be a bit more sophisticated perhaps than regular mutual funds, but hopefully not as complicated as PMS or AIF products. I'm talking about an asset class that will be known as the specialized investment funds, an asset class that will look to bridge the gap between mutual funds and products like PMS, which is Portfolio Management Services, or AIFs, which are alternate investment funds. Now, we have to discuss what the risks are, what are the tax implications, what are these new, more sophisticated strategies involved, and should we investors really care? Well, to do this, I have two very special guests with me in the studio, Radhika Gupta, MD and CEO of Edelweiss AMC, and Swaroop Mohanty, Vice Chairman and CEO of Mirai Asset Managers. Thank you so much, Radhika and Swaroop, for joining in. It's a pleasure to have both of you in person with me in the studios. And with your presence together, I know this is an exciting moment for investors. What are we looking at? Lady, let's start with you.
Thank you. It's lovely to be here. I think, I usually have more mixed opinions about new things that are launched. But with the SIF launch, I am reasonably bullish. You said it's a middle path between MF and PMS and AIF. I actually think that for the consumer, it brings the best of both worlds. What PM, and I came from an alts background, so perhaps this is closer to heart, but I think what PMS and AIF offered is flexibility in investments, flexibility in subscription redemption, how you use credit, how you use derivative. But what mutual fund offered was comfort. People are comfortable with the structure. You can do SIPs, huge sense of tax advantage. You know, the consumer doesn't pay any tax. I think SIF gives you the flexibility that that AIF and PMS had, with all the comfort that mutual funds have. And the 10 lakh ticket size, I really think opens this up to consumers, a much wider range of consumers, because when you were talking AIF, you were talking 1 crore investor, which means someone with 10 crore net worth to hoga, because you won't put more than 10%. So that versus someone with a 1 crore net worth, I think the ambit of people that we can speak to is very good. So I think in India's asset management evolution, you know, you saw the evolution of passives, multiple investment styles, smart beta. I think this is a welcome step in the evolution, and I'm glad the mutual fund platform has been chosen, because it's a platform people have gotten comfortable with.
Okay. Well, the objective is to make it as simple as possible for people to understand, because there are nuts and bolts and nuances of this new product. Swaroop, what are your opening thoughts? Do you see this as a big stepping stone, or well, it'll be one more product that AMCs offer?
No, it's a step forward, both for the investor as well as the asset manager. I mean, look at it, we are graduating forward into a slightly more evolved space. I won't say complicated or easy space, but for an asset manager, it's great to start expressing ourselves into new areas of investments. The regulations have made it far more broader than what we used to do. The risks are very different, so how we manage it, how we look at the whole space will be different to each fund managers. And I think it's the emergence of style-based investing coming out from each fund houses. So it's a great platform to express our backend to the investors. At the same time, from the investors' perspective, and I say this with all humility, when I look at the last 2-3 years in particular, when return chasing has become so blatant, risk understanding needs to go up. Finally, you start your investment journey thinking it's a process of return generation, but it's a process of risk mitigation.
DBS presents CNBC-TV18 India-Singapore Connect.
Hello and welcome to DBS Bank presents India-Singapore Connect in association with CNBC-TV18. I'm Shriram Finance. From a single office in Mumbai to a presence in over 350 locations across India, DBS Bank has spent over 30 years committed to the India growth story. As Singapore's largest bank and one of the world's most digitally forward companies, DBS Bank has been a pillar of the India-Singapore corridor. driving this next phase of growth in India is Rajat Verma. He joined DBS Bank India in 2023, became CEO in 2025, and under his leadership, the bank has been recognized for its strengths in corporate banking and cash management by CRISIL Coalition Greenwich. Rajat, thanks very much for joining us here on CNBC TV18. It's great to have you back in the studio.
Thank you, Shriram, for having me.
Let me start by asking you about what the India growth story looks like to you at this point in time. I know in the last call, the global leadership did call out India, saying that the fundamental growth story remains intact. But given all of the volatility and flux that we see world over, how does India stand out?
I am a great optimist on the India story, and I have been for a very long period of time. I think fundamentally, if you look at all of the evidence on local production, on our exports, on all of the sort of structural changes that have happened in India over the last decade, maybe more than a decade, I think there's a lot to be optimistic about the fundamental growth story. The other thing, of course, is you have a massive aspirational population which wants to upgrade their lives, buy new homes, buy better food, buy more protein, etc., etc. So there is a momentum that you cannot deny, and that momentum will not go away irrespective of what trade sort of situations lie in here. So there's a lot of consumption demand that is going to keep coming in India, at least till it reaches a certain level. The curve of that is a little steeper. It'll start to saturate at some point in time, like it has in every other developed country in the world. But that is, I feel you still have a couple of decades before that happens. So I think fundamentally, given that you have this inherent local demand, fundamentally you have structural stability and improvements over a period of time, I remain very, very optimistic that whilst there are issues around the world, it's not a steady state environment. Actually, I think India has got some significant de-risking elements to that, and therefore I remain very optimistic about the growth story in India, certainly for the next couple of decades.
Well, you know, the next couple of decades is a long way off, but let's talk a little bit more immediate,
Sure.
Rajat. And given the fact that you continue to be confident about the consumption story, manufacturing, of course, is the big other hope at this point in time. How do you see the bank positioning itself to make good this opportunity that India offers?
Sure. I think the banks we completed 30 years in 2024, so we've been around now for a while. We've got a network of branches, we've got various products we've got a full set, well, nearly a full set of what a universal bank will look like. And we are significantly invested in the country. We continue to invest in the country in the last 9 months of the last fiscal. So therefore, clearly we see the opportunity both in India as management, but also as our shareholder in Singapore as well. So, but we can't be all things to all people. It is a very large market, right? And it's very competitive, and therefore it is important for us to be able to focus on things where we can make a difference, where we can take leadership positions and add value to our clients. Because ultimately, if you do not add value to customers, you will start to lose out over a period of time. And therefore, that will remain an underlying theme, I believe, for the institution and for the time that I spend here as well.
You know, you talked about the competitive landscape, not just the domestic banks, but of course the large private and foreign banks that you're up against as well. So what do you believe are the sweet spots then as far as DBS is concerned? What do you intend to prioritize? What will the focus areas be for you specifically?
Sure. There are many. Let me begin with our wholesale bank, where we're well established. We established a branch in Gift City in July 2023 that is doing very well. I think it would be top 5 in its size already, although it's just been a couple of years since the time we started. It's inevitable as Indian companies grow in size that they need to diversify the source of financing so we can support that growth. I don't think anybody disputes that the growth of wealth in India is a monotonic, long-term opportunity for financial institutions to work with. So I see that as an opportunity for us. I see SME as an opportunity for us, because SMEs not only do they serve economic purpose, they serve a very important social purpose as well.
From a jobs perspective.
From a jobs perspective, and they're commercial. So I don't mean the CSR side of things, I mean the sort of the wealth creation, the industry creation that is coming from SMEs is actually very heartening to see. And the growth of Indian SMEs is absolutely essential for the long-term future of India. So I see us playing an important role. So I see that as an area of investment and an area where we can support SMEs who, for example, want to go overseas or want to buy from overseas. I see that as an area that we can be specifically more useful than some other institutions. Yeah, so we are invested in growth, but I don't think we should be invested in every type of growth that is available in the market. We have to choose and pick the areas that we feel that we'll be invested in from a very long-term period of time. We certainly want to have a view that we stay invested in a particular idea for a long period of time, because it does take time for many of these products to come through.
In terms of the loan book, you talked about how SME is likely to be a priority area for you. You also talked about fueling global ambitions and global aspirations of Indian companies who could potentially be looking at, foreign M&A at this point in time. Give me a sense of what the loan book is likely to look like over the next few years. What kind of growth do you work with at this point in time?
The way to answer this question is that this set of products that we are invested in, we want to take them to scale. We want to scale our SME business, and the evidence of that is that we've been growing nearly at about 50% or 40-something%, 45% on our asset book in SME, which I think is of course, the law of small numbers applies here as you grow, but we have now crossed about 10,500, 11,000 crores on our SME book, so it is now reasonably substantial. And we see continued ability. Of course, you have to add some new products. You have to make sure that you add a few markets as you go along. So that's on the SME side, and I could go on. But so there is a growth. India is a very important growth engine for DBS globally. I think you'd hear that from our group as well.
Yes.
And therefore, we have certain sort of dimensions in mind as we go through our planning process. But what I will tell you is that what is much more important to me is that we understand that this is really just, ultimately this is about how you compound over a period of time as opposed to how you grow. So it is less important whether we grow at X or X plus delta. What is more important is that we do not vary too much from our strategy and from the path that we think we can do in a controlled risk sort of setup. And therefore, it's really important that we don't grow too fast or too slow in any one year over a period of time, and that we get the benefit both at our top line and at our bottom line. So I'm very focused on both the profitability, so the risk-adjusted return, the cost-adjusted return of our business, the bottom line, but also at our top line. So I think they all go hand in hand.
You were talking about betting on growth engines here in India, and this is something that you and I have spoken about previously as well. The whole startup story, and link that to what we're seeing happen as far as the capital markets are concerned. How much of that is going to be something that you intend to prioritize?
Absolutely. I think the startup story in India is fantastic. And the number of entrepreneurs, it's also inspiring to meet many of these people. Some of them are 22 years old.
Yes.
They
do make us feel very old.
They do.
Certainly me.
And me as well. So I think it's certainly an area where we are very vested in. We are very vested in this as a group as well, elsewhere outside of India as well. And I meet a lot of startup founders, and I know you probably meet many more than I do. But from a bank, my question to them is, what do you need from a bank?
Yeah.
Often, this sector is largely equity funded, actually, right? Or even venture debt funded. Actually, equity funded.
Mostly equity.
Mostly equity funded. So that's not the primary need. I mean, many of them don't have a full CFO office. Sometimes they have, they share CFOs in outsourced manner and so on. And it's quite important to support them in other ways, because they are often not as organized, perhaps, as a large company could be. So the people who support them have to be willing to be a little more available and more proactive in the types of advice that they give, be able to connect them with other counterparties who can give them that advice.
Right.
Could it be tax? Could it be FEMA related and so on? Anything that it could be. So therefore, there's a slightly different role without being advisory. I'm not saying we need to be advisory. We just need to be a little more empathetic towards their requirements. And I think that is one of the things that we want to do as a bank, and that we are trying to do by setting up people who have done more of this, who understand the situation is slightly different from a large cap or a mid cap company.
Well, we are going to take a break here, but return to our conversation with Rajat Verma at DBS Bank right after this short break.
DBS presents CNBC-TV18 India Singapore Connect. DBS presents CNBC-TV18 India-Singapore Connect.
Welcome back to DBS Bank presents India-Singapore Connect in association with CNBC-TV18. We're in conversation with Rajat Verma, the CEO of DBS Bank India, and let's pick up right where we left off. We've been, of course, discussing the robustness of the India-Singapore Connect and the deep association that both sides have had and building out this trade corridor. In this sort of uncertain global environment, the imperative to double down on this, I would imagine, is even more significant, is it not?
Absolutely, absolutely. We're natural allies.
Yes.
There's no doubt in my mind about that. And many of this dates back to cultural ties, of course. But also to economic ties, and that has increased manifold, I would say, in the last few decades. Of course, government to government has always been an excellent interaction, and the enhancement of India as a strategic partnership just very recently, all of these are inevitable outcomes of discussions that happen all the time between businesses, but also between governments.
Yeah.
As you know, some of the largest investors in Singapore are very vested in India.
And across different sectors, I mean, from infrastructure to telecom.
From infrastructure to telecom to consumption, everything.
Yeah.
And they have a deep understanding of the Indian market, and they continue to invest. There's a lot more interaction even in the corporate strategic side as well. And you see a lot of strategic companies who are pretty large in India, and are looking to invest even more. So I think the business and economic corridor is real. The social corridor has always been real, right? It's always been real, the amount of remittances, the sort of interaction of people going and all of that. But I think the other third sort of angle to this is the financial services angle, right? So Singapore is a hub for private equity, for venture debt, for financial institutions, for startups.
Yeah.
So I think that these are the sort of very natural sort of points of alliance, I would say.
You know, you talked about areas of congruence and convergence, and one of the, I think, opportunities that India is focused on at this point in time is how do we sort of make use of this move towards diversifying your global supply chain and what that potentially opens up as manufacturing opportunities here in India. How do you see that playing out, and what role do you believe that you could potentially play there?
I think, firstly, I think India has a real shot, to my mind, of being a high-quality manufacturing center. And there's so many recent examples of that which should give us a lot more confidence. I mean, take defense, for example, where it's been proven over a period of time. So you can see that we should start to have a much greater, deeper belief in India's ability to be a manufacturing superpower at some point in time. And there I feel that the engagement with Singapore can be extremely useful, given that it's essentially not only through its own investment, but also the fact that it's a conduit for large investments, large strategics as a regional headquarters. I think the potential for engagement is immense.
As you look at the various metrics that you're working with today, and I know that you're constrained by talking specifics, but what are the metrics that you believe matter to you the most at this point in time as you grow the bank's presence, as you grow the bank's book and balance sheet here in India?
The one set of metrics which I'm very focused on always are the metrics that we hear from our clients. So whether it's the Greenwich survey that you mentioned in your opening, or whether it's our retail bank where we keep looking at how our clients are viewing us through our mystery shoppers, etc., or how our complaints are trending. I think that ultimately is a barometer, and it's a statistical barometer over a period of time. So what you hear from clients on an absolute and a relative basis, because it kind of shows you a mirror from time to time.
Yeah.
The other sort of metrics, industry has comparables, and ultimately you need to see how you fare in that on a relative basis, because that is what gives customers the confidence. So let's take the case of wholesale banking, which is today the bulk of our business. So we spoke about loan syndications at the beginning of this conversation. So let's say you're doing loan syndications. How many you do, how many investors you have the ability to reach out, how much value do you put out for Indian companies? These are all measurable things over a period of time. And so we have to measure ourselves against those in an objective manner to be able to see whether we are really up there or not. The other angle is how your own people think of you as an institution, as how they think of our brand, how they think of our contribution to customers, to society, and so on. So I think taking a barometer of that is an important metric as well for me. How you grow on your financial numbers are important metrics for me, which obviously, I should have said that first. They are very important because we are financial institutions, we have stakeholders. So there is a set of things that one should look beyond the subjective in any assessment, and they're very clear in my head.
We did have constraints on liquidity, which the regulator is now trying to improve on. We've seen rate cuts happen. The expectation is that the rate cut cycle will continue. So how do you assess what's happening in the environment at this point in time, also from a regulatory point of view?
So I think if you think about the structural things that have been happening in India, let's say over a period of 7, 8, 10, 12 years, something like that, things like SMA came in. And then, of course, you had credit bureaus and things like that, which are now so instilled. So the structural changes are very profound. And that is the reason why to my mind, we have the most benign credit period that we've seen. Certainly, if I got my numbers right, and I think it's going to get better from here, 2.7 is our gross NPA, which was probably it wasn't this low for the last 12 years or so. So it is not an accident to my mind. And therefore, when when there is a view that, okay, something is overheating, I think we have to take those views very seriously because we are in a country where people need that credit. And credit needs to get cheaper over a period of time. Otherwise, it becomes a burden on the borrower itself. So we have to heed those very carefully. So I actually feel that the regulatory environment is absolutely essential for this country. Absolutely essential, a tight regulatory environment. Because unless you're strong, you're not going to grow. You're going to impede the growth, as we've seen in the past. So I think it's really, to my mind, I feel very positive about the regulatory environment.
No, absolutely. And as you pointed out, we need to ensure that while there is growth, that it is sustainable growth.